Okay, let's start with Forex now. This is the last chapter. Forex and an extension of Forex is international financial management. Now, Forex as such is a very lengthy chapter because there are too many concepts which are there in this. And what we will initially do is get some good grip on the initial set of concepts where I'll go very slow. I get the grip on the initial concepts. Once that is done, I can solve any type of question. As I used to say in my regular batch, moment my first class of Forex is over, the overall chapter of Forex is over, I'll keep adding something here and there. But major discussion will be the initial 1 hour where the basics are discussed. Let's start. First, there's a term called price currency and product currency. Whatever I'm explaining, it'll be there in the concept book. You just need to be in listen mode. Where I tell you to participate, you need to participate by doing certain question. What is price currency and product currency is, assume I go to a market and I ask a quote, he will tell rupees 10 per apple. This is the price you normally hear in market. You ask what is the price of an apple, he'll say rupees 10 per apple. In this, rupees is the price, apple is the product. Rupees is the price and apple is the product. Same logic can happen for Forex. The first currency is called price currency. The second currency in Forex, you don't see rupees 10 per apple. You see rupees 10 per US dollar. Rupees 10 per US dollar. So rupee is the price currency and the second currency is the product currency. The first currency is the price currency. Second currency is the product currency. This will have certain implication when I solve the question. The first currency is the price currency. Second currency is the product currency. Whatever quote is given. If they give quote which says 82 per US dollar, INR is price currency, dollar is product currency. If you tell me USD 0.0122 per INR, US dollar is the price currency, INR is the product currency. It is not necessary that INR has to be price currency or the other one has to be product currency. Anything can be price currency, anything can be product currency. Depending on whatever the quote you give, I'll decide which is price currency, which is product currency. Then there's something called as direct quote and indirect quote. Not much relevant from problem solving point of view, but still an understanding is good to have. Direct quote means you go to the market, they will tell, I ask what is the price of the apple, he says rupees 10 per apple, you understand that. If I say rupees 10 per apple, you understand it. He says apple 0.1 per rupee. He says apple 0.1, that is I'll give you 1/10 of an apple if you give me 1 rupee. Both are same. 1 apple 10 rupees. 1 rupee can buy you 0.1 apple. 1 rupee can buy you 0.1 apple. So you ask me the quote title rupees 10 per apple, you are very happy to understand this. If I say apple 0.1 per rupee, now you are thinking what is he saying? What is he trying to say? I am not able to understand. In the market, nobody will say apple 0.1 per rupee. They'll say only rupees 10 per apple. Rupees 10 per apple. Rupees 10 per apple is a direct quote. Apple 0.1 per rupee is indirect quote. Rupees 10 per apple is a direct quote which you understand. Apple 0.1 per rupee you don't understand, it is called indirect quote. It is called indirect quote. In short, if I am in India, I want to see rupees first and the other currency later. I want to see rupees first and the other currency later. So if home currency comes first, foreign currency comes second, it is called a direct quote. So today I go to the market and ask, he'll say rupees 85 per dollar. I understand this. Rupees 90 per pound, I understand this. But suddenly he says USD 0.01 per rupee. I'm now thinking, what is he trying to say? That's the other quote. That is the indirect quote. What is direct quote for India is an indirect quote for the other country. Is an indirect quote for the other country. For example, in India, if you say rupees 85 per dollar, it's a direct quote. Same if you say in USA, it's an indirect quote for USA. Does this make any difference in problem solving? Nothing much different from a problem solving point of view. How do I convert a direct into indirect? If 82 is direct, 1 by 82 is indirect. 1 by 82 is indirect. Certain simple example. Following are the quotes given by whom? Mumbai Banker. You see what first here? INR. It's a direct quote. You see INR first, it's a direct quote. What do you see first here? AUD. AUD if you see first, it's an indirect quote. It is a indirect quote. Does it have any implication on problem solving? Really no. I don't have any implication on problem solving, but understanding a direct quote and indirect quote is good to know. It's just good to know. Now how do I convert 1 divided by 8.8438? 1 divided by 8.8438. and 1 divided by 0.03038. 1 divided by 0.03038. Any doubts on this? A direct quote, indirect quote, both are there. I can convert the way I want. Then there is something called as a two-way quote. There's something called as a two-way quote. I asked a bank what is the interest rate. I asked the bank what is the interest rate. He says 6.5-7. He says interest rate is 6.5-7. I clearly understand if I want to create a deposit, 6.5 is the interest rate. If I want to borrow, 7% is the interest rate, because banker wants to make money. Banker wants to make money. He cannot say, you say interest rate is, what is the interest rate? He may ask you a next question. Are you asking for deposit or are you asking for a loan? Next question will be, are you asking for a deposit or are you asking for a loan? Similarly, when you ask a bank what is the exchange rate, he will say, are you asking for buying something or selling something? Are you asking for buying something or selling something? So there will be a two-way quote. There will be a two-way quote which has two quotes, and the gap is the banker's profit. The gap is the banker's profit. Like 6.5 and 7, the gap is the banker's profit. Here also there will be a banker's profit. There will be a banker's profit. So the first rate is called bid rate, which is banker's buying rate. Bid rate is banker's buying rate. Then there is a ask rate, which is banker's selling rate, which is banker's selling. Example, 82.5/83. 82.5/83. What banker is saying is, banker is the only person who openly tells what is his profit. Like this, if I go to a supermarket, I ask what is the price of an apple. He says rupees 8/10. He will not tell you this. But if he says this, you can understand at 8 rupees, if you are a farmer and go to him, he will buy apple from you at 8 rupees. And you go as a customer, he will sell it at 10 rupees and make 2 rupee profit. But when you go to a supermarket, you never know what is his buying rate. He will never tell you what is his buying rate. Banker openly tells that what profit I make. Banker is openly telling what profit he is going to make. What is the profit he makes? Difference between the two rates. Difference between the two rate. Openly he will tell that this is my profit. This is my profit. What is the profit in this example? 50 paise. 50 paise is the profit I want to make, rupees 82.5/83 per US dollar. Unfortunately, this is the item which causes 80% of students doubt. You will message me saying, why are you using bid rate? Why not ask rate? Then you will ask me, why are you using ask rate? Why are you not using bid rate? Because your mind is fixated on one thing, saying that buy bid rate, sell ask rate. You don't even look into the currency. Your mind already makes a conclusion. Making an early conclusion will lead to errors only in this chapter. Making an early conclusion, be it derivatives, be it forex. Only problem in derivatives and forex is, derivatives, I tell you to think slowly and answer in an option. But when I think slowly also, it will take me only 3-4 minutes to solve an option problem. Here I'll tell you to think slowly, but it is not one question. First there will be a question, second another question, third another question. Every time you need to decide bid ask, bid ask, bid ask. 5 times you need to decide. Every time you make the right decision, final answer is correct. You suddenly make a mistake in one time, your solution goes wrong. This is the cause for 90% of forex issues. Whatever students face, bid and ask is the reason for 90% of the mistakes students make. And the reason for mistake is very simple. Your mind has already decided that, okay, I am buying, I am an importer, I am buying, please decide this rate. I am selling, please decide this rate. Your mind has already told you the answer. You are not even thinking about the question. You are not even trying to solve the question. You have already decided the answer. If you have already decided the answer, then there is no point in me explaining or no point in going through a process. In our problems, we will go through a process. When I go through a process, the answer, if a normal situation takes you 4 minutes, my answer may take you 6-7 minutes. Extra time will be there. But extra time will ensure you don't make mistakes. You don't make mistake. At some stage, because I keep solving question, at some stage I'll go very fast. When I say very fast means I know those steps. In my mind, I'll make the step and give you the answer. You may not get that answer. So at some stage, if you're not getting the answer, then you will have to think through those step by step. First step, second step, third step, fourth step, fifth step. There are series of steps I want you to do. If you do those series of steps and write the answer, I can tell you any type of forex problem you solve, you will get the answer. What is forex is two things. Two things, if you decide correctly, everything will be right. You will think you need to divide. Answer will say multiply. And you will think it is bid rate. Answer will say ask rate. These are the two mistakes students make. So you have to ensure that you don't make these two mistakes. You are thinking division, solution will say multiplication. You are thinking multiplication, solution will say division. And the other challenge is you are thinking that it is the bid rate. Answer says ask rate. You are thinking it is the ask rate. Answer says bid rate. If you are able to manage this by solving 50 questions step by step by step by step, you will become very confident. 51st question, what you will do, you don't want to follow the step because you think you know everything and you start doing it. ICA does something, you make an error again. You make an error again. I am repeating. If you give me a forex problem and tell me quickly, give me the answer, I'll give you the answer. I may get it, I still may get it only 80% of the time right. 20% I will also make a mistake if I try to rush through the solution. If I try to rush through the solution, and that's my challenge in a revision. My challenge in a revision batches, if I rush through the solution, you will end up surely making a mistake. So initial 1-2 hours, you will see it is going like a regular class. Very slow it will go. But once you get clarity on that, you will see the normal speed starting. But the point is, at any stage you get confused, you will have to go through those series of steps. You will get to the right answer. This is the major concern. Major concern is not knowing what rate to start. Okay. So I've explained bid rate. I've explained ask rate. Ask rate has to be always greater than bid rate. One exam question. Unfortunate. ICI gave rate like the 61.72, 61.6. This is little unfortunate because your mind has thought first rate is bid, second rate is ask, which is right. They have done something like this. In this is the bid rate, 61.72 is the ask rate, because my ask rate can always be higher than bid rate, because banker is here to make money. He's not here to lose money. He's not here to lose money. Average of bid and ask is called middle rate, which has zero utility, only for statistical purpose. Only for statistical purpose. We may not use middle rate in any of the question. The difference between bid and ask is banker's profit. This profit I can calculate as a percentage of bid rate. I can also calculate as a percentage of ask rate. Logically speaking, I should do as a percentage of ask rate. ICI solution has done as a percentage of bid rate. To make it better, we did one area, conversion premium. I told conversion premium divide by conversion value, current market price, multiple things I told you to divide. So you will write 10% of bid rate, 9% of ask rate. Two answers you write in exam and then proceed. If they ask you spread. Spread is the difference between, so the spread is the profit. Percentage, if you want, it can be a percentage of offer price. It can be a percentage of bid price. Clear? Any doubts till this? An example, 82.5, 84.5. In this example, bid rate is 82.5, ask rate is 84.5, middle rate is average of this, spread is the difference, which is the profit he is making. Any doubts till this? So I've introduced bid rate, ask rate, middle rate, spread rate, and spread percentage. Then comes something called as PIPS. What is PIPS is, banker is saying, I am very lazy, I'll not give you the quote directly. I'll not give you the quote directly. I will do something called as a PIPS in the quote. I'll do something called a PIPS in the quote. What is PIPS in the quote? 82.5 hyphen 82.8. Now he is saying, why should I repeat this 82 again? Why should I repeat this 82 again? So he will say 82.5 hyphen 80 hyphen 80. If this is given, obviously ask rate cannot be lower than the bid rate. Ask rate cannot be lower than the bid rate. So 82.5, that 80 given is the number after decimal. Is the number after decimal. So 82.50 hyphen 82.80. Now what they do is, let's assume they give 85.00. Don't do any interpretation. 85.00 means it is the real rate. 85.00, it is the real rate. Now comes 82.500 hyphen 80 hyphen 80. This 80 is the last two decimal of the quote. This 80 is the last two decimal. So 82.500 hyphen 82.580. 82.500 hyphen 82.580. If you do this interpretation and unfortunately the ask rate turns out to be lower than the bid rate, which is a rare scenario, then whatever rate they have given is the direct rate. Whatever rate they have given. Example, 82.892 hyphen 83 hyphen 83. What I'll normally interpret is 82.892 hyphen 82.883 883, which is not possible. Which is not. Why not possible? Ask rate cannot be lower than bid rate. Then understand this as 83.000. Understand this as 83.000. They'll not mention 000 there. That you have to understand, because ask rate has to be always higher than bid rate. These are few addition which will keep happening. These are few things which will keep happening in problem. The numbers after the decimal in quote are called as pips. If the numbers before the decimal in pip in bid and ask is identical, while quoting the ask portion, only the pip is quoted. Only the pip is quoted. Example 67.80 hyphen 67.90 is written as what? 67.80 hyphen 90. Practically this is what happens. Okay, practically also this is what happened. Then they are saying if the numbers in the pip is also same, numbers in the pip is also same, then I will not repeat the number also. I will not repeat the 12.315 hyphen 70. 12.315 hyphen 70. He is saying I'm lazy. I will not even repeat number 3. I will not repeat even number 3. If they given 70, it is the last two decimal. It is the last two decimal. Understand 12.3150. That 0 is added there. Hyphen 70. Which means in place of the last two decimal, you will have to write 70. In place of the last two decimal, you have to write 70. 12.3150 hyphen 70 is interpreted as 12.3170. 3170. Please go through this and tell me what is the ask rate. USD 1.5606 hyphen 950 GBP. Which rate you want me to take? 1.5950. Clear? Any doubts on this? Any doubts on 1.5950? Okay, now I want to do direct to indirect, indirect to direct conversion. Earlier I told do 1 by indirect, but now there's a problem. Let's understand. Spot rate is 60, 80. 60 and 80. Such a huge difference will not be there, but let's assume it is 60 and 80. Now I want to convert into the other. I want to convert into other. Tell me what is 1 by 60 and 1 by 80? 0.01. Second one, I face a challenge. If I write this, bid is turning out to be higher than ask. If I do this, bid is turning out to be higher than ask. I did what you told, 1 by 60, 1 by 80. That is what we do. That is inverse. But there's a challenge. What is the challenge? If I do it like this, 0.0167 is a bigger number and 0.0125 is a smaller number. So what they say is, if you want to convert bid indirect into indirect, for bid you have to do 1 by ask, and for ask you have to do 1 by bid. For bid you have to do 1 by ask, and for ask you have to do 1 by bid. If I do it directly 1 by bid, 1 by ask, I face a challenge. Challenge is very clear. My ask rate has to be higher than the bid rate. This is the logic for using the other rate. This is the logic for using the other rate. Clear? Any doubts on this? So I cannot do 1 by 60. I have to do 1 by 80, and for the other one I have to do 1 by 60. Clear? Any doubts on this? Now this is the second source of confusion. When I say second source of confusion, your mind has told bid rate. I say a solution will do 1 by ask rate. Now student will keep asking me, why are you using ask rate? Why are you using ask rate? Why are we not using bid rate? They never check that I have done 1 by ask rate. They are right saying that bid rate is to be used. Everything is right, but bid rate is 1 by ask. Bid rate is 1 by ask, and ask rate is 1 by bid. That you have to understand. So be very clear. Logic is very clear. Logic is very clear. If you do direct division, what will happen is bid rate will turn out to be higher than ask rate. Let's take this example. INR per USD 65.20 hyphen 80 hyphen 80. What will be the bid rate for USD per INR? Other one. Tell me the answer. Bid rate for USD per INR. Just use calculator and give me the answer. 0. For bid rate, what should I use? 1 by ask. And 80 is not 80. 80 is 65.80. 80 is 65.80. So 1 divided by 65.80, you get the answer as 0.015198. 0.015198. Clear? Any doubts till this? Very simple calculation. Again, these are major sources of confusion. One is you don't interpret the pips properly. You don't interpret the pips properly. Second, for bid I have to use 1 by ask. For ask I have to use 1 by bid. Any doubts till this? Once the base is set fully, then only I'll be able to get into the exam questions. Any doubts till this? Okay, some question will ask you to calculate return. It will ask you to calculate return. Return can be calculated in home currency. Return can be calculated in foreign currency. What is home currency? Mostly INR. What is foreign currency? The other currency. I invested in USA. In USA, I'm generating 7% return. In India, the 7% may become 12, 13, 14, 15, 16. Both are not comparable. Reason is appreciation or depreciation of currency. Reason is appreciation or depreciation of currency. In capital budgeting, I said MDR is equal to RDR plus inflation, where I told I cannot add like this. I wanted you to add what? 1 plus MDR, 1 plus RDR into 1 plus inflation. Same way, INR return is equal to USD return plus R minus appreciation of USD, appreciation of foreign currency, appreciation of foreign currency. You cannot add them. So add 1 and do multiplication. Add 1 and do multiplication. I'll explain the implication of this when I do a problem. 1 plus home currency return is equal to 1 plus foreign currency return into 1 plus appreciation or depreciation of what? Foreign currency. In the formula, appreciation percentage of foreign currency should be added, while the depreciation of foreign currency should be deducted. It is important to solely consider the percentages of what? Foreign currency and not those of home currency. For calculating home currency return, don't write the appreciation or depreciation percentage of home currency. Example, very simple example. Let's just see this. Investment on day 0, 100. I don't want you to solve. When I tell you to solve, please solve it. Okay. Interest earned is 10. Value is 105. So I invested 100. I got 10 plus 105, 115, 15% return. 15% return. Unfortunately, the place where I invested, currency has depreciated. The place where I invested, currency has depreciated. Approx answer is 15 minus 5%, 10. That's approximate. That is approximate. I will not earn more than 15. Now I'll earn less than 15. Many a times when you invest in India, they will earn 12-13% return in India. But then when they convert to USD, it will become 2-3% for US investor. Because unfortunately, Indian currency depreciates. Indian currency depreciates. And they are okay with it, because when you invest in USA directly, you generate only 2% return. You generate only 2-3% return. So how do I calculate this? 1 plus INR is equal to 1 plus foreign currency 15 into 1 minus 5% of USD. 1 minus 5% of USD. Can you get me the answer? 1 plus 15 into 1 minus 0.5. How will it be 20? Minus 9.25. 9.25. Now USD returns 6%. Appreciation of INR is 5%. How much is the INR return? Let's make it one thing very clear. INR is not always our home currency. Please don't be fixated saying that INR is only my home currency. I cannot help it. If you keep coming with that mind, INR is not my home currency. In this case, which appreciation I have? INR. So I'll put INR as the foreign currency now. I'll put INR as the foreign currency, because in my formula, what I can use? Appreciation or depreciation of which currency? Foreign currency. Appreciation or depreciation of foreign currency. So 1 plus USD return. 1 plus USD return is equal to 1 plus INR return. 1 plus INR is my foreign currency. Okay. INR is my foreign currency into 1 plus INR appreciation. 1 plus INR appreciation. 1 plus 0.06 is equal to 1 plus INR into 1 plus 0.05. Tell me the INR return. 0.95. Again, I'm repeating because I don't know. I can explain in any ways. Don't think that INR is only our home currency. Don't think INR is only our home currency. INR many times will become foreign currency. At that time, students keep saying that we are in India, INR is home currency. I cannot help it. I cannot help it, because I don't want you to solve this question with your own assumption. If you come with your own assumption, I cannot do anything there, because you have your own assumption. INR is our home currency. Why are you doing the other way around? I cannot help it there. If you come with those set of assumption, answer cannot be solved. I cannot get to the right answer. At that time, I don't want you to think you are solving from India's point of view. You may be solving from US point of view. You may be solving from UK's point of view. A problem can be solved from anyone's point of view. Clear? If there is a two-way quote, if there is a two-way quote, formula and all cannot be done. How will you calculate return? I'll explain later. We'll have to solve the problem and use bid and ask rate. Two-way quote means bid is also there, ask is also there. Commonly used currencies. Why are these needed? Because some question they'll give the quote saying USD per INR 85. This is a quote which comes in exam. USD slash INR, not per, I'll use the word slash INR 85. Can you tell me, can it be USD 85 per INR? It is can it be USD 85 per INR? Practically possible? No, but practically quotes are given like this only. Practically, this is called the way of giving the quotes. Practically, if I go and check USD INR rate, practically the quotes will be given as USD slash INR. Again, I'm repeating USD slash INR. Just give me a minute. You look at here. USD slash INR 82.88. USD slash INR 82.88. Now I cannot go to the bank and say I'll give you one INR, give me $82. Give me $82. That's not possible. But internationally, quotes are given like this only. It is USD slash INR. It is not USD per INR. It is not USD per INR. It is USD slash INR. It is USD slash INR, and this is international convention, which ICI in few questions does it. Many questions they don't follow. Many questions they don't follow. So what I need to do is, if I see a question like USD slash INR 85, don't say USD per INR 85. Don't say USD per INR 85. You have to say this as what? INR per USD 85, and they have done solve the question as INR per USD. They have done the right thing, everything. And in fact, that is the right question. That is the right question. Many times they give the wrong question. What is the wrong question? INR slash USD. INR slash USD is the wrong question. So in order to interpret the quote, you may have to understand this order. Whenever INR is there, I have no problem. But question will give USD slash GBP. USD slash GBP. You have to understand whether it is USD per GBP or GBP per USD. GBP is the costliest currency. GBP is the costliest currency. So if they say USD per GBP 2.5, it is possible. 1 GBP can be $2.5. 1 GBP can be $2.5. But if they give the other way around, then you'll have to understand this GBP 0.8 per dollar. GBP 0.8 per dollar. Now in an exam question, they can give 3-4 quotes. If you're able to interpret one, then the same logic you can apply for others. Then the same logic you can apply. That is USD slash INR. If I've interpreted that as INR per USD, USD slash GBP will be GBP per USD, USD slash Euro will be Euro per USD. One interpretation is sufficient. So for that, it is better to know the internationally rates, and in this order. This is the order. Internationally, all currencies, the commonly used one. I'm talking about the commonly used one in exam. Every currency is costlier than INR except JPY. Except JPY. Japanese yen is cheaper than INR. Japanese yen is cheaper than INR. Everything else is costliest. Everything else is costliest. Now comes the next one, cross rate. What is cross rate? Doing cross multiplication. Cross rate is nothing but doing cross multiplication. If I tell that you have to do cross multiplication, a 4th standard student would be very happy, saying 4 by 5 into 5 by 4, I have to do this. But if I tell you in Forex, you get really irritated with it. So cross rates is just doing cross multiplication. It is nothing. Forex is really nothing in exam, because you keep confusing yourself with your own preconceived notion. I am explaining so much. After 20-30 minutes, somebody will ask, why are you using bid rate? Why are you not asking ask rate? This has happened with me in every batch. This has happened. Maybe this time I have told you, you may not ask me, but you will have this in your mind. You will have this in your mind. You don't want to ask me because you will say, this guy is already told, why are you using this? So let me not ask it. Let me keep it in my mind. This is what the problem with the chapter is all about. The chapter doesn't have any other difficulty. The chapter doesn't have any other difficulty. It is just your mind has already decided something. Your mind has already decided something. In fact, if a student is not able to think much, he'll be able to do Forex better, because he'll follow whatever I say. Student who is smart, he'll say, no, no, I don't want to follow what this guy says. He is saying follow 5 step. I will do smartly. I'll follow 1 step and do the answer. 4 answers, he'll get it right. Fifth answer, I see I will give some bouncer and you make a mistake. And every question will have 5 or 6 requirements to be done. 5 or 6 requirement means 5 times you have to decide division, multiplication. Bid, ask. 4 times you decided correctly. Fifth time you made a mistake. Entire solution went wrong. This is what keeps happening in exam. There's no other difficulty in this chapter. Let's understand this. USD slash GBP, USD slash GBP, USD slash Euro. Think about the normal rates. Think about the normal rates. Is it USD per GBP or GBP per USD? I given you which is costlier, which is cheaper. GBP, should it be USD per GBP or GBP per USD? Looking at the rate, looking at the rate. USD per GBP. GBP is costlier. GBP is costlier. So 1 GBP can be more than $1. So the quote is as it is. The quote is as it is. Now, the given quote is not okay for me. So I'm writing 1.5606, 1.5650, 1.5606. In fact, I go through the entire concept book. The chapter is over. I can complete this even in 3 hours by going through the entire concept book. But anyway, I want to solve certain questions. So I'll keep solving them. 1.5606 hyphen 1.5650. Second one is what? 2600. What they're asking? Bid euro per GBP. Bid euro per GBP is equal to bid. The connecting currency in this case is US dollar. The connecting currency in this case is US dollar. So you wanted euro per GBP, please euro in the top, USD in the bottom, into USD per GBP. USD per GBP. Whenever you write a quote, please write it like this: USD per GBP. USD per euro. Do you have euro per USD here? Do you have euro per USD? You don't have? Then tell me 1 by ask. Then you'll have to tell me 1 by ask. If you don't have, you'll have to tell me 1 by ask. If you have, write it directly. If you have, write it directly. Why I keep telling you have to write USD per GBP? Because you can look at here and then see. What is given is USD per euro. What I want is euro per USD. What I want is euro per USD. So I don't have, I'm writing 1 by 1 point. Do you have USD per GBP? Guys, participate, please. Do directly into 1 point. Do the multiplication. 1 point. This is as simple as that. This is as simple as that, provided your thought is okay. Because now I'll tell you, see, though it may look very simple, I keep talking about this. I tell with my experience and you will have your own experience also. I need not tell with my experience. I did bid euro per USD. No, student is very clear in his mind. I have to use bid rate. Bid rate means I should use only 1.5606. I should use only 1.2456. He has decided this. He has decided this, that I should use only 1.2456. Suddenly he sees 1.2600. Immediately message saying, why have we used this rate? Why have we used this rate? A message will come to me. Then I'll ask, did you expand the formula? Did you think this? Did you do this? Then he'll say, okay, I'll do all this. Then he'll get the right answer. Then he'll get the right answer. So trying to do it in a short manner will not give the answer in this chapter. Again, I'm making it very clear. And the another headache is deciding division and multiplication. He has decided I'll multiply only. That is his thing. He says, I don't want to divide. ICA gives a shocker there. They'll keep adding this. Clear? Any doubts in this? Now comes the most important part. How do I solve my basic problem? When I solve, I will start with something called as a known component and unknown component. Student who have done with me will know what I'm trying to say. But for others, I'll start explaining with certain numbers. Question says, I want to buy $10 lakh. Only thing I know is I want to buy $10 lakh. What is known as $10 lakh? $10 lakh. Whatever you know is called $10 lakh. Now he has decided what I know is home currency, what I know is foreign currency, nothing like that. What I know is when you can answer that number. With an example I will do. Here he is saying what? I want to buy 1 million. I want to pay how much minimum CHF amount you have to pay for what? 1 million. So known component is 1 million CHF. 1 million CHF, please write along with me. Known component 1 million, sorry, 1 million GBP. 1 million GBP. Known component 1 million GBP. Known component 1 million GBP. 1 million GBP. Whichever number you can tell. Some question will say, I want to sell 2 million GBP. Known component is 2 million GBP. Whatever you can tell. In terms of which currency you want the answer. Unknown component is question mark CHF. Unknown component is question mark CHF. I'm trying to find 1 million GBP is equal to how much CHF. That is my requirement. 1 million GBP is equal to how much CHF. Any doubts till this? Okay, then I move to the next step. CHF is equal to for the time being, ignore the second quote. Okay, ignore bank B. Ignore bank B because it will become too much confusing. This is a second complex level problem. This is not the initial level problem. So ignore bank B for the time being. Only you have bank A. Only you have bank B. CHF is written in the left hand side is equal to unknown component is equal to known component into I should do something so that GBP gets cancelled and you get CHF. GBP should get cancelled and you should get what? CHF. How will it get cancelled? CHF by GBP got cancelled. GBP got cancelled. CHF is equal to GBP into CHF per GBP. In this process, what will get cancelled? GBP will get cancelled and CHF is the balancing figure. Any doubts till this? Any doubts? If you are not clear, I'll explain again. Any doubts? Now, next question you need to ask is, what is the denominator currency? What is the denominator currency? What is the denominator currency here? Now, write denominator currency is equal to GBP. Denominator currency is equal to GBP. Will you have to write like this in every step? At some stage, if you get comfort, you can do without writing. If you don't get comfort, in exam, one question on Forex you are going to do, it's okay to write such a lengthy answer so that you get the right answer. Denominator currency is equal to GBP. Our action. What do you want to do with GBP? Do you want to buy GBP or sell GBP? Please read and let me know. Do you want to buy or sell? Our action buy GBP. Our action buy GBP. It says how much CHF you have to pay for 1 million GBP. So you are planning to buy GBP. Our action with the denominator currency. I'm talking with the denominator currency. Our action is what? Buy GBP. What is the banker action? Bank action, right? Please write. Bank will sell at ask rate. Bank will sell at ask rate. Bank will sell at ask rate because bank wants to make money. Bank wants to make money. So now only I have decided that I want the ask rate. Now only I have decided that I want the ask rate. Student saw the question. Mind has already decided that I want to use bid rate. Mind has already decided that I want to use bid rate. He will write bid rate. He will write bid rate. So it may look very lengthy, but I can tell you any Forex problem you do, you will get the right answer provided you are thinking like this. Provided you are thinking like this. You may say it is looking very lengthy. I don't want you to write this. I want you to think only about this in your mind. I want you to think only about this in your mind. If you can think about this in your mind also, it is sufficient. If you think about this in your mind, that is also sufficient. Any doubts till this? Any doubts on this? Now I'll have to do expansion. Now write. Please write whatever quote you had. CHF is equal to GBP into ask CHF per GBP. Which is the connecting currency? There is some currency which is connected. Let's expand. GBP into ask CHF per USD into USD per GBP. What is expansion? USD cancelled. What is expansion is USD cancelled. Now this expansion at times it will be into CHF by USD, into USD by INR, into INR by some other currency, into some other currency. Normally ICA does it only 3 stages, but I can do till 20 stages also. Doesn't really matter. Concept is same. You will have to keep doing till you get GBP in the denominator. You will have to keep doing till you get GBP in the denominator. So sometimes it will be CHF per USD into USD per Australian dollar into Australian dollar per GBP. 3 times they will go. 3 times they'll go, not beyond that. Now, what is the GBP you want to buy? 10 lakh into, look at only one bank. Do you have CHF per USD there? Before that, I may have to check whether that is right or wrong. I may have to check whether that is right or wrong. I don't know about CHF per USD, but I know about USD per GBP. I know about USD per GBP. USD is a costlier currency. USD is a cheaper currency. GBP is a costlier currency. So the given quote is fine. The given quote is fine. Do you have CHF per USD? Tell me the ask rate. Don't look at both the rates, okay? I've removed one bank, okay? I've removed one bank. We will see that later. I don't want to bring two banks as of now. I don't want to bring. Do you have USD per GBP? Do you have? Please tell me. Yes. What is the number? That's all. This is the answer. This is the answer. 10 lakh into 1.4655 into 1.7660. There's nothing beyond this in Forex. There's nothing beyond this in Forex. Only thing is, if your mind has already decided some number, I cannot really help in that. I cannot really help when your mind has already thought about a number. Any doubts? The answer may not match with what is there because I didn't want to do both the banks together. I didn't want to do both the banks together. So every question, I'll first decide what is the known component, what is the unknown component. What is known component? One which you know the number. What is unknown component? The other currency. Unknown component is equal to known component into something so that the numerator denominator gets cancelled. That is USD is equal to INR into USD per INR. INR got cancelled. INR got cancelled. Euro is equal to GBP into Euro per GBP. GBP got cancelled. Like this, you'll have to keep cancelling. That is the stage one. Stage two, whatever is your denominator currency, whatever is your denominator currency, please tell what you are doing with the denominator currency. What you are doing with the denominator currency, what the bank is doing with the denominator currency, then decide bid or ask. Then decide bid or ask. Again, I'm repeating. The same question may say, how much minimum CHF amount you have to pay for 1 million GBP? I can change the question. How much CHF can I get? Can I get with 1 million GBP? How much CHF can I get with 1 million GBP? Then you will have to think, what are you doing with the GBP? It will be the opposite calculation. So you will have to imagine the calculations correctly and then proceed. Please check what is the denominator currency. Sometimes you will think you are buying, but it will be you are selling the denominator currency. You have to check what are you doing with the denominator currency. What are you doing with the denominator currency? What is the bank doing with the denominator currency? Decide bid or ask. Decide bid or ask. Assuming you have decided that. You have decided that. Do cross multiplication. Do cross multiplication. Then look at in the question. Do you have that? Write it. You don't have, one by ask, one by bid. One by ask, one by bid, depending on what you want. Depending on what you want. Clear? Any doubts on this? Let's take this example. Let's take this example. Euro 1.24-1.40 per GBP. INR 75.25-35 per GBP. How many GBP can be purchased with INR 1,20,000? Before we start doing it, is the quote okay? Is it INR per GBP? Okay. If quote is given like this, no need to do any interpretation because they have used the word INR per GBP. When should I use interpretation? If they give something like this. CHF/USD does not mean CHF per USD. Let's be very, very clear. CHF/USD does not mean CHF per USD. In one exam, the question gave this USD/INR rate. USD/INR rate. Don't tell me this is USD per INR. Don't tell me this is USD per INR. It can't be. It can't be. It has to be what? INR per USD. It has to be INR per USD. Does this happen frequently? 15 to 20, not 15, 10% of the questions will have this. 10% of the question. In fact, only 10% of the questions are correct. Balance all are the wrong convention. All are wrong convention. Real convention is USD/INR. I showed you the example of State Bank of India quote. That is a real convention. Student asked me that doubt, why are we not doing USD per INR? I cannot do USD per INR because it is not possible. It is not possible. So this check you have to do if they use the word USD slash INR. If they tell USD per INR, where is the convention I have to follow? They have given USD per INR. Let me follow USD per INR. I just hope they don't do a mistake there. By using the word USD per INR, they don't do a mistake here. Let's come to this. Which is the known component here? You will write along with me. Please write initial question. This known unknown, once we crack it, for me Forex is over. I can keep doing any add-on problems I want. But for me, the Forex gets over moment you crack this known and unknown properly. Moment you crack this known and unknown properly. In my regular class, I spend around 3 hours on this. Here, I think in 1 hour, we'll crack this part because every concept I had to go. Well, I have not gone faster, but you are able to relate to those concepts because you've already gone through the subject. Now, right. Known component is equal to, what is the known component here? Known component is equal to INR, unknown component. Question mark, GBP. Listen, tell me what are you going to do with GBP and what are you going to do with INR? Here itself we will write. Are you going to buy GBP? Because later on your mind will force you to make a mistake. When you write known component, unknown component, tell me, are you planning to sell INR or buy INR? Sell INR and buy GBP. So GBP in right bracket buy. This say sell. INR I am planning to sell and GBP I am planning to buy. Why I am writing at this stage? Because next stage your mind is already decided something. I don't want you to decide that. I don't want you to decide that part now. So let's write this and then proceed it. Because at this stage you don't have a preconceived notion. Moment you write the expansion formula, you already have a preconceived notion which keeps happening. Which is the known component? Unknown component. GBP is equal to INR into GBP is equal to INR into what should I write? GBP by INR. GBP by INR. Clear? Now tell me what are you doing with INR? Sell. INR sell. What is the word question has used? Purchase. Your mind has already told you. That is what happens. Okay. That is what happened because you saw the word purchase there. You saw the word purchase there. You have decided that we are buying. You have decided that we are buying. That is why I gave you this example and that is why I told please write it first itself. Please write it first itself. What are you doing? I want to know what I am doing with my denominator currency. I don't want to know what you are doing and all. Please don't tell me what you are doing. What are you doing with your denominator currency? What is the denominator currency? INR. What are you doing with INR? Sell. What is the bank going to do? Buy. Bank will buy it. Right bid. Usual doubt of the student, why are you using bid rate? Why not ask rate? Usual doubt of the student, why are you using bid rate? Why are you not using ask rate? Clear? Any doubts on this? What is the connecting currency in the question? GBP cannot be the connecting currency. Just give me a minute. Take it. Change. How many euros? Take. No. Let's not worry about the answer. Let's not worry about the answer. Just change how many euros. Just change it as how many. See, if it's GBP, I can solve it also. If it's GBP, I'll directly use code 2. I'll directly use code 2. Code 2 is given in the question. Let me use it directly itself. It's not that there is an error, but yeah, I wanted euro. I wanted euro because the solution says unknown component, question mark euro. My objective was to do it as euro. So let me use the word euro here. So euro per INR. Tell me the connecting currency now. What is the connecting currency? So euro per GBP into what? Euro per GBP into GBP by INR. GBP by INR. GBP will get cancelled. GBP will get cancelled. I am getting euro per INR in the end. I am getting euro per INR in the end. Next, euro is equal to 1,20,000. Do you have euro per GBP in the question? Yes, tell me the bid rate directly. Do you have GBP per INR? No. Tell me 1 by ask rate. 75.35. You will get the answer. You will get the answer. Yeah, I think that is what I wanted to do. It's just a wording issue. It's just a wording issue. It's just an error in the question. Okay, let's not worry much about it. If you are able to solve the concept book MCQ itself properly, 80% of the questions you will be able to solve it. That's how I have designed the MCQs. Few chapters I'm very confident about the kind of MCQs I've generated. Few chapters, I could have done little better also, but I at some stage wanted to release the book, so I may not have got to that stage of perfection. But this is again one chapter where with MCQs itself you will get full clarity. With the MCQs itself you will get full clarity. Any doubts on this? I will give you 2-3 more questions. Let's do that once and be done with this known unknown component understanding. And once that is done, we will go to regular speed. We'll go to regular speed because I didn't want to do regular speed till I get this clarity with you. Now, write quote 1, euro 1.50-60 per. I'm giving the proper code, no interpretation. I'm not expecting any interpretation from you. Okay, 1.50/60 per GBP. Code 2, INR 85/87 per euro. 85/87 per euro. Code 3, INR 75/77 per US dollar. 75/77 per US dollar. Code 4, USD 1.25/30 per GBP. USD 1.25/30 per GBP. Okay, 4 codes are sufficient. First requirement is how many USD is needed? How many USD is needed to buy 1 lakh euros? How many USD is needed to buy 1 lakh euros? There's a possibility that I could have made a mistake in framing the question. If so, I will change the question in a minute, if at all, because I've just framed it. Let's see whether we are getting the answer. In case there's an error, is I will need a quote, and if it's not there, then I'll give you extra quote. This is the requirement. Start known component, unknown component, in bracket write what you want to do, expand formula, and then complete it. I'll wait for 2-3 minutes. I've already shown you one example where question said purchase, but our action was sell. So don't go with any preconceived notion when you do the problem. That's the only requirement I have.
Sir, is it 116,000
No,
USD?
I don't want the answer. I'll show it. You guys can check. That's all. I don't want anyone to give me any answer because I also don't know the answer. So I cannot tell whether it is right or wrong. I'll just show it here. In case I may also make a mistake. Again, I'm repeating, after doing so many things, I myself have made mistakes in many batches. And it can happen. Because sometimes I will say that, okay, let me skip a step. I would have thought something in my mind and I would have done, and it can lead to errors. Okay, an error with the quotes, that is you can go through the INR route also, you can go through the GBP route also. That's a mistake from my side. Okay, whatever answer, see, somebody could have expanded using INR, I have expanded using GBP. That's okay. That's an error from my side in framing the question. That's an error from my side in framing the question. Let's not worry much about it. See, you could have written USD per INR into INR per euro. That is also perfectly fine. That's just an error in framing the question. Okay, let's not worry much about it. This will be the answer if I expand using GBP. If I expand using GBP, some of you could have expanded using INR. I'll show that also. There's nothing wrong. It is just that when I framed the question, I did not even think about this possibility that I'm framing an error there. Okay, let's not worry much about it. If you have expanded using INR, and both can give a significantly different answer and all, because I have not framed a question properly here. So let's not get into the calculation part of it or worry about this. Okay, this is what I think you should write. This is what I don't want the final answer also. Are you getting this? 87, is it? Okay, okay, sorry. Ask rate is 87. Any doubts on this? Any doubts on this part? If this is tackled properly, if this is tackled properly, 90% of our issues are managed. 90% of the issues are managed if you are able to tackle this properly. Any doubts on this first? Any doubts on this? How many INR is needed? How many INR is needed to buy 1 lakh GBP? I'll tell you, please ignore quote 3 and quote 4. Okay, use quote 1 and 2. Use quote 1 and 2. 3 and 4, if you use, you'll get a different answer, because that's just an error in the framing. Use first and second quote. Any doubts on this? Like this, which one? This one. What is the denominator currency in the expansion here? GBP. In your known unknown, you have written what? Nay, did you write buy sell in bracket? The confusion is very simple. What are you doing with GBP? Known component 1 lakh GBP. What are you doing with GBP? Needed to buy 1 lakh GBP. No. So I'm going to buy GBP. Needed to buy 1 lakh GBP means I'm going to buy GBP.
Sir, small down.
You are going to buy, banker is going to sell. Banker is going to sell. Banker will sell at what rate? Ask rate. If someone had a doubt in live online, please tell me.
Sir, when we expand the formula, should we expand using the numerator currency or denominator currency, sir?
Anything you can do. You just need to expand, that's all.
Okay.
Okay, clear? Assuming the basics are set in, I'll just revise the basics again once. Known component, how you'll write, but the only challenge is this will take time. When you do a problem, this will take time. I feel it's okay to spend time on this chapter. That is one question, two question comes in exam. Wherever you have a confusion, it's better to take that time and then proceed ahead. I can give in any number of instances where you will think bid, answer will be asked. You will think ask, answer will be bid. There is no end to that. There is no end to that. So what you do, known component, whatever currency, unknown component, whatever is the currency. Known component, if you're writing 1 lakh GBP, what are you doing with GBP? Please write that in brackets. If you're writing unknown component, the other currency, if you're writing buy there, other one obviously has to be sell. Other one obviously has to be sell. Once you have written that, then you come to the expansion. What is expansion? Unknown component in the left hand side, known component in the right hand side, into you'll have to write something so that denominator and numerator gets cancelled and you get the other one which is there in the other side. Once that is done, you have to use a connecting. Okay, you'll have to decide what is the denominator currency. See the denominator currency. Go to KC UKC. That is known component and unknown component. See what have you written there. You would have written something in bracket. You would have written something in bracket. Use that here in the calculation. Use that here in the calculation. Don't try to apply mind at this stage, because there if you have written, your mind will not, because at that stage confusion levels are on the lesser side. Moment you expand the formula, you start looking into multiple numbers, your mind tells you something. Your mind tells you something which unfortunately 20-30% of the time is the wrong answer. Unfortunately, that becomes a wrong answer. So you write the denominator, then after writing that, expand the formula, close it. Any doubts on this? Any doubts on this? If this is understood, major chunk of Forex is over. Major chunk of Forex is over. I can keep adding on. I can keep adding on, which I'll now start doing it. Which I'll now start doing it. Let me see if I can do any basics question before I add on the extra concept. First is okay, second is okay, third is okay. All these are basics which I have. Fourth is okay. Let's do this. Question 6. Get me the answer for quantum of euro that you can buy if you have sum of 1,20,000. Euro alone. I don't want DKR calculation. Quantum of euro that you can buy if you have a sum of 1,20,000. Only the euro part calculation. You do it. After that, I'll expand the full calculation. If you are not able to get, please be honest. Let me know. I'll explain again. There's nothing wrong in not getting it, but at some stage you will pick it up. So if you're not getting, let me know. But only thing is, when you do, I don't want you to think certain things and then do it. Start. I didn't understand. Sorry. Only quantum of euro. I don't want the DKR answer. Quantum of euro that you can buy if you have sum of 1,20,000. Quantum of euro that you can buy if you have sum of 1,20,000. Euro that you can buy if you have sum of 1,20,000. I don't want the other answer. If there is some confusion going on your mind, please tell me now itself, because I want full clarity. If confusion is there, nothing wrong in telling it here rather than accumulating the confusion.
So that 72.25 and 72.35 is per euro we have to take as it is London market or GBP.
London means what? GBP, no friend. How can it be euro? No, I'm talking to someone in the live on. London has to be GBP, no?
Okay, but there is no GBP.
So no GBP means what should I do? You please. This is London Forex market, which means all these are related to GBP, and here this rate is.
Okay. Okay, sir. Okay.
You do it. I'll explain in some time. Please take your time. If there is any confusion there in your mind, please spell it out so that I clarify that. Don't keep thinking about it. If you're not clear about something, let me know now itself. If any confusion is there, please tell me now itself. It could be anything. I'm not going to judge you guys. So anything you tell, I'll get it clarified at least now. Request, don't look at the answer. Looking at the answer, everything will look very simple. If you keep looking at the answer and do it, nothing is going to happen. You can keep doing it. My first requirement is understanding what is this quote. So Japanese yen is a cheaper currency as compared to GBP. So everything is euro per GBP, DKR per GBP, Japanese yen per GBP, USD per GBP. Why per GBP? Because London Forex market. London Forex market. And the given below number is INR per GBP. The given below number is INR per GBP.
The 2056.67 euros.
Guys, I don't want the answer, please. I don't want any answer. So even live online, I don't want any answer. Physically also, I don't want any answer because I don't know the answer. So even if you tell me, it is of no use. I'll do the solution. You can check. If you made a mistake, then let me know. This should be the answer. Let me know if there are doubts. If there are doubts, please tell me. This answer will be right provided you did not try to say that I'm buying, I'll use ask rate. If you had not done that in your mind, you will get the right answer. That is why no preconceived notion will work. Are you getting it? No. Are you getting it or no? Let me know. You got the answer? No. Got clarity? Or still there is a clarity
Yes, sir.
missing? Done?
Yes, sir.
Full?
We got the answer.
Okay. Can we proceed? Any doubts? Anybody has any doubts on this? See, that's what. So there's a very lengthy explanation for 1-2 question I would have done. After some stage, I would have started doing, even in my printed solution. I cannot keep writing this, keep writing this. But again, I'm saying, when you write your known component, unknown component, that time itself, please write in bracket what you are doing. Because when I read this question for the first time, I thought I'll be using the ask rate. I'm being very honest to you. I thought I'll be using the ask rate. When I read the question for the first time, I thought it said buy. So my mind said I'll use the ask rate. When I did expansion, I find a surprise that I have to use bid rate. I find a surprise that I have to use the bid rate. This keeps happening. This keeps happening because your mind forces you to work in one manner. ICI only tackles that. They try to get certain questions around that. Can we proceed? Okay, I'll come to the next concept. Next concept is exchange margin. Next concept is exchange margin. Very simple concept. Rate is 80/82 per USD. Now they say there's an exchange margin. There's an exchange margin. 2-3 points for you. Exchange margin is applicable when one customer is dealing with a bank. There'll be a problem where a bank will deal with another bank. A bank will deal with another bank. In that, exchange margin will not come into picture. There are two types of rates. One is called interbank rate. Second is called merchant rate. This is interbank rate. 80/82 is called interbank rate. On top of this, you have to consider exchange margin and then do a transaction with the customer. So whenever you are transacting with the customer, a bank is transacting with the customer, exchange margin will come into picture. There will be few problems where one bank will deal with another bank. ICICI will deal with SBI, SBI will deal with ICICI. In such question, exchange margin cannot come into picture. Now, what is the role of exchange margin is, how much is the profit I make now? 2. Exchange margin will increase this profit. How can it increase? It will reduce 80 to 79. Let's just imagine, okay? And increase 82 to 83. Increase 82 to 83 and reduce the bid rate from 80 to what? 79. So in this process, what? Your profit now becomes 4 rupee. Earlier, what was the profit? 2 rupee. How do you do this? They'll give a percentage. Which is deducted from the bid rate and added to the ask rate. What is the implication of this? Your profit increases. Exchange margin is the extra profit for the bank. It is used to increase the spread. EM is deducted from bid rate, added to ask rate. Merchant rate versus interbank rate. Merchant rate is the rate for customer. Interbank rate is the rate for bank, plus or minus exchange margin. How should I apply exchange margin? If you do a problem and you expand the quote, no, INR per USD, USD per GBP into GBP, you should either apply it on the final exchange rate, which is after doing all the workings, or you should apply in only one quote. When you apply it in one quote, indirectly mathematics will ensure that it is getting applied on all the three. Mathematics ensures that it gets applied on all the three. So you will see INR per USD, USD per euro. What ICI does is calculates the final rate and applies it. Sometimes in some solution, they'll only do in INR per USD. Applying in one or applying in the end is same effect. Mathematically. So let's assume first quote is 1.25, second quote is 2, third quote is 3. Exchange margin is 2%. Let's assume exchange margin is 2%. What you did is you got this rate. Let's just say you multiplied all the three and added 2% on top of this. This is finally you did. One answer what you did is you directly did 2% only on this. Then you did multiplication. 1.275 into 2 into 3. You get same 7.65. Whether you apply it on the final rate. When you apply it on the final rate, student thinks, okay, I've applied on all the three, great. When you applied on one of the code, your mind thinks that I have not applied it on the second and third. Your mind forces you to think that you did not apply it on the second and third. If you apply on second as well as third, you are applying it 3 times. 3 times, which is, for example, I apply here, and now I do multiplication. 3 times banker will make extra profit. 7.95. 7.5 will go to 7.95. Is there a possibility that I apply on all the 3? Possibly yes. When? I'll explain later. But normally I'll apply only once. There are certain exceptions where I'll apply on all the 3. How do I apply? Why I am applying? I'll explain as we proceed. Any doubts till this step? Okay, now I come to cover rate. What is the concept of cover rate? Is I bought something. I bought $10 lakh. After I bought $10 lakh, suddenly market has become bad. So if you have bought it, now you need to sell it. So the rate at which you sell is technically called the cover rate. You sold something. And suddenly market has become volatile. So you thought, you let me buy it back. So opposite transaction is called cover transaction. Cover transaction refers to the opposite of original transaction. If a forex dealer has sold USD, cover transaction is buying back USD. US dollar. Rate at which the cover transaction is executed is called cover rate. Some question will not use the word cover rate. They'll use square up the position. Square up the position means they want you to do the opposite. Instead of using the word cover rate, they say please square up the position. Whenever a bank deals with other bank, all transaction will get executed at what? Interbank rate. All transactions will get executed at interbank rate. Now comes the most important part. In case of interbank dealing, one bank is dealing with another bank. I ask, what are you doing? What is the bank doing? Unfortunately, in an interbank dealing, both are bank. Because I ask, what are you doing? What is the bank doing? In an interbank dealing, ICICI is dealing with SBI. If ICICI initiates the transaction, ICICI is like a customer and the other bank is like a bank. Why this understanding is needed? To decide the bid and ask. I'll ask you, what are you doing? What is the bank doing? You will say both are bank. Doesn't help. So ICICI dealing with SBI. If ICICI initiates, ICICI is not the bank. Who is the bank now? Only SBI is the bank. Clear? Any doubts on this? Let's see this in a question now. Even this 2 MCQ will take care of it, but I don't want to do the MCQ. Let me do a proper problem. Go through 8. Okay, you sold Hong Kong dollar 1 crore value spot to your customer. You means a bank would have sold it to its customer. 1 crore at the rate of 5.7. So if you sold at the rate of 5.7, you would have got rupees 5.7 crore. I'm telling this very confidently, but some stage it will be 1 lakh divided by 5.7 also. It will be 1 crore divided by 5.7 also. In case there are doubts, known component, unknown component, expand formula, and then decide whether it's into 5.7. Wherever INR is there, I can tell with 99% confidence. Wherever INR is not there, I also will get confused. So I'll expand the formula and then give. Now what he is saying is he covered himself in the London market. London market. What did you do originally? Sell Hong Kong dollar. Now you have to buy. Now you have to buy Hong Kong dollar. Now you need to buy Hong Kong dollar. Opposite transaction. Let's write known component equal to 1 crore HKD. Known component equal to 1 crore Hong Kong dollar. Unknown component equal to question mark INR. Unknown component is question mark INR. We have originally sold to the customer. Now I plan to close this transaction. For closing this, I have to buy HKD. Which means I'll have to sell INR. Any doubts till this? What is the unknown component? INR is equal to HKD into INR per HKD. What are we doing with HKD? Look at the top. We are buying. The other bank will be selling. We are buying. We are bank only, but we are like a customer. We are buying. Other bank is going to sell. Other bank will sell at what rate? Ask rate. Other bank will sell at ask rate. Do you have INR per HKD? What's the connecting currency? INR per USD into USD per. See, only difference is if you are doing an interbank dealing, don't bring exchange margin into picture. Don't bring, and many question will not give also. Even if given also, I'll have to ignore. 1 crore into. Do you have INR per USD in the question? What is the ask rate? Do you have USD per HKD in the question? HKD per USD. Tell me one by bit. Please tell me this rate with maybe 5-6 decimal, because they have asked for the cover rate also separately. 4 decimal, sorry, 6 decimal. 6470. This 5.647074 is called cover rate. And I'll be getting 5 crore 64 lakh 70,740. 5 crore 64 lakh 70,740. This is the number I get, okay? Indirectly, to buy 1 crore Hong Kong dollar, I have to pay how much? 5 crore 64 lakh 70,740. And when I sold the Hong Kong dollar, I got how much? 5 crore 70 lakh. So look like I have made profit in this deal. Interpretation of quotes I've already explained. Most critical part. In the real world context, exchange rates for the Indian rupee against the US dollar is commonly denoted as USD-INR, with the USD preceding the hyphen. However, it's important to know that in exam question, the representation may switch to INR per USD. In such cases, it is generally acceptable to interpret them as INR per USD. Exception can happen. There can be some instances where the given quotes may seem illogical. In such situation, you'll have to analyze the quote, and during exam, you please write what you have interpreted. And accordingly do in the exams. Clear? Any doubts on this? Next comes swap points. What is swap points is, whenever I want to do a transaction today, I do the transaction using the spot rate. But some transaction I want to do it for a future rate. That's called a forward rate. Like you have a spot rate and a forward rate in futures. Like we had a spot price and futures price. Here we have a spot rate and forward rate. If we have to calculate the forward rate, there are ways to calculate it, which is IRPT, which we'll learn later. But instead of using the IRPT, the question itself will give you the forward rate. Now, this forward rate is given through something called a swap points. What is swap points is the difference between the spot rate and forward rate. If swap points are in ascending order, add them. If swap points are in descending order, what is ascending order? 11-13, descending order 13 slash hyphen, then please deduct it. Please deduct. Ascending order, add it, descending order, deducted. Ascending order, added, descending order, deducted. Some question what they did is they did this in one exam. They used the word swap premium. They used the word swap premium, but they gave descending order. But what is the word used? Swap premium. Premium means it will only increase. Premium means it will only increase. In one exam, they did this. They used the word swap premium, but they gave descending order. They gave descending order. Ascending order added, descending order deducted. No exception to this rule. But if they use the word swap premium, it means it is the premium. It is the premium. Premium can only be added. Example, let's look at spot rate. 66.5-90. So my spot rate is 66.50 hyphen 66.90. What is the swap points they mentioned? What is 140 and 120? Is the 140. 40 is the last two decimal. 40 is the last two decimal. Here we have two decimal code. Here we have two decimal code. So 140 will be understood as 1.40 hyphen 1.20. 1.40 hyphen 1.20, because we have two decimal. We have two decimal. If it was 66,500 and hyphen 66,900, 140 would have been interpreted as 0.140, 0.120. Last two decimal. Why last two decimal? Because we are working with two decimal code. We are working ascending order, descending order. Descending, deducted. Descending, deducted. So once I deduct it, I'll get 65.10, 65.70, 65.10 and 65.90. Any doubts on this? Any doubts on this concept? Ascending order, added, descending order, deducted. Then there can be something called a swap points for broken period. What is broken period is? They gave me 1 month. They gave me 3 months. Using interpolation technique, I can get 1.5 months, I can get 2 months, I can do 2.5 months, I can do 3 months. Interpolation technique. Using the interpolation technique, we can calculate any time period in between. We can calculate any time period in between using the concept of interpolation. Example, 1 month is 100 and 150. 3 months is 300 and 400, and I want it for what? 2.5 months. I want it for 2.5 months. So I put it in a timeline here, okay? 1 month, 100, 150. 3 month, 300. I want it for 2.5 months in between. I want it for 2.5 months in between. How do I get this? What is the gap in the time period? What is the gap in this? 1 month becoming 3 months is a gap of 2 months. 1 month becoming 3 months is a gap of 2 months. I want 1 month to become what? Only 2.5. I want 1 month to become only 2.5. Whereas 1 month has become 3 months. 1 month has become 3 months. Interpolation is a very, very important technique. In the statistics concepts, I have given multiple examples of interpolation. Very simple. Extra 2 months is equal to 2 months is equal to 200 and 250. Interpolation. 1.5 months is what is proportionate. What is proportionate? If 2 is equal to 200, 250, what is 1.5? Give me the proportionate number. 150 and 150 and 187.5. Add that to your 1 month swap point. Add that to your 1 month swap point. I have the 1 month swap point. I have the 3 month swap point. Anything in between you want, you can use interpolation technique. Anything in between you want, you can use interpolation technique and proceed ahead. Any doubts on this? Any doubts on this? So two important points. One is swap points can be in ascending order, can be in descending order. Ascending order added, descending order deducted. Ascending order added, descending order deducted. Second point what we learned is broken period. What is broken period? Is you gave me something else, in between suddenly I want. I can calculate 1 month 1 day, 1 month 2 day, 1 month 3 day, 1 month 5 days, 1 month 10 days, 1 month 15 day. Anything can be calculated. Anything can be. Assume they ask you for 2 months. Then it's very simple. Average of 1 and 3. Average of 1 and 3. But otherwise you'll have to use the interpolation technique. Otherwise you have to use interpolation technique. Proceed. I'll go to the second concept, which is called premium or discount appreciation or depreciation. It's again a very simple concept. I'll first explain with one example and then I get into one or two problems on that. Now listen. I went to the market. I asked what is the price. He said Coke is 25 rupees. When did I ask? Year 0. Okay. I again went to the market after 3 months. I asked what is the price of the Coke. He said price of the Coke is 30. He said price of the Coke is 30. Can you tell me what is the percentage increase in price? 20% for 3 months. 20% for 3 months, which is technically 80% for a year. Any doubts on this? So the given quote was rupees 25 per Coke, and the next one is rupees 30 per Coke. Tell me what formula did you use? You tell me the formula. How did you get 20%? 30 minus 25 divided by 25. You got that number. I told we'll do the annual rate. So you would have done into 12 by 3 into 100. This is the formula for the product currency. This is the formula for product. Why product? Coke is the product. What is the formula? Forward rate. Forward rate is 30 minus spot rate divided by spot rate into 12 by m into 100. Forward rate minus spot rate divided by spot rate into 12 by m into 100. Here Coke has appreciated by 80%. Coke has appreciated by 80%. Coke appreciating by 80% does not mean rupee is going down by 80%. Does not mean rupee is going down by 80%. Then what does it mean? You will understand. It does not mean rupee is going down by 80%. Let's take the same example. I asked you the rate. You told me the rate is spot rate rupees 25 per Coke. Can you tell me 1 by 25 is how much? Let's assume for the time being Coke is the currency. Anything you want to buy in the market, you'll give Coke and get the other product. You'll get the Coke and get the other product. So I went to the market. I wanted to buy a product called INR. I asked you what is the rate for INR. He says give me 0.04 Coke. Give me 0.04 Coke. You will get the INR. What is the forward rate in my example? Rupees 30 per Coke or 0. Okay. So there was something in the market which had a price of 4 paise. Now the rate is 3.333 paise. Now the rate is 3.33. Like you have a price for Coke. Now the price for INR is earlier 0.04. Now it is 0.03. Price has gone down or gone up? Just look at 0.04 and 0.03. Don't look at 25 and 30. Don't look at 25 and 30. It has gone down. Let's apply the formula. Forward rate 0.0333. This is NAV1. This is NAV0. 0.0333 minus 0.04 divided by 0.04 into 12 by 3 into 100. Are you getting 80%? Did you get first a negative answer? How much negative you got? This means if Coke appreciates by 80%, INR depreciates by only 67%. INR depreciates only by 67%. So some question will say USD appreciated by 10%. Students think INR has depreciated by USD appreciated by 10. So they say INR has depreciated by 10. Both percentages cannot be same. I see a few questions have done that. Those are wrong answer. I cannot explain those things. Okay. If USD appreciates by 10%, INR does not depreciate by 10%. Any doubts on this? Okay. How do I calculate the 66.68 without doing all this? Very simple. You did 30 minus 25. No. Now do 25 minus 30. Opposite. 25 minus what denominator you were using earlier? Use 30. Wherever 25 is there, use 30. Wherever 30 is there, use 25. Wherever 25 is there, use 30. Wherever 30 is there, use 25. 25 minus 30 divide by 30 into 12 by 3 into 100. What answer you get? Did you get negative answer first? Negative, how much you got? So this gives me my two formulae. This gives me my two formulae. I don't remember the formulae. Don't ask me that. Should I remember the formula? Understand the logic alone. If I want to calculate percentage appreciation or depreciation in the quote, whatever is the product currency, I initially started with price currency and product currency. Whichever is the product currency, formula is NAV1 minus NAV0 divided by NAV0 into 12 by 3 into 100. What is NAV1? Closing rate. What is NAV0? Today's rate. Forward minus spot by spot into 12 by M into 100. If you want to do it for price currency, two options are there. One, you can convert the quote 1 by 25, 1 by 30 and then apply the same formula. You don't want to do that, then the simple formula is spot minus forward by forward. Wherever forward is there, use spot. Wherever spot is there, use forward. Spot minus forward by forward into 12 by M into 100. Any doubts on this? Any doubts on this? Now, this calculation I can do separately for bid rate, separately for ask rate, together for average rate. You can do it in different ways. You can do it for bid rate separately, you can do it for ask rate separately, or in your denominator. Some question will say in the denominator don't use spot rate or forward rate. Use the average of spot and forward rate. Use the average of spot and forward rate. The question can tell you to do anything. The question can tell you to do anything. It can be, but I will get one answer using bid rate, another answer using ask rate. This is for US dollar. Then again repeat one answer for using bid rate, one answer using ask rate for the other currency. For the other currency, appreciation depreciation percentage for average rate. For average rate, if you want to do it for average rate, then average is average of spot and forward. Average of spot and forward. You will do for bid separately, ask separately. It's not middle rate, it is average rate. Average means in the denominator. In the denominator, you will have to use average of spot and forward rate. Came once in one exam. Can you please go through this question and tell me for INR? Please go through this and tell me for INR. Is INR price currency, product currency? Price currency. Apply the formula for price currency. Apply the formula of price currency. With the MCQ itself, the concept is over. Apply the formula of price currency. See, if you want, you can do the quote conversion and apply. See, I can, moment I convert a quote, a price currency becomes a product currency becomes a price currency. Only challenge is rounding off. Only challenge is rounding off. So our normal formula is forward minus spot by spot into 12 by M into 100. Is this a formula I want you to remember? No. NAV1 minus NAV0. What is NAV1? Closing, forward. NAV0, opening, spot. Divided by NAV0, spot, into 12 by M into 100. Just reverse the formula. What is the spot rate here? 50 minus 52 divided by 52 into 12 by 3 into 100. If you get negative answer, it is depreciation. If you get positive answer, it is appreciation. No need to even think much about it. Okay, negative depreciation, positive appreciation. What's the answer you get? Depreciation of 15.4. Now why I'm explaining this is why I don't want to apply whether it's appreciation or depreciation, because some students, they see 50, they see 52, they say okay, price has increased, it's appreciation. They see 50 and they see 52 and their mind forces them to say that it is appreciation. I don't want to get into any of your logical thinking there. Please apply formula. Negative answer indicates depreciation, positive answer indicates appreciation. Can you please get this for INR bid rate? For INR bid rate, INR price currency, product currency, you see and then apply it. INR bid rate, only for the bid rate I want. See, last question had only one code. So now you have two codes. That is why I'm giving you this example. My first question, INR price currency, product currency. Price currency, what is the formula for price currency? SR minus FR by FR into 12 by, how many months is this? 3 into 100. What is the spot bid rate? Forward divided by into 12 by 3 into 100. What's the answer you get? 1.23 appreciation. 1.23 appreciation. Can I convert the quote and do? You will get the same answer. Again, I'm repeating. That is why I gave you that example of Coke. You will get the same answer even if you convert the quote and do it. Only thing is rounding off will come into picture. Moment you do 1 divided by this, your rounding off will come into picture. Can I proceed? We'll come to it as we proceed. So if I tell you the difficult part initially, you will see as we proceed. Okay, read this and let me know what is the answer. All these are technically one question. Okay, every concept is picked from there only. There are a lot of concepts which are there in this. You'll understand when I come to the explanation part. It may look very simple, but multiple concepts will get tested in this. MCQs, please participate. I want you to do it. If you're not even doing MCQ, then I don't know. I cannot help it. I don't know. What is the spot rate? N 3.6 per INR. Amount is equivalent to 10 lakh. It's anticipated that it will change by 10%. Now changes, is it increase, decrease? I don't know. Is it increase or decrease? I don't know. Only thing I've said is change by 10%. Indian company promises to take appropriate in order to protect yen payments. In order to protect yen payments. That is, I have to make yen payment. I have to make yen payment. See, now understand. Today, Japanese yen 36 lakh is equal to 10 lakh. Today, Japanese yen 36 lakh is equal to 10 lakh. I will be having a problem if this 36 lakh becomes more than 10 lakh. I will have a problem if this 36 lakh become more than 10 lakh. I will have a problem. In short, I will have a problem if yen appreciates. If yen appreciate, why yen appreciates is a problem? My liability is in yen. My liability is in yen. I don't want my liability to appreciate. I don't want my liability to appreciate. Yen appreciation or INR depreciation is a problem. Yen appreciation or INR depreciation is a problem. Very good problem. Lot of concepts are tested in this. I have a problem if my liability appreciates. I have a problem if my liability appreciates. In this case, which scenario is liability appreciation? That's the exchange rate. That's the exchange rate. Which scenario is the liability appreciation? 3.24 or 3.96?
3.96.
3.24, sir.
It's 3.24. It's 3.24 because it is division. It's not multiplication. It is division. That is 36 lakh divided by 3.24 is what? That is problem. That is a problem. 36 lakh divided by 3.96. That's not a problem. If that is happening, I will not do anything. Okay, I'll be very happy. I'll not do anything. Why should I go to forward market? Why should I go to forward market if 36 lakh is going to be divided by 3.96? 96. Why should I even visit the forward market? Why should I even visit the forward market? The problem is if it becomes 3.24. Exchange rate will change by 10%. An Indian importer will be worried about depreciation of INR. Why depreciation of INR is a problem? Depreciation of INR means yen is appreciating. Yen is appreciating. Hence, exchange rate of 10% will be interpreted as depreciation of INR. New exchange rate is minus 10%. New exchange rate is minus 10%. This tests my next concept. I should have added it in the next area, but this tests my next concept. Any doubts on this? Any doubts on the understanding? Okay, comes to the next concept, appreciation or depreciation percentage, direct application of product currency. What is direct application of product currencies? Question will give you an exchange rate. Understand this, very, very critical. And few places ICI makes an error in this. I cannot help all that, so let me not get into that part of it. 90% of the questions they do it right. Question says spot rate rupees 40 per dollar, and it says INR appreciates by 5%. INR appreciates by 5%. I want to calculate the forward rate. Now 40 per USD, which is the price currency, which is the product currency here? INR is price, USD is product, and I said INR appreciates by 5%. If INR is appreciating by 5%, I want the INR to be the product currency. I want INR to be the product currency. How do I do? 1 by 40 is how much? USD 0.025 per INR. Now I said INR appreciates by 5%. Add 5% to this. Add 5% to this. It has to be applied only to product currency. It has to be applied only to product currency. Add 5% and then reconvert. Add 5% and then reconvert. Add 5% and then what is the addition of 5%? No, adding 5%, what do you get? 0, 2, 6, and now convert again. 38 point. What ICI does few times, which may not make a big difference, but it's a difference still. It's a difference. They say INR appreciated by 5%. So let's take it as USD depreciated by 5%. Let's take it as USD depreciated by 5%. 40 minus 5%, 38 is the answer. 40 minus 5%, 38 is the answer. If you want accurate answer, this is the right approach. This is the right approach. Now I cannot tell you suddenly in few questions they do it. That's an error. Error, I cannot give a logic to it. Error, I cannot give a logic because I cannot tell this time they'll make an error, this time they'll do a right answer. Rule is very simple. You see this example and then give me the answer. The given rate is 2 per GBP. Now this example may look very simple to you now. After at home when you start practicing this, no, because I have not explained the concept. I've just explained the concept. When you do together, no, somewhere at the back of your mind that concept gets erased. You are not able to think through in that situation. In this case, USD has appreciated by 10%. I want USD to be the product currency. I want USD to be the product currency. So what I do, GBP 0.5 per, apply the exchange, apply the change. After application of change, what happens? GBP, please reconvert now. 1.82. In this, I can add a variant. What is a variant? Question asked what? 6 month forward rate. I can say USD has appreciated by 10% per annum if I want. If I want, I can say USD has appreciated by 10% per annum. We are calculating what? 6 months. So you have to take 6 months appreciation rather than the annual appreciation. Rather than taking the annual appreciation, you should take the 6 month appreciation. Question here did not say, because some students have asked me this. It said appreciated by 10%. Why are you not doing 5%? I will do 5% if you use the word per annum. They confuse with interest rate, because interest rate is normally for a year. Interest rate is normally for a year. Appreciation, depreciation need not be for a year. Need not. I'm not saying it cannot be, but it is not mandatory. It is not mandatory that it has to be for a year. Any doubts on this? Any doubts on the concept? Give me the answer to this. Okay, I think whatever I tested is there in this. So whatever I explained is there in this MCQ. Do it now. Please do it. I want you to do the questions. My sincere request. If you have not understood anything, please let me know. I'll explain again. Don't be here to audit my solution. I want you to account, solve, and then check. Zero point. Okay. They've given on which currency? Euro. They've given on euro. So first I'll have to convert the quote. I'll have to convert the quote. What is the converted quote? 1.2490. Okay, 91 per euro. 2491 per euro. How much is the forward discount? 4% per year. No use. I need to use 2%. I need to use 2%. So please subtract 2%. You get an answer. Take inverse of that. Take inverse of that. Any doubts on this? Any doubts on this? So that the answer is 0.8169. 0.8169. Appreciation percentage of one currency. This is not needed to solve the question and all. Appreciation percentage of one currency will always be higher than the depreciation percentage of the other currency. That is when you do your calculation. I gave you that Coke example. Coke appreciated by 80%. INR depreciated by 66.67%, and this is because you use different denominator for price currency and different denominator for product currency. Is this going to be useful in any solving? No. This is just for a concept. This is just to give you a concept. I have just added this. Doesn't really matter. Okay. This doesn't really matter. Okay. One exam asks something called as real appreciation and real depreciation. Let me explain what is real appreciation and real depreciation. Real appreciation and depreciation is basically removing the effect of inflation. Removing the effect of inflation, because real means without inflation. Real means without inflation. So this formula you saw where? Capital budgeting. 1 plus money discount rate is equal to 1 plus inflation rate into 1 plus real rate. A question can ask for computing real appreciation or depreciation of a currency. Real appreciation or depreciation of a currency. If you are asking real appreciation or real depreciation, you cannot use the exchange rate as it is. Normal appreciation, depreciation, use the exchange rate as it is. Price forward minus spot, spot minus forward, whatever formula you want to do. So what I need to do is, whatever rates are given, I have to first adjust for the inflation. I have to adjust for the inflation. You can go through the working and all later at home. I'll have to adjust this for the inflation. After adjusting for the inflation, you'll have to use the formula. After adjusting for the inflation, then you have to use the formula that you apply. That will give you real appreciation or depreciation. How do I adjust for the inflation? I have to give effect to this 5 and 9. I have to give effect to this 5 and 9. How do I give effect to this 5 and 9? Using something called as purchasing power parity theory, which I'll explain in some time. I'll be explaining purchasing power parity theory in some time. You can see this example later on at home, moment I do purchasing power parity theory. But only thing is, if there is a real appreciation or depreciation, you cannot use the normal exchange rate. You cannot use the normal exchange rate. You will have to adjust the inflation. You will have to adjust the inflation. Okay, next comes our IRPT. Next comes the IRPT. IRPT is very simple. Before I come to the formula, I'll explain simple logic. Okay, today I invested USD 100 in USA. Today I invested USD 100 in USA, which is equal to INR 5000, which means exchange rate is rupees 50. Which means exchange rate is rupees 50. In India, I get 10% risk-free rate. In India, I get 10% risk-free rate. This becomes INR 5500 if you invest in India. If you invest in India without risk, In USA, the interest rate is only 2%. In USA, the interest rate is only 2%. So this will become USD If USD 102 is INR 5500, tell me what should be the exchange rate? If USD 102 is INR 5500, what should be the exchange rate? 53.92. If this happens, there is a parity. If this happens, there is a parity. If this does not happen, parity does not exist in the market. Parity does not exist in the market. If parity does not exist, this will lead to arbitrage. If parity does not exist, it will lead to what? Arbitrage. It will lead to arbitrage. Clear? Any doubts till this? Now, how do I get this in a formula? 1 plus RH divided by 1 plus RF is equal to F1 by E0. My sincere request, RH does not mean Indian currency. RH means home currency. And what is home currency here is the first currency in the quote. The first currency in the quote. You will be doing this along with somewhere in international capital budgeting. When you do along with international capital budgeting also, my first currency for IRPT alone, first currency is home currency, second currency is foreign currency. Now, what is the problem? The problem is student will see a quote like this. He is adamant saying that I will take INR only as home currency. He is adamant saying that INR is my home currency. Why are you telling USD is my home currency? I cannot help there. I cannot help there. Again, I am repeating. For me, home currency is what? Whichever is the first currency in the quote. Whichever is the first currency in the quote for IRPT. For IRPT, whether you are in India, whether you are in USA, I am least bothered in knowing that. I am least bothered in knowing that. I am telling this. After 3-4 days, you will solve a problem and you will make a mistake. You will make a mistake. Again, I am repeating. First currency only is home currency. First currency is only home currency. Second currency is foreign currency. Whichever be the quote. If INR is not there, confusion doesn't come. Because moment you see INR, you want INR only to be the home currency. I cannot help it. So, let's take this 50. Yeah, patriotism is not needed in this. I don't want your patriotism coming here. So, this is USD 102. Let me see how do I get it with the formula. The quote today is INR 50 per USD. INR is the home currency. USD is the foreign currency. INR is the home currency. USD is the foreign currency. So, how do I apply the formula? What is the risk-free rate of India? 1 plus 10%. What is the risk-free rate of USA? RF is equal to F1, which is the forward rate, divided by E0, 50. Apply the formula, you will get F1. Apply the formula, you will get F1. What's the answer you get? 53.91. That is what I told. 102 is equal to 5,000, which is easy. But the exam should have all these numbers. No, you will have to assume certain random numbers and then do it. So why do you want to get into this? See, I can explain the logic of the formula. If I get into doubt, I only think like this and then sort out my doubt. But otherwise, your wish, whatever way you do. Now, one important factor is you did 1 year calculation. Question will ask 6-month forward rate. Question will ask 6-month forward rate. If you are doing 6-month forward rate, you need to use 6-month interest rate. You need to use 6-month interest rate. What is 6-month interest rate? 10% divided by 2. 10% divided by 2 and 2% divided by 2. Clear? Any doubts on this? After 4-5 classes, when you do at home, you will again make a mistake in this. You will again make a mistake. Yeah, tell me.
Sir, sorry sir, again I'm asking this. This you said no that parity is not there. How you said that parity is not there? Said that 5,500 or not that concept I didn't understand.
No. If it does not happen, parity is not there. Ignore that wording. Please ignore that wording. For the time being, let's not get into that. Okay, let's come to this. Okay, let's come to this example. If you are able to do this example, all my questions are done technically. All my questions are technically done. Again, I'm repeating this chapter. If you solve the MCQs properly, what is solving properly? Not looking at the answer. You start looking at the answer, that's not properly solving. Because moment your, unfortunately, answer is next to the question, you want to audit whether this faculty has done it correctly or not. So let me check whether he's doing it correctly or not. I don't want you to do that. I would have made mistakes. You can highlight that later, but first you'll have to do the question. Let's write. Write. Please write along with me. Spot rate is equal to rupees 50 per USD. Spot rate is equal to rupees 50 per USD. Rupees 50 per USD. Guys, please. Rupees 50 per USD. Which is the home currency? INR. RH is equal to, what is the interest rate in India? 12% per annum or 12% per annum. We are doing calculation for what? Now it said 6-month interest rate in India does not mean this is a 6-month rate. This is the per annum rate only. Some exception. What is exception is they say 6-month interest rate in India 4%. You know what happens in India's interest rate. If they say 4%, you can understand that to be 4% directly for 6 months. You can understand somewhere some practical understanding. Some practical understanding is needed. 12% cannot be for 6 months. 12% can only be for a year. So 12% per annum or 6% per 6 month. Please write along with me. RH is equal to 12% per annum or 6% per 6 month. RF is equal to what? 4% per annum or 2% per 6 month. 2% per 6 month. What formula we have? 1 plus RH divided by 1 plus RF is equal to F1 by E0. F1 by E0. What is the RH? 6%. RF equal to F1 50. Get the answer to F1. 51 point. Can you please? Okay, let me explain and then you start doing it. Question is asking forward rate of year 2. So formula is listen, 1 plus RH by 1 plus RF equal to F1 by E0. F1 is first year rate. Then F2 by F1 will give you the second year rate. F2 by F1 will give you the second year rate. First you will have to calculate the first year rate. Then apply F2 divided by F1. Same formula. Same formula. Start doing it. Understand correctly which is home currency, which is foreign currency, and then start doing it. Which is the home currency? USD. USD is the home currency. So 1 plus 5% divided by 1 plus 10% is equal to F1 by 1.4. F1 by 1.4. What's the answer you get? F1. 1.27. Then I repeat again. That will give me. Okay, whatever is the answer. F1 I wanted, and then from F1 I wanted to move to F2. From F1 I wanted, and then F2. Any doubts in this? The concept should be clear. The concept should be clear. Can we proceed? Clear? I've done from F. I did not go direct. I've done power 2. Power 2 directly gives the second year rate. But you can move to F1, and from F1 you can move to second year. IRPT link with interest rate. Understand this very clearly. IRPT link with interest rate. Concept is USA has lower interest rate as compared to Indian interest rate. India is at, understand this is India, USA, you'll find it very easy to understand. India 10%, USA 3%. As long as this gap exists, you will see dollar which is at 80. When I was studying Forex, that time it used to be around 55, 60. Now it has reached 80. It will become 85, 90, 95, 100, 105, 110. It will keep going up. It will keep going up as long as this gap exists. If you have higher interest rate, your currency will keep depreciating. So as long as you have higher interest rate, currency will keep depreciating. So a currency will depreciate if the interest rate in the country is higher, and a currency will appreciate if the interest rate in the country is lower. Why should it happen? In USA, I get 2% return. In India, I get 10% return. So if you get 10% return, Indian currency will depreciate, and when you convert into USA, 10 will become 2. 10 will become 2. That is, in India, you are generating 10% return. In USA, you are generating 2% return. I wanted to use the formula, convert the Indian return into USD return or USD return into Indian return. What is the formula? 1 plus home currency return is equal to 1 plus foreign currency return into 1 plus appreciation or depreciation of the foreign currency. So if you invest in India, a US guy is investing in India, generating very good return, The problem is INR has depreciated. My assets have depreciated. My return goes down. So whether you invest directly in India or you invest in USA and bring it back, both will almost give similar return. Because of the difference in interest rate. Now, a question will ask, what is the implied differential in interest rate? What is implied differential in interest rate is, they have not given any interest rate in the question, but they're asking what is the implied difference. That is nothing but the appreciation or depreciation of the currency. That is nothing but appreciation or depreciation of the currency. For example, in this question, can you use this 51.96 and 50 and tell me the appreciation or depreciation percentage? You do it for dollar. Do it for dollar. 51.96 forward minus spot by spot into 12 by M into 100. Into 12 by M. Please do 12 by M also. Please do 12 by M in the calculation. 7.84, which is approximately the gap in the interest rates of the two countries. And this is why our currency keeps depreciating. Our currency will keep depreciating till this gap is eliminated. Indian currency will keep depreciating against the foreign currency. This will never change as long as India has higher interest as compared to USA. Any doubts on this? What is the implication of this? Read this example and then tell me which answer is right according to you. One of them is right, okay? Ignore the point D, it's not point D. One of them is right. Which currency is depreciating? If USD is depreciating, interest in USA is higher. Which option is that? See, interest rates in Germany is 2.5% lower than that of USA. Any doubts on this? The same thing can be extended, called as purchasing power parity theory. Like you have interest rate parity theory, we have purchasing power parity theory. What we do in purchasing power parity theory, instead of using interest rate, you use inflation. 1 plus IH. IH is inflation of home country divided by inflation of foreign country. And here also, first currency is home currency, second currency is foreign currency. First, second rule remains same. Don't change those rules. Any doubts on this? Okay, let me quickly go through what we did in the first session on your Forex part. In the Forex basics, we learned that there are two types of currency, a price currency and a product currency. Price is the first currency, product is the second currency in the quote. A direct quote is one where home currency comes first, foreign currency comes second. Indirect quote is where foreign currency comes first and home currency comes second. A direct can be converted into indirect quote as 1 divided by indirect is direct, 1 divided by indirect is indirect, inverse of each other. In a two-way quote, bid will be before and ask will be later. Average of the two rates is called middle rates. Ask rate has to be always higher than the bid rate because banker will always want to make profit, and the difference between the two rates is called spread rate. This spread can be converted into percentage. How you convert? You can do it as a percentage of bid rate or you can do it as a percentage of ask rate. Pips refers to the number which comes after the decimal. So in a two-way quote, if the number before the decimal is same, when I'm giving a two-way quote, I will not repeat the number before the decimal. And in fact, if the number after the decimal is also same, then I may not repeat that in the pips portion. I may not repeat that in the pips portion. Direct to indirect, if you want a bit direct quote, you will have to do 1 by ask. And if you want a ask direct quote, you will have to do 1 by bid. Return in foreign currency, if you want to calculate, 1 plus home currency return is equal to 1 plus foreign currency return into 1 plus appreciation or minus depreciation of the foreign currency, In case a question gives you two-way quote, we had one problem where we were investing in the US market. We had to divide by the exchange rate, get the US figure, do the calculation, and then bring it back to the Indian figure and then do the computation. These are commonly used currencies which can help you in doing the interpretation of the quotes. Cross rates is a process of doing cross multiplication, which is very simple. A by C is equal to A by B into B by C. How do I solve my basic problem? Find out the known component, unknown component, understand what you are doing in the known component, what you are doing in the unknown component, write them. Then you will say unknown component is equal to known component into something. See what's the denominator currency, what are you doing, what the bank is doing, decide the exchange rate, and then proceed with the calculation by expanding the formula. Exchange margin is basically an extra profit for the bank. It is deducted from the bid rate, added to the ask rate. You have two choices, apply it on the final quote or apply it only in one quote and then proceed ahead. Certain exceptions are there, I'll explain. And in case it mentions that it is some paise, then you can only apply it on the INR quote, which you can either do it at the beginning or do it at the end. I see I've had one problem where they applied it at the end. Now, when you apply this exchange margin, one question said exchange margin on buying rate and selling rate. I did not explain this that time because it will become too many concepts. Now, exchange rate on buying rate and selling rate can be understood as exchange rate on bankers buying rate and bankers selling rate, or I can understand it as my buying rate and my selling rate, because it can be interpreted either ways. Question only said exchange margin on buying rate and selling rate. What ICAI solution has done, they have understood this to be bankers buying rate and bankers selling rate. That is what ICAI has done. So if exam question says exchange margin on buying rate and selling rate, buying rate is bankers buying rate, which is bid rate, and selling rate is bankers selling rate, which is ask rate. Exchange margin, should I do it on direct quote or indirect quote? Now this is a slightly tricky part. What is tricky part is, let's understand. I have a bid rate 46-48. Now I want to apply 0.5% exchange margin. So 46 into 99.5%, which is 45.77. I subtracted and I added here. Assume I want to do the other rate, that is 1 by 48 and 1 by 46. Now you can apply the exchange margin before doing the conversion. You can also apply the exchange margin after doing the conversion. Both will lead to small variation in answer. Both will lead to small variation in answer. That is, if you apply 1 by 48 and 1 by 46, and now you apply the exchange margin and do reconversion. Now you apply the exchange margin and do reconversion, you may not get exactly the same answer. So exchange margin to be taken on direct quote or indirect quote. Sometimes the direct quote might not be readily available. We resort to using 1 by ask rate to derive the bid rate, 1 by bid rate. In such a situation, exchange margin can occur either before conversion or after conversion. There has been inconsistency in the application resulting in slight variation, because you may apply it before, you may apply it later on. Also remember that we should always add the exchange margin to the ask rate and subtract the exchange margin from the bid rate. Now what is the implication of this? For example, you are calculating bid as 1 by ask. Bid as 1 by ask. In the denominator, it is the ask rate. In the denominator, it is the ask rate. So you are calculating the bid rate. So you are calculating the bid rate. What is denominator? 1 by ask rate. For the ask rate, you need to only add the exchange margin. What we are calculating? I am calculating the bid rate. I am calculating the bid rate. What is the formula? Bid rate is equal to 1 by ask rate. If your denominator is ask rate and you want to apply exchange margin, exchange margin in the denominator, you cannot say this is my bid rate calculation, I want to subtract. It will not work that way. It will not work that way, because if you do it that way, you will give benefit to the company. You will end up giving benefit to the company. For example, if you are computing the ask rate as 1 by bid rate, in ask rate, what you do with the exchange margin? Add. But if you're doing 1 by bid rate, it should be deducted from the bid rate for the denominator currency. Deducted from the bid rate for the denominator currency. What is the implication? Let's understand. 10 is the rate, okay? 10 is the rate. Now, 8 comma 10 is the rate. I want to apply the exchange margin. What I did is I wanted to calculate the bid rate. So I did 1 by 10. Now question said about some exchange margin. You wanted to apply the exchange margin. In bid rate, what you do normally? Deduct. Now if in the denominator 10, if you deduct no, it will be beneficial for them. So what you need to do is in the denominator, what you have is the ask rate. So for the ask rate, 10 plus something you have to do. 10 plus something. If you end up doing 9.8, then you will end up getting a higher bid rate. 1 by 10 would have given you 0.1. By applying exchange margin, now it's giving 0.102, which is wrong. By applying exchange margin, it is giving 0.102, which is wrong. Then what should I do? In the denominator, 10 can become 10.2. To cut it short, that is, you can apply before conversion, after conversion. I told you two reasons. So if you are applying in the denominator, please be little cautious. In short, if the denominator is the ask rate, please use the rules of the ask rate. If the denominator is the bid rate, please use the rules of the bid rate. Don't try to get into saying that no, I'm calculating bid rate, so I'm subtracting, or I'm calculating ask rate, so I'm adding. That will not work. You'll understand implication of this in the arbitrage part. Cover rate is basically an opposite rate to square up my transaction. Whenever a banker deals with some other banker, all transaction will get executed at interbank rates, and the initiating bank is the customer, the other bank is the banker for identifying the bid rate and ask rate. Likely rate of one currency against another currency. I did not discuss this, but one exam asked, what is the likely rate of yen against US dollar? Now, if you go to the market and ask, what is the likely rate of Apple? What will the answer be? Rupee per apple or apple per rupee? Rupee per apple. If you ask likely rate of Apple, they'll give you rupee per apple. Similarly, if they ask you likely rate of yen, you have to give me USD per yen and not yen per USD. You have to give me USD per yen and not yen per USD, because when I read likely rate of yen against USD, I thought I have to calculate yen per USD. That is why I keep relating to an example, that is likely rate of Apple. Wherever I do, I started with Coke example. So I relate to a real product and then do it. You will be able to appreciate the discussion. Interpretation of quotes, most critical part. Why it is most critical is sometimes ICI follows the exact international convention. Many times they don't follow it. So before going ahead solving the question, see whether practically what should be the interpretation. Use that and then proceed ahead to solve the question. Swap points are basically the difference between your forward rate and spot rate. If the swap points are in ascending order, add it. Descending order, deduct it. If they use the word swap premium, it means it has to be added only, whether it is ascending order or descending order. If you have to calculate swap points for broken period, you will have to use the concept of interpolation and then keep calculating whichever period you want to. Appreciation or depreciation calculation for the product NAV1 minus NAV0 by NAV0 into 12 by M into 100. For the price currency, exact opposite. If the question gives you some appreciation percentage and you want to apply it on the quote, you can apply it, but ensure that that is the product currency. This may involve sometimes you have to convert the quote, apply and reconvert the quote. That's a slightly longer process, but you will have to do it. Appreciation percentage of one currency will always be greater than the depreciation percentage of other currency. Real appreciation or real depreciation is there will be certain exchange rates given. You normally use FR minus SR by SR to calculate. If this FR will have to be adjusted using the concept of inflation, and then you apply the formula. Interest rate parity theory can be used to compute your future exchange rate. Only rule is the first currency is home currency, second currency is foreign currency. In this type of problem, INR can become foreign currency. If the interest rates given in the question is for 1 year and you're calculating 3 months, please calculate 3-month interest rate. If you want 6 months, please calculate 6-month interest rate. There is a linkage with interest rate. IRPT is saying whichever country is having higher interest rate, the currency of that country will depreciate. Implied difference in interest rate can be understood appreciation or depreciation of the currency of that country. Law of one price, same thing, 1 plus IH divided by 1 plus IF is equal to F1 by E0. Now we are moving to arbitrage. Your material has, I think, 3-4 types of arbitrage. One is space arbitrage, there's time arbitrage, and I think there's something called as a triangular arbitrage. Space arbitrage is very simple. I will buy in one market, sell in other market and make profit. Buy in one market, sell in other market and make profit. Very simple example. A pen is available at the following markets. Market A price is 9-10. What is 9? Shopkeeper purchase price is 9 and he will sell to you at 10. Market B 10-11. Market C 11-12. If you wanted to buy pen, which market will you buy? At what price? 10. Which market will you sell? C. At what price? You will make 1 rupee profit. This is called arbitrage. You will make 1 rupee profit. This is called arbitrage. Let me change. It is bank A, bank B, bank C. Rupees 9-10 per USD, 10-11 per USD, 11-12 per USD. So what I'll do, I'll buy the USD at the rate of 10 and sell it at the rate of 11. Buy it at the rate of 10 and sell it at the rate of 11. Tell me in this case, INR per USD in bank A is this much, bank B is this much. How much is the arbitrage gain if you have $1 lakh? If you have $1 lakh, you have $1 lakh with me. Tell me, where do you want to sell this $1 lakh? In bank B. When you sell it in bank B, you will sell it at what rate? 68.4. You'll be able to sell this at 68.4. You have the money with you now. You want to go ahead and buy again $1 lakh. You want to go and buy $1 lakh. From where will you buy? At what rate? In this process, you will earn 1 lakh rupee. In this process, you will earn 1 lakh rupee. This is called space arbitrage. Now, what can happen is the quote may not be INR per USD, INR per USD. The quote can be JPY per USD at one place and USD per JPY at other place. JPY per USD at one place and USD per JPY at another place. You need not do much about it. You need to just convert one of them. You need to just convert one of them. Which currency I have with me? USD 1000. So I'll ensure USD is the product currency. USD is the product currency. Can you convert this quote and give me the rate? USD per JPY convert. Convert to JPY per USD. Triple 1.11 and 107.53. I have $1,000 with me. I have $1,000 with me. I use this $1,000 and sell it. I have this $1,000 and sell it. In which market do you want to sell? Second market. So 1000 into what you get? How much JPY you have now? 1,07,530. This much JPY I have. Any doubts in this? Now what I do is I want to sell this JPY. I want to sell this JPY. I will go to the other market and then do the process of sale. And in the end, I started with $1,000, but I'll end with more than 1000. I'll end with more than 1000. If that is happening, I started with 1000. I got 107.53. I used the 107.53, sold it. I got 1009.67. I'm ending with a gain of how much? 9.67. This is an exam question. This is an exam question or an RTP question. So I'm done with space arbitrage. I'm done with space arbitrage. One situation where they have given INR per USD, they have given INR per USD. Very simple for you to analyze. If they give it differently, you will have to do the job of conversion. I'll show you the question which was there. This is a question on space arbitrage where rate was 1.2816, rate was 1.2806. Buy at 1.2806, sell at 1.2816 and make the profit. In this question, 105, 106, 0.0090, 0.0093. Is there any possibility of arbitrage? You can start with JPY 1 lakh or US dollar 10, US dollar 1000. So you work with US dollar 1000, you do your calculation. JPY 1 lakh, you do your calculation. I had shown you the calculation for US dollar 1000 where I end with profit of 9.67. If you had worked with JPY, you would have made a profit of 967.44. That's what the answer says. So we are done with something called a space arbitrage. Space is buying in one place and selling it in the other place. Just give me a minute. Okay. Now comes the second type of arbitrage, which is called covered interest rate arbitrage, I can explain this also with the MCQs which are there, but I'll do a direct problem itself so that you understand the interest rate arbitrage fully. Covered interest rate arbitrage, because this is a slightly important one. Let me directly get into a problem. Let's come to 31. Because this does not have INR in it. When you don't have INR in it, this difficulty level slightly increases. The interest rate on pounds is 12% in UK, 7% in US. Pound spot rate is 1.79. 1 year forward rate is 1.68. Check whether arbitrage opportunity exists. A very simple, straightforward question. How you do the problem, I'll explain, okay? Now, what is the spot rate? First, I'll have to calculate something called as a fair forward rate. I can also do fair RH. I normally used to do fair RH, but let me make it consistent with ICI solution, which is fair forward rate. I'll make it consistency with ICI solution. I'll calculate something called as a fair forward rate. How are we going to fair forward rate? Using the IRPT formula. This 1.79, is it USD per GBP or GBP per USD based on international rates? USD per GBP, because USD is a cheaper currency, GBP is a costlier currency. Now write spot rate is equal to USD 1.79 per GBP. RH, USA interest rate. RH is the USA interest rate, 7%. RF, UK interest rate. 12, and we are going to apply the formula of IRPT and calculate fair forward rate. Apply the formula of IRPT, which is 1 plus RH divided by 1 plus RF is equal to F1 by E0 1 plus what rate? 7%. 1 plus 12%. F1 by 1.79. Get me the forward rate. Fair forward rate, how much? 1 point per GBP. This is the fair forward rate. That's okay. So don't get into it, because the reversal could have happened in between. So at some stage the reversal happened. Indian interest rates will also go lower to US at some stage. So like that. Now actual forward rate is out. Now understand the calculation, very simple. You need to invest in one currency and borrow in another currency. GBP according to me should be 1.71. GBP is the product. So GBP according to me should be 1.71. Whereas what is the market saying? 1.68. Unfortunately, market is not giving the right value for GBP. So I want a liability in GBP. Because market is not giving the right value. Market is undervaluing it. So let me create a liability in undervalued currency. If it's the other way around, market is giving 1.75. I'm very happy. Market is overvaluing the GBP. So let me create an asset. In GBP. Why do I want to create a liability in GBP? Because market is not giving right value for the currency. Any doubts on this? I'll repeat again. USD 1.71 per GBP is the fair forward rate. Actual forward rate is USD 1.68 per GBP. So GBP in the market is not getting its due weightage. In the market, it's not getting its due weightage. Market unfortunately is giving a wrong value, undervaluing it. Let me undervalue my liabilities. Let me undervalue my liability, and if it is overvaluing, let me overvalue my assets. Let me overvalue my assets. So strategy, borrow in GBP and invest in USD. Borrow in GBP and invest in USD. Borrow in GBP and invest in USD. Clear? It goes through a series of some 7-8 steps. I'll take you through it step by step. It's very simple. First step is borrow loan in GBP at what rate? What is the rate of interest in GBP? 12%. Students somewhere think that higher interest means deposit, lower interest means borrowing. All that is not there, okay? Because 12 and 7 cannot be compared. 12 and 7 cannot be compared. Borrow loan in GBP at 12%. What amount? Your wish. What amount is your wish? Let's assume GBP 1 lakh. Currency, please write along with me. GBP 1 lakh. GBP 1 lakh. Okay, after the loan is created, sell GBP and get USD. Sell GBP and get USD. After the loan is created, I'll sell this pounds which are there and get US dollar. Get US dollar. What is the spot rate today? Now you may have a doubt on division multiplication. If you have a doubt, go through known unknown into 1.79. Create USD deposit at what rate? 1,79,000. I'll create a deposit. 1,79,000. I create a deposit. Enter into forward contract at 1.68. I'm freezing the rate. Forward contract at 1.68 per GBP. All this happen on day 0. I'm freezing the rate. All this happen on day 0. Enter into forward contract at what rate? 1.68 per GBP, because you can enter into a contract only at the actual rate. You can enter a contract only at the actual rate. Then comes day 365. Redeem your deposit. Redeem USD deposit with interest. Redeem USD deposit with interest. How much is the interest in USD? So I get 1,91,000. I get 1,91,000. I am redeemed the deposit which I had created. Borrow and deposit both will happen together. Borrow and deposit both will happen together. After redeeming what I did, convert into GBP. At what rate? 1.68, because we have already frozen the rate. We have already frozen the rate. So I convert at 1.68. 114,006.114,005.95. I convert into GBP at what rate? 1.68 per GBP. What should I do next? Repay the loan which was taken. Repay GBP loan with interest. Repay GBP loan with interest. 1,12,000. And what's the arbitrage gain? This is the arbitrage gain, 2005.95. Now listen, you had told me one fair forward rate, no? Can you tell me a 4 decimal fair forward rate? Please tell me a 4 decimal fair forward rate. 7100 only. Okay, 1.71. If this rate was 1.71, if this rate was actual rate, then I don't make any gain. Then I don't make any gain. That $5 is rounding off. If this rate was 1.71, if this rate was 1.71, arbitrage does not exist. If this rate was 1.71, arbitrage does not exist. Now let's assume you did this calculation and you did not get a gain, which means your strategy was wrong initially. Try the other strategy. That's a trial and error. That's just a trial and error. By error, if you could not write the correct strategy and you did all proper calculation, but still you are not getting a gain, it means the strategy is not borrow in GBP. The strategy should have been borrow in USD and invest in GBP. If by mistake you have done this, if by mistake you have done this, then you have made an error in the strategy. You have made an error in the strategy. I'll repeat the steps. I'll not be repeating the steps again. First, many students, what they think is they see 12-7. That's all. They see 12-7. Natural thought process, deposit at 12, borrow at 7. That's a natural thought process of anyone, which is the wrong strategy here. Which is the wrong strategy, because 12 and 7 are not comparable. 12 and 7 are not comparable because 12 is in one currency, 7 is in the other currency. You cannot compare them. You cannot compare them. Clear? Any doubts on this? So what I do is I calculate the fair forward rate, compare with the actual forward rate. Actual may overvalue it, undervalue it. If actual is overvaluing your product currency, create asset in the product currency. Create asset in the product currency. And if actual is undervaluing it, create liability in the product currency. And if it's correctly valuing, no scope for arbitrage. No scope for arbitrage. Okay, we are now going to solve this question. If you give me bid as well as ask, and you give me deposit rate as well as borrowing rate, if you give me deposit rate as well as borrowing rate, or you give me bid as well as ask, no formula will work. Trial and error. What is trial and error? Strategy 1, borrow in INR, invest in GBP. Complete the step. If you get gain, great. If you don't get gain, strategy 2, borrow in GBP, invest in INR. Again the 8th step. Most of the time both will not give you gain. Loss of 2068, loss of 1434.37, loss of 2068, loss of 1434. This is called if they give you two-way rates. If they give you two-way rates, you don't have. Can I do this for even a normal problem? Yes. I need not calculate fair forward rate. Nothing needs to be done. I can directly do 8 and 8 step, but unnecessarily time wastage. Unnecessarily time wasted. So that is why we calculate fair forward rate and then decide the strategy. Otherwise, you can go ahead and do this for even the normal problem. When you have two-way rates, I don't have a choice. I don't have a choice. So I do trial and error. I do trial and error. Any doubts on this? Clear? Strategy is very simple. Borrow in one currency, convert to the other currency, create deposit, take forward contract, redeem the deposit, repay the loan, redeem the deposit, convert into other currency, repay the loan, and left with arbitrage gain or loss. Any doubts on this? This is a second type of arbitrage, which is called covered interest rate arbitrage. Comes the third arbitrage, which is triangular arbitrage. What is triangular arbitrage is? They give you three quotes. They give you three quotes. What are the three quotes? INR per USD, INR per GBP, USD per GBP. Now do what I say. You have USD 1 lakh in this question. Okay. Please convert this 1 lakh USD into INR in the calculator itself. 1 lakh into INR. Convert the INR into GBP. Convert whatever INR you have into GBP. Convert that back into USD. One lakh. 1 lakh 1,000. I started with 1 lakh. I started with 1 lakh. I'm ending with what? 1 lakh 1,129. Now I told convert. You had USD in hand. I told convert into INR and do this. Let's assume you have USD in hand. Convert that into GBP. Convert that first into GBP. 1 lakh divided by 1.6231. Convert that into GBP. You got the GBP. Convert that into INR. Convert that back into USD. One of the two strategy will give you arbitrage gain if there are no exchange margin and other issues. If there are no exchange margin and other issue, one of the strategy will give you arbitrage gain. What you need to do? Trial and error. What you need to do? Try. What ICI does, they give only one answer. Which answer you don't know. That is why I have to do trial and error. I have to do trial and error. I started with 1 lakh, converted into the first. How do I decide? I have USD. With USD, what are the quotes in the question? With USD, what are the quotes? INR per USD, USD per GBP. So you have only two choices. So the routes are from USD, go to INR, go to GBP, go back to USD. Start with USD, go to GBP, go to INR, go back to USD. In this process, one will give you gain, one will give you loss. One will give you gain, one will give you loss. That is what we have done. Understood this? Any doubts on this? So it's an arbitrage strategy to gain by converting currencies and getting back the original currency again. If we get back more than what we started with, arbitrage exists. Arbitrage exists. Example, we have USD in hand. We can convert the same into different currency in different markets and reconvert the same. Reconvert the same. We have the following quotes in question: INR per USD, INR per GBP, USD per GBP. Trial and error. USD to INR to GBP to USD, USD to GBP to INR. Now comes the concept of exchange margin. What I said, exchange margin is applied only once. Now in these type of question, every quote you will apply exchange margin. Reason is because you are doing the conversion, getting the real other currency, getting the real other currency. So where the exchange transaction takes place in different markets or bank, exchange margin is to be applied on each of the individual quotes, exception to the normal rule where we have mentioned that EM is to be applied on either the final cross rate or one of the quotes. The reason is every time you are doing the conversion. Every time you are doing the conversion. So you have to apply it every time. You have to apply this every time. Clear? Understand this. Now I get into something called as hedging of forex risk. What is hedging of forex risk? Is whatever risk is there, I want to hedge it. There are multiple instruments which are given in your ICI study material, starting from currency invoicing, netting, leading and lagging, forward contract, money market hedge, futures and options, and currency swaps. All of this to some extent you have seen at some other places. Futures and options we saw when we were doing something called as your derivatives. Currency swaps you saw in the last session. We did one question on with the two currencies being different currency. That was a currency swap question. That was interest come currency swap. That was interest come currency swap. Money market hedge you did not see, but money market you saw when we were doing money market instruments. Forward contract and futures contract is technically same. Forward contract and futures contract is technically same. We saw forward rate agreement. Futures contract has three challenges. The three challenges is the time period. Okay, that third one challenge is only for the interest rate. Two challenges it has. Number of contract can be in decimals, and on the last day there can be a basis risk. Forward contract doesn't have that risk. Forward contract doesn't have that risk. Only challenge with the forward contract is if you take forward contract, there is a possibility that the other party may default. The other party may default. So you have to then do legal case, all that will go on. In futures, other party cannot default because you need to deposit maintenance margin or initial margin. You need to deposit maintenance or initial margin. Because of that, you cannot default. Moment it touches maintenance margin, he will tell please replenish. If you don't replenish, he will close the transaction. The broker will close the transaction. In fact, in futures, when you deal in a practical world, you don't know who is at the other side. You never know who is at the other side. In forward, it's always a deal between me and a bank which is sitting in the other side. Currency invoicing and netting are maybe two new techniques. Like, let's start with currency invoicing. Currency invoicing, very simple. Two approaches is there. One is I want to eliminate exchange risk. Second is I don't want to eliminate, but I want to speculate. One is eliminating the risk fully. Second is I don't want to eliminate. I want to take risk. Elimination is very simple. I'm talking about the Indian importers and exporter. Indian company should accept billing in INR and should do billing in INR. That is, if you are exporting something, you will tell my billing will only be in INR. My billing will only be in INR. If you are importing something, again you are saying my billing will only be in INR. This technique practically not possible for any Indian company because internationally most of the transaction happen in USD. Most of the transaction happen in USD. So where will it happen? If you look at a US company, ideally they should not read about this forex itself because for them the billing will be in US dollar when they sell, and when they buy also it will be in US dollar. So they are least bothered about all this exchange rate, all this discussion, because for them If I see, if I'm buying something in INR, if I'm selling something in INR, where is the exchange rate coming into picture? Where is the exchange rate coming into picture? So for a US based company, all this will not be there. So currency invoicing can do only one thing. It can transfer your risk to the other party. It can transfer your risk to the other party. It cannot eliminate. It's not a technique to eliminate the risk. I don't want to take the risk. So I'm asking, can you take the risk? So I pass it on. Practically, there is an issue. The issue is loss of business. If you tell the other party that I'll bill only in INR, he says, I don't want to do business with you. I don't want to do business with you. You want to import something, you are importing, and you again force, he'll say, I'll not supply to you. I'll not supply to you. An Indian company is exporting goods to USA. What should be the billing currency if I opt for currency invoicing technique to hedge transaction? Very simple, INR. INR, if I can get, practically difficult. Then you are saying, no, I want to take risk. I want to take risk. If you want to take risk, it's very simple. What you need to do is, you need to bill in a currency which is appreciating. You need to bill in a currency, that is, if you are exporting, bill in appreciating currency. Why exporting appreciate? Export leads to receivable, which is my asset. I want my asset to appreciate. And if I'm importing something, I create a liability. I should get that billing done in depreciating currency. If I'm exporting something, give me appreciating currency. If I'm importing something, give me depreciating currency. Assume I give you two choices. One is USD, second is GBP. You are going to import something. Unfortunately, both are appreciating. No problem. This appreciates 4. This appreciates 6. Let me select 4. You gave me two choices. Let me select the lesser appreciating currency. I don't want my liabilities to appreciate. In practically, importers have this problem because importers will be billing there in US dollar, and because of exchange rates, USD is expected to appreciate as time passes by. Exporters are in fact very happy because they want to bill in US dollar. If 80 becomes 85, they'll be very happy because now they'll realize more. So exporters always very happy with USD billing because currency is going to appreciate. USD is going to appreciate. If you are a company wants to take exchange risk, then we should bill in appreciating currency. If you are exporter, and should accept billing in depreciating currency if you are importer. Net, this is the concept. Basic logic is, I will select a currency which gives me highest inflow of INR in case of export, and select a currency which leads to lower outflow of INR in case of imports. Higher inflow, lower outflow. Now, can you please see this and tell me, first see this. Okay, yeah, read both and tell me what should I do. One thing I can tell you for rough discussion, if INR is depreciating 5% against USD, you can understand USD is appreciating 5%. So it's technically not right, but for rough discussion, this is fine. So USD will appreciate by 5%, GBP will appreciate by 3%. Are we importing, exporting? Importing. I wanted a depreciating currency which I don't have. Because my currency is only depreciating. So among the two, which is the better one? GBP. Both are bad. I'm selecting the one which is lesser bad. Import will lead to foreign currency liability. We should go for billing in depreciating currency. INR is preferable, but counterparty says what? USD or GBP. We should therefore accept a currency which have lower appreciation, and hence we will prefer GBP. Able to understand the point? Any doubts on this? Tell me with this what you want to do. See this and tell me what will you do. The swap points ascending order indicates something, descending order indicates something, which we did when we were doing swap points. Ascending order indicates something, descending order indicates something else. Ascending order means what? Currency will appreciate. Currency will appreciate. Descending order, currency will depreciate. In this case, which is appreciating? Euro is appreciating. Go ahead. Go ahead with euro. Company should accept for billing in euros. Okay. Exam questions will give you some number and say that you want to go for currency invoicing technique. You want to go for currency invoicing technique. When you want to do currency invoicing technique, they'll give data in euro. You need to convert that into USD to do the billing. You need to convert that into USD. Now, when I want to do this conversion, I can use bid rate, I can use ask rate, I can use middle rate, I can use any rate I can use because it's a negotiation. It is not a dealing with a banker. It is not a dealing with a banker because students come back saying that I am an exporter. Why are you doing bid rate? Why are you doing ask rate? There's nothing there because it is a negotiation between the two parties. When we are discussing, I'll say 60 lakh euro is the amount. I want to bill in US dollar. So I will use bid rate. I will use ask rate. I will use middle rate. Which one is better? I cannot tell you because consistency is not there. Consistency is not there. Exam situation, time permits, you may end up doing both. That is, if the billing was done using this rate, if the billing was done using the other rate. Question can ask for converting the foreign currency exposure into home currency exposure and bill the same in home currency. Bill the same in home currency. That is, I had $1 lakh is the amount. I wanted to convert into INR. Should I use 48 or 50? I don't know. 48-50 is the rate. Should I use 48 or should I use 50? Should I use 49? I don't know. You cannot use any logic of bid ask there saying denominator currency because consistency is not there and it cannot be there also. Reason is this. Exposure can be converted at bid rate, ask rate or middle rate. This will depend on what? Negotiation of the two party. What is negotiation? $1 lakh, you are sitting in the other side. If I use 48, billing is 48 lakh. If I use 50 lakh, I will prefer 50. You will say 48. You will say 48 and I will say 50. We may sit together and say, let's do 49. Let's do 49. So I cannot give any consistent answer to this. I cannot give any consistent answer to this. Exam questions are right. I say approach is also right. Only thing is they could have made it simpler saying that please use this rate or the other rate. Please use this rate or the other rate. Few exam question, it became simpler. They did not give two rates. No bid rate, no ask rate. So I don't have a problem. I just use the one rate and then. Okay, I'll go to the next technique, which is called leading and lagging. It's a fairly simple technique where what we are doing is basic principle is higher inflow of INR, lower outflow of INR. Basic principle is higher inflow of INR, lower outflow of INR. How do we do this calculation? What is lead and lag is, should I make the payment immediately or wait and make the payment? Should I receive the payment immediately or wait and receive? That's the analysis you do. Now there is a challenge. Making early payment or making later payment is in your hand. Receiving early, receiving later may not be in your hand because the counterparty has to make the payment. The counterparty has to make the payment. So outflow or inflow under both option cannot be compared because one will happen on day 0. Another one will happen on day 90 and hence we should add interest. We should add interest to the lead amount. What is lead amount? Is day 0. To the day 0 amount, you will add interest and take it to day 90. To the anything. Day 0 you will add. Interest rate will, how will you calculate? There are two types of companies. One is a cash deficit company. Another is a cash surplus company. Assume you had $1 lakh payable. $1 lakh payable. What you did is in one option, you said I'll pay immediately. I'll pay immediately. So you paid $1 lakh today, 50 lakh rupees. You paid 50 lakh rupees. Second option, you waited and made the payment, but that is 55 lakh. Why 55? Because currency depreciated. Currency appreciated or depreciated in this gap. 50 lakh in one option, 55 lakh in other option. both are not comparable. 50 is happening when? Day 0. 55 is happening when? Day 90 or day 365, whatever is the time period. How do I make comparable? Assumption, two things. I did not have any money with me. I did not have any money with me. I went to the bank, took a loan. I went to the bank, took a loan. If you took a loan, you have to pay interest. Second option, you had money. You had money. But that money was in the fixed deposit. That money was in the fixed deposit. You break the fixed deposit. You break the fixed deposit. So you're losing the interest income. So interest rate will be borrowing rate if I'm having a cash deficit. If I'm having a cash deficit, and it will be an investment rate if I have cash surplus. If you are having surplus money, then you can go with your investment rate. Otherwise, go with your borrowing rate. Early receipt is a slightly challenging thing. What is early receipt is? I want my customer to pay immediately, which may not be possible so easily. So then what you need to do, you need to give some discount to your customer. You need to give some discount to your customer so that he makes immediate payment. See, I purchase from someone one product, $1 lakh. I have to pay after 3 months. Suddenly you are calling me and say, give me $1 lakh. Why will I give you? I will wait for 3 months. You gave me credit period. No, I will pay only after 3 months. Then you are saying, can you please pay now? Don't pay $1 lakh. Give us 99,000 or 98,000. I'll give you discount. I will give you discount. So in case you want a early receipt, there can be some discount charges which needs to be incurred. Clear? Now, this is a very important concept. I have tried explaining in many ways, but still students end up making mistakes here. A firm is considering whether to lag receivable. Lag receivable means normally you will collect in some time, you are delaying that beyond normal credit period. Let us assume normal credit period is 2 months, but we are planning to extend the same to 3 months. So in one case, you will get the money in 2 months. In another case, you will get the money in 3 months. When we are comparing both the option, either consider interest income in option 1. What is interest income? You get the money in 2 months. You get that money, no? You put it in fixed deposit, earn interest. Or you have that money, you repay the loan, save interest. Interest income from month 2 till the last month. Or consider opportunity cost in option 2. What is opportunity cost? In the second option, you are saying, you waited for 1 more month. I want to consider opportunity cost. You cannot do both. If you do both, you are double counting the same item. Students keep asking me this. I don't have answer to this. I can only tell you, if you do consider both, either go by real cash flow. What is real cash flow? Option 2, you'll get interest income. That is real cash flow. Or you go with opportunity principle. You say in the alternative 2, I will consider opportunity cost. In alternative 1, I'll consider interest income, double counting of the same item. Moment you consider interest income, month 2 becomes month 3. Moment you consider opportunity cost, month 3 goes back to month 2. Now again, they are not comparable. So either consider one or consider that, but don't try to consider both. I don't have an answer to this, because you will ask me a question. You will say that time you considered opportunity cost. Why are you not considering opportunity cost? You are perfectly right. Consider opportunity cost, then don't consider the income. Then the other argument, no, we are getting income. Why are you not considering it? That is also right, but you cannot do both. If you do both, you are double counting the same adjustment. I cannot do double counting of the same adjustment. Either go with real cash flow or you go with opportunity cost principle. I have no problem. Let's take a company has a payable of N 10 lakh after 3 months. N is likely to appreciate by, my liability will appreciate by 5%. Company is thinking whether to pay this today after 3 months. It is having a cash deficit, and the rate in bank loan is how much? 10% per annum. So you have two choices. You can pay today with an INR loan, which will have appreciation of 10%. What is appreciation? Interest rate of 10%. So today you don't pay, interest will keep getting added. So either have a N liability which will appreciate by 20% per annum. Which will appreciate by, what is 20%? 5% for 3 months, 20% for a year. So N liability, 20% appreciation. INR liability, 10% appreciation. A loan will keep appreciating. A loan will keep appreciating. Which is better? INR borrowing is better because this will appreciate only by 10%. That will appreciate by how much? 20%. Hence, it is beneficial to borrow money at 10% and pay liability today. Borrow at 10% and pay liability today. Able to understand the concept? Both will appreciate. Both will appreciate. Yen, if I leave, it will appreciate and become 20%. We will not answer something like this. Just a concept MCQ. We'll do proper calculation and then try to give the answer. This is just a concept MCQ to get the clarity. Tell me answer to this. If you are having a surplus money, what rate is relevant? Investment rate. And if you are having a deficit, borrowing rate is relevant. Okay, now coming to netting. Netting as such, we may not see much of questions in exam. One concept can get discussed in netting, which is on an area called cash management, where there is one problem there, but I'll be discussing that in multiple forex hedging strategy. That is, after doing all the strategies, we'll club them together. So good part about forex is after doing everything, we'll revise them by doing problems. We'll revise them, which is called multiple forex hedging strategy, where in one question you will do 3 of the techniques, in another question you will do 3 of the techniques. So we'll club them together and do it. That is the last part of the chapter, where around normally 2 hours I spend on multiple forex hedging strategy and revision. So let me come to netting. Netting is very simple. We did that problem on fixed rate payer, floating rate payer. I told you don't pay me, I'll not pay you, we'll net off the amount. That is called netting. That's all. So how does netting helps in reducing risk? Because I had $1 lakh payable, I had $1 lakh receivable. If I knock them each other, my forex risk is over. My forex risk is over. Netting refers to the process by which dues receivable and dues payable are set off. Net exposure is inflow minus outflow. In exam, one time they asked what is the net exposure calculation to be done, for which you can multiply with spot rate. You can also multiply with forward rate. You can also multiply with spread rate. Spot rate or forward rate or spread rate. And one utility of netting is something called as cash management. We'll be doing a problem on cash management later on when I go to multiple forex hedging. What is cash management is, I have 4 subsidiaries, each of them having some surplus money. Some are having deficit, some are having surplus. I tell them everyone independently do investment, independently do borrowing, and after 360 days we will do the calculation. Another approach is I net off all the amount today and do one investment. Doing immediate netting most of the time will be beneficial. Immediate netting will be beneficial. So your cash balance as per option 1 and cash balance as per option 2 will change, and that gap is called benefit of netting. That gap is called, one is doing centralized cash management. What is centralized cash management? I tell everyone to give me the money. Today I will net off all the amounts and do one investment or one borrowing. Later on, everyone individually does it. In the end, again, I'll have to convert into single currency. There is a question on netting. Sorry, I didn't see this. There's a question on netting and the cash management. We are not going to solve the question. I'm not going to get into the solving of the question. Let's just understand it. AMK Limited, an Indian-based company, has subsidiaries in US and UK. Surplus fund for the 2 subsidiary. US has surplus, UK has surplus. Annual borrowing or deposit rate. What is the use of borrowing or deposit rate? If you have surplus, you create deposit. If you have deficit, create a borrowing. Indian operation is having what? So I have 2 choices. Every company does independent. That is, in India, 500 million deficit. Take a loan at the rate of 6.4%. In US, 12.5 million, create a deposit at the rate of 1.5%. UK, create a deposit at the rate of 3.7. Add interest, you will get the amount. In the end, convert everything into INR using this rate. Convert everything into INR using what rate? 30-day forward rate, because you are going to do at the day 30. Is this rate correct? USD per INR or INR per USD? USD per INR is right. So one approach is everyone does, I get the value and I do conversion. Other approaches, I do conversion today and do single investment or single deposit. What's the benefit? 4865 minus 4753. 4865 minus 4753. So I save around whatever is the gap. I save around that much is the gap. This is called immediate netting. So is this technically is this a new technique and all? No. This I need not tell you netting. These are the two approaches. One, I can do immediate investment by pooling all the funds together, or I wait and then I do pooling of funds together. Both are different approaches. One is called independent cash management. Another one is called centralized cash management. One is called centralized. Another one is called independent. One exam question asks calculate net exposure. Calculate net exposure. I understood the question that 4 crore minus 2 crore they want, 2 crore minus 80 they want. All this I understood. But suddenly they're saying net exposure of each currency in terms of what? For that, ICA gave different option. Okay, just if at all if it gets repeated, just remember it's your study material question. It's your study material question. What they did is they found out the net amount. They say I'll multiply with spot rate. I can also multiply with forward rate. I can also multiply with spread rate. I can also multiply with spread. That is I can do. That is what in the theory I said I can multiply with spot rate. I can multiply with forward rate. I can multiply. Are any of the exposure offsetting to some extent? First of all, every exposure is offsetting each other. Every exposure is offsetting each other. In top of that, they're talking about something else. In Japanese yen, I have a outflow. In Japanese yen, I have a outflow. And what is happening in Japanese outflow is forward rate is at a discount. Forward rate is at a discount, which means my liability is depreciating. Everywhere else, I have an asset. Everywhere else, I have an asset, and each of the asset is appreciating. Each of the asset is, this is the best thing which can happen to me. This is the best thing which can happen to me because my assets are appreciating, my liabilities are depreciating. That was a simple discussion which they had, which is good. This is a simple discussion on it. Now I come to forward contract. When I come to forward contract has two components. One is cancellation of forward contract, which we are not going to touch today. I'm not going to touch any question on cancellation. I'm going to touch questions on something called as a cover rate, something called as a profit or loss calculation, something called as should I take a forward contract or not. So all those type of question, which mostly some understanding of known and unknown will be used, and some places you will have to use certain extra concept. Cancellation part we will start fresh whenever. Tomorrow there is no session, so on Monday what timing I'll update in the group. So Monday whenever we are starting, we'll start with forward contract and take it forward. Now listen, what is forward contract is a contract entered to buy or sell at a specific rate on future date. Now question says, do you want to take a forward contract? Very simple rule. I'll take a forward contract if two choices. One, I don't want to take any risk. Please take a forward contract. You don't want to take any risk, take a forward contract. Second is, question says it will be at 85. I believe it will be 83. You have your own belief and question gives one number. Then in that case, you need to check if you cover, what is the outflow? If you don't cover, what is the outflow? Whichever has lower outflow. If you have inflow, if you cover, what is the inflow? If you don't cover, what is the inflow? In simple words, higher inflow of INR, lower outflow of INR is my principle. Very simple principle. Receivable, higher inflow, payable, lower. Now, this is a very simple question, okay? But still students keep making mistakes on this, okay? I leave it to you. Don't look at the, just look at the question. You have some understanding of forward contract. Tell me, should you take a forward contract or not? You do have an understanding of forward contract, so you tell me the answer. Two rates are there in front of you. I have a receivable. Should I collect at 1.43 or at 1.41? I may force you to make mistakes also. So think logically and then do it. Okay, in order to solve this, don't look at 1.43, 1.41. It will not give you the answer. It will only force you to make a mistake. What you do is, you have $1 lakh. If you collect at 1.43, how many GBP? 1 lakh divided by 1.43 or into 1.43? Divided by, what is the number you get? 1 lakh divided by 1.43 is 1 lakh divided by 1.43. This is if you take forward contract. If you don't take forward contract, 1 lakh divided by what? Which is better? 1.41. Student, what they see? 1.43 is higher, 1.41 is lower. Let's go ahead with 1.43. Let's go ahead with 1.43. There is no thought on what is the question asking. I know only one thing. He has given me two rates, 1.43, 1.41 receivable. I'll do 1.43. That's all. That's how students normally answer. If you give me this question and ask me, my mind will also tell 1.43 only. That is why I put some number and then do the calculation, because it depends on whether you're dividing or multiplying. Whether you're dividing or multiplying. You see in my example, I said 100. I said 100. I did the calculation. Okay, this is there. You tell me what is the answer to this. Give me a logical answer to this. I want a logical answer. I don't have two rates here. I don't have two rates here. So give me a logical answer to this. It could be that you're not able to decide also. It could be that you take a forward contract, you don't take a forward contract. Do I have a payable or receivable? Payable $1 lakh. Spot rate is how much? 74. Forward rate? So if you take forward rate 73 lakh 50, you cannot compare that with 74. Okay, you cannot compare that with 74, because last question you compared 1.43 with what? Expected spot rate. Now what is expected spot rate? They have not given, but what you can tell is 74 should only go up. Why? Because interest rates in India are higher than that of USA. Interest rates in India are higher than that of USA. So ideally 74 should become 75, 76, 77. Which means if you keep it open, you will end up paying 75 or 76. If you hedge it, you will pay how much? 73 lakh 50. This they asked in one exam. They did not say interest rates in India are higher and all. They said these are the rates. You tell should you keep it open or not. Then student had to answer saying that I can take a forward contract if I believe in future the rate is going to be more than 73.5. If in future the rate is going to be more than 73.5, it is better to pay 73.5. Then they said in future, if you believe the rate will be lesser than 73.5, don't take a forward contract. And they gave a very good conclusion saying that considering the current interest rates between India and USA, considering the current interest rates between India and USA, it is wrong to expect appreciation of INR. It is wrong to expect appreciation of INR or depreciation of USD. If 74 has to go down to below 73.5, you are expecting what? USD has to depreciate, which is a wrong conclusion. Which is a wrong conclusion. This was the exam question. See this. First is what will be your commitment in rupees if you enter into forward contract. What is the loan amount I've taken? 2 million. Loan is at what? LIBOR plus 1%. What is the 6-month LIBOR today? 2. 2 plus 1 is 3. Now I have one challenge. Is it 3 for a year or 3 directly for 6 months? That challenge can come. I know US interest rate. This should be per annum mostly. This should be per annum. I don't know the answer, but I'm saying this confusion will keep coming in. So I pay interest of how much? 3% into 6 by 12 using the forward rate 68.4575. I do the calculation. I don't want to do any calculation on this. Where when something tricky comes, I'll explain. Will you advise them to do so? Explain giving reason. For answering this, I will calculate fair forward rate using IRPT. Fair forward rate using IRPT. And fair forward rate, if it's more than 68.4575, fair forward rate, if it's more than 68.4575, it's better to pay 68.4575, which even without doing the calculation, I know it will be more only, because what is happening to interest rates in USA? Lower. India, higher. So the 68.5275 can only increase. So the fair forward rate is 69.8845, which means it is better to take the forward contract. Then they are saying no, rate is not 68.5275, 68.4275. Again, you have to repeat the calculation. Last part is where what I said will come into picture. We are saying interest rate is not given in question. Then they gave three-way answer. First answer saying, what do you expect? If you expect less than 68.4575, please don't take a forward contract. If you expect more than 68.4575, take a forward contract. And if you don't have any expectation, go by IRPT. The forward rate indicates that INR will appreciate over the next 6 months. INR will appreciate over the next 6 months. If the company believes INR can appreciate more than what is indicated, INR can appreciate more than what is indicated. What is INR appreciation? 68.52 becoming 68.45. You are saying no, 68.45. It will go to 68.3, 68.2, 68.1, 67, 66. You are saying it can appreciate even more. In that case, don't take a forward contract. If you are not having, if you believe appreciation will be less or there can be depreciation, then take a forward. And the last part is the good conclusion. If the company has no view on exchange rate, enter forward contract, close it. Given the interest rate differential between India and USA, it would be unwise to expect continuous depreciation of dollar. Dollar depreciation nobody can expect. Okay, dollar is not going to depreciate unless the US economy is crashing, some challenges are there. That's a different thing. Otherwise, expecting dollar depreciation is kind of a wrong assumption. So please go ahead and cover the exposure. Any doubts on this? Very simple discussion. There's nothing much in the question. Any doubts on this? Can we proceed?
Small doubt.
Yeah, please tell me.
Sir, for that USD loan, why are we taking INR rate, sir?
Where did we take INR rate for USD loan?
USD loan is 2 million. And in the calculation of part 1, we are taking 3%, no?
What is 3%? 3% is what rate?
6 months, it's a 6 months LIBOR is 6%. So by 2
plus 1.
3, no?
2 plus 1, LIBOR plus 1.
Okay.
Okay, I'll go to the next concept. Some question will ask, what is the cover rate and a profit or loss based on that? I'll explain with MCQ. You will understand it better. Now let's understand first what is cover rate. Cover rate is the rate which you are using for hedging. Question will say, you want to take a forward contract, you are hedging at some rate. When I do a forward contract, whatever rate I hedge is the final cover rate. But they'll say, you have to pay premium today. Premium payment doesn't happen in forward contract. In forward contract, I pay booking charges, which is fixed for a contract. But question will tell you pay premium. Okay, if you are saying I'll pay a premium. If you are paying premium on day 0, there's an interest on premium. So cover rate for a payable is hedging rate plus the upfront premium plus the interest on premium. For receivable, hedging rate minus the premium minus the interest on premium. Logically, should there be a premium? Ideally, no. Now the question asks multiple type of losses. One, they will ask, what is the profit or loss you arise because of taking a forward contract? This is technically not a good way of analyzing it, but still questions will ask you to do. That is, I asked you, do you want to take forward contract? You analyzed on day 0. You said you will take forward contract. In the last question, 68.45, some numbers were given. You said yes. Unfortunately, on the last day, exchange rate becomes 60. Now you are thinking, why did I take a forward contract? Why did you take a forward contract? So you will be thinking, because you took a forward contract, there is a loss happening. happening? Because you took a forward contract. Because you took a forward contract, you will now think not on day zero. You cannot analyze this on day zero. So what is profit or losses? I have to go to the last day, check what I pay in forward contract and what I would have paid if I did not take a forward contract. What I pay in forward contract and compare with what I would have paid. What I would have paid. For example, I paid 700 lakhs in forward contract. If on this day, if forward contract was not there, I would have paid 720 lakh. In forward, you paid 700. If you had kept it open, you would have paid 720. Are you happy that you took a forward contract or not? Yes. So I earned 20 lakh because of the forward contract. I earned 20 lakh because of the forward contract. What is the calculation? FC exposure into spot rate on maturity date, which is 720. FC exposure into your cover rate. FC exposure into your cover rate. I don't want any formula because students kept on asking. I've written a formula. Comparison is this. Profit or loss is computed by comparing the actual cash flow with the notional cash flow. What is notional? You have already taken a forward contract. Now there's no point in doing, it's basically doing a postmortem. We are doing a postmortem of whatever decision has been taken. You have already taken a decision. Now you want to do postmortem of that decision. Why should I do this? If every time I'm suffering a loss, then there is something wrong with the company. There's something wrong with the company. I should not take forward contract because every time I do analysis and in the end you are saying forward contract should not have been taken, forward contract should not have been taken, forward contract should not have been taken. There are practically a lot of companies who are exporter. They don't take any forward contract. They don't take any forward contract. They are saying anywhere rupee will depreciate only. Let me keep it open. Sometimes I'll gain, sometimes I'll lose, and let me not get into forward contract. Many small exporter, I'm talking about small companies, they may not do any hedging itself. They're saying let it be open, let it be open. Clear? So what is profit or losses? Comparing what happened with what could have happened. With what could have happened. If what happened is good, you are happy. If what could have happened is good, you are sad about it. That is what the calculation is all about. That is what the same thing in forward contract. I realized 700 lakh. If I kept it open, I would have realized 720 lakh. I would have realized 720. Now realization. Are you happy with the forward contract? No, loss of 20 lakh. It is a loss of 20. Formula changes. Technically, I don't want a formula. Technically, I don't want a formula. Just understand the logic. Now see this and tell me the cover rate. I've given you the formula for cover rate. See this and tell me the cover rate. Whatever you understand, that's your wish. Whatever you understand, you do it, we'll discuss. Is there a word per annum there? So when we did appreciation, depreciation, what did I do there? 3% if it's given, what did we take? We directly take it for the time period. So this will not be per annum and all. If they have mentioned 2%, it's 2% for the period. It's not like interest rate. Don't confuse with interest rate. Is it an importer or an exporter? So you have to pay 45, interest of 0.90 on day 0. Premium of 0.90 on day 0. Premium is what? 45 into 2%. 45 into 2% upfront premium. Upfront premium. On this premium, interest 0.90 into 12% into 6 by 12. All the three are my outflow. All the three are my outflow. So effectively, I'm paying how much? 45.954. Now please imagine this and tell me, did good happen or bad happen in this? Good is profit, bad is loss. By taking forward contract, how much did you collect? If you had not taken, so loss, profit, loss, because I got 45. I'm thinking, why did I take this forward contract? I'm thinking, why did I take this forward contract? Now this is very easy because we have INR. Wherever INR is not there, you may be thinking multiplication, it can become division. So that caution alone I want. Okay, this is same. Give me answer to this. Lot of concepts are there in this. Don't be in a hurry. Okay. Loss of, is it not 3 lakh? Okay, listen. You are going to pay at the rate of 55. What in reality happened is spot rate 50 per USD, and which is depreciating. INR. INR is not the product currency. So you'll have to do conversion. USD 0.02 per INR. Subtract 4%. Subtract 4%. No 4% per annum and all. Directly 4% subtraction, which is USD 0.1. Okay, 0192. Reconvert. 4 decimal. 08. So I am paying, I could have paid 52 lakh 8,333. What I ended up paying is 55 lakh. So there is a loss of 291 667. This is one type of loss analysis. Okay, this is one type of loss analysis where you do post-mortem. This is technically called post-mortem analysis. I am done with the every transaction and now I'm doing. Second is, some question will say, tell me what is the likely loss if I do hedging and if I don't do hedging. What is this is, you did the sale in your books of accounts, you recorded it as into 90. You recorded this into 90, sales rupees 90 lakh, sales rupees 90 lakh. If I do forward contract, I will collect only 87 lakh. If I do forward contract, I will collect only 87 lakh. So by taking forward contract in my books of accounts, I'll have to report a loss of 3 lakh. In my books of accounts, I'll have to report a loss of 3 lakh. That is technically called translation loss. If you don't do a forward contract, if you don't do a forward contract today, you are believing it will be 84. This is all your belief. Today you have to believe. Today you have to believe. So you are believing if you don't take a forward contract, you will pay 84. You will pay 84. Sorry, you will receive 84. You will receive 84. So that is the expected loss with hedging of 3 lakh, without hedging of 6 lakh. What is with hedging? Realization, which is actually realization which is going to happen with the forward contract, and what is recorded in your books of accounts. What is recorded in your books of accounts. Then what is without hedging? Realization which will happen. Again, it is, the word is expected. Okay, this is not actual. This is not actual. Expected means all you are doing today. All you are doing today. Expected loss if hedging is not done is compare cash flow at spot rate. What is spot rate? In your books of accounts you record, no, that is called spot rate. When I say books of accounts, it's not technically books of accounts, it's basically the spot rate. With cash flow that will happen at expected spot rate. With cash flow that will happen at expected spot rate. This is if hedging is not done. Because you are saying this will happen and today this is the scenario. What is second scenario? Cash flow at spot rate with cash flow at what? Forward rate. Please tell me whatever you get out of this. There's technically two answers are possible, but okay, you write it, you do it and let me know. Both answers are technically possible. What is more logical, I cannot tell, but okay, you first decide this answer. What are you recording in your books of accounts? I'm going to record in my books of accounts 70 lakh. What will I realize? 67. So in my books of accounts, I'll have a loss of 3 lakh. That's one way of understanding. Somebody will say, no, I don't want to do that. I want to do another calculation. If I collect today, what is the payment? 68. If I collect it later, what is the payment? 67, which is a loss of 1 lakh. Now, loss in operating profit means in your books of accounts. In your books of accounts, let's not worry, ICI doesn't give two different rates. Maybe I complicated this MCQ, but normally they will not give two different rates. They'll just give one rate and then you proceed with your calculation. That is whatever is in your books. We did this loss in operating profit in one problem. 45.2 was given, 45.6 was there, 45.5 was there, and we did some calculation saying what is the loss in my books of accounts. Okay. Good morning, friends. Okay, let's continue with our discussion. We were doing a forward contract area. Whatever we did before that, I've revised in the last session in the end. So let me just start with forward contract discussion. What we learned in forward contract is we are taking this to freeze the future interest rate. Freeze future exchange rate. If you freeze future interest rate, that was called FRA, forward rate agreement. Like that, here we are freezing the future exchange rate. What is the exchange rate? The rate at which two currencies will be exchanged with each other. Now, why are we taking forward contract? Because I don't know what is going to happen to my exchange rate. So, as an exporter or an importer, I want certainty. That certainty can come through forward contract. So, in case I do not have any view, then I should go ahead and take a forward contract and eliminate the risk. If I want to speculate, then you can speculate by doing a comparison called as what you will realize if forward contract is taken, what you will realize if forward contract is not taken, all that you can try to do. Now, in this, there's something called as a cover rate. Cover rate refers to the rate at which the contract was entered. It can be calculated through IRPT, or it can be calculated as the rate given in the question plus the upfront premium plus the interest on premium if it's a payable, minus the premium minus the interest on premium if it's a receivable. Question may also ask you to calculate something called as expected loss with and without hedging. What is with hedging is what you are going to realize through forward contract compared with what you will realize today. What is without hedging? Compare what you will realize today with what you would have realized with what you will realize. Some assumption is there. You have certain assumption. So I will have three numbers on today. Realization using today's rate, realization using forward contract rate, realization using expected spot rate, which may or may not happen. So that is another profit or loss we calculate. Now I'll be moving to an area called your forward contract closure. I'll start discussing that. That's the major chunk of the discussion, which can take a little bit of an extra time. So a forward contract, when you enter, you can close the forward contract through three ways. Either you can honor your commitment, or you can cancel your commitment, or you can extend or roll over your commitment. You said you will honor it on December 31, you roll it over to March 31. So either honor it, extend it, or roll over. All the three, I entered a contract saying that March 31 I will do this. I suddenly come on Feb 28 and say that I want to honor it. That's called early honor. If you come on Feb 28 and say you want to honor, that's called early honor. You come on Feb 28 and say you want to cancel, that's called early cancellation. And you want to come on Feb 28 and say you want to extend, that's called early extension. So there can be an early honor, early cancellation, early extension. On time honor, on time cancellation, on time extension. There's also late, which is possible because there is a 3 days grace period which is available for the contract. ICI in the latest exam by mistake had given a 10-day grace period, but because there was a rule earlier, it was 3-4 years back, it was a 15 days grace period. So maybe the copy pasted the previous question and did not change the date, but now there's a 3-day grace period which is available. So if you have a contract on March 31, you can come on April 1, April 2 or April 3, or it can be even April 4, 3 working days they say. You come on that day and say that you want to honor your commitment or cancel your commitment or roll over your commitment. Only important rule is there's only one way of honoring, which is honoring on March 31. All other will involve cancellation. All other will involve cancellation. If you say you want to honor on Feb 28, there's nothing like honor on Feb 28. It is cancellation on Feb 28 and then honor will happen. If you say you want to honor on April 2, there's nothing like honor on April 2. Cancel and then honor. So there's nothing like honor before or honor after. Out of the 9 possible ways, there's only one way of honoring your commitment, which is honoring on due date, Everything else will involve cancellation. Honor on due date, no extra calculation to be done. If you want to honor before due date, then you have to cancel the contract, pay swap loss, pay or receive interest. You want to honor after due date, pay cancellation loss, pay effective loss, pay or receive interest. Effective loss and swap loss terms are almost similar. Cancel on due date, pay cancellation loss. Cancel before due date, pay cancellation loss. So everywhere a cancellation loss will come into picture. Along with that, certain extra things can come into picture depending on if you are coming early or late. If you are coming on due date, no problem. If you are coming on due date, only cancellation loss needs to be paid on due date. Only cancellation loss needs to be paid. Or rollover on due date, only cancellation loss needs to be paid. If you are coming before or after, before will involve some interest calculation. Before, let's just understand, will involve interest calculation and cancellation loss has to be paid. Cancellation loss. After will involve cancellation loss, interest calculation, and there's a swap loss of bank. There's a swap loss of bank. What is swap loss of bank? I'll make you understand. So if you are honoring before due date, cancel the contract and pay swap loss. What is swap loss? What is cancellation loss? Let's just proceed. As we proceed, you'll understand. Pay or receive interest before due date. If you are doing before due date, pay or receive, even in this case, there can be a pay or receive interest if there is a data available. Many question data will not be available. Rollover before due date, again there can be pay or receive interest. Before due date can have interest calculation. After due date will have interest and something called as a banker analysis. How is it done? You will understand as we proceed. Okay, let's understand this table. This is how we will do: date, position, action, reference date and rate. On my original date, I entered into a contract to buy. I entered into a contract to, this is how the table is read. I entered into a contract to buy. At what rate I can buy? I can buy at ask rate. I can buy only at ask rate. To buy at the rate of 68, minus 68 because I'm buying it. Minus 68 because I'm buying it. I come on December 31. I come on December 31. Opposite means I'm cancelling. Opposite indicates I am cancelling the contract. I come back on December 31. I want to cancel. Opposite of buy is sell. And for sell, you will need bid rate. For sell, you will need bid rate. The only problem with this and futures, in futures, you do not have bid and ask rate. Here, you also need to consider bid and ask rate in the calculation. So, you come back and say that you want to cancel the commitment. You want to cancel the commitment. So, you cancel the commitment at the opposite rate. And then you're entering into a new contract. New position means new contract, which is for March 31. Which is for March 31. This is technically a calculation of rollover on due date, extension on due date. That is, you came on December 31 and asked for an extension. You came on December 31. If you add all the three, what is add all the three? One is the buy rate, second is sell rate, third is buy rate. My effective rate is 67.5. My effective rate is 67.5. What was my originally contracted rate? 68. Now, I originally wanted to pay 68. Now, I'll effectively pay 67.5. So, I have an effective gain of 50 paise. I have an effective gain of 50 paise. Effective gain of 50 paise. But this effective gain will not happen on December 31. Because on December 31, what will happen is, you originally entered at 68. You cancelled at what rate? 66.5. Banker will say, pay me 1 rupee 50 paise. Banker will say, pay me 1 rupee 50 paise because you have cancelled the commitment. Because you have cancelled the commitment, please make a payment of 1 rupee 50 paise. So there is one cancellation loss and effective loss. Cancellation loss is not a real worry for me, because in this example, though I have to pay 1.5 on December 31, I have to pay 1.5 on December 31. I'm happy about one thing. What was my originally contracted rate? My new contract rate is what? So I'm saving 2 rupees, losing 1 rupee 50 paise. Effectively 50 paise is my gain. Effectively 50 paise is my gain. So we calculate two types of losses. One is called effective loss and another one is called cancellation loss. ICI is not consistent what they want to answer. So we will end up doing both in the question. When to write, what you will understand as we proceed. What is cancellation loss? The loss which you pay on cancelling the contract. What is effective loss? This will not come. Effective loss will not come if you don't have the third item. What is third item? New position. When will you have a new position? If you roll over or do honor also. How it happens on honor also you'll understand. But in case you are entering into the third position, then only I can have something called as effective rate and effective gain or loss. Otherwise, there is only a cancellation gain or loss which needs to be paid to the bank. Original position mean what action the company want to take on reference date. What action the company want to take on reference date. An importer will enter into a buy contract, exporter will enter into a sell contract. Rate will be written as negative if the action is buy, and it will be written as positive if the action is sell. These are self-explanatory item. Understand them very clearly, because when I do it in a problem, suddenly you keep getting confused. We should ensure reference date remains same as that of original position date for cancellation. That is this December 31 you see. See what can happen is suddenly you come on September 30 and say that you want to cancel contract. There will be a September 30 rate in the market. There will be October 31 rate. In futures valuation, you understood that you can calculate rate for different period. So when you entered a December 31 contract, let's understand there are 6 variants of apples. Variant 1, variant 2, variant 3, variant 4, variant 5, variant 6. Different apples will have different rate. Some will have 200 per kg, some will have 250 per kg, some will have 300, some will have 350. You originally bought variant 6 because that was the rate you entered. Now for cancellation, you cannot use a variant 1 rate or a variant 2 rate, because that will mean you are not doing the right thing. So in a forward contract, I should always ensure that the cancellation, when it happens, the two reference date matches. The two reference date matches. Practically today, bank will give me March 31 rate, April 30 rate, May 31. So today I ask the rate. Let's assume it is 60, 61, 62. I say I want to buy at this rate, and immediately I say I want to cancel. Let's cancel at 62. That is not logical. You wanted to buy at 60 and immediately say let's use the another rate and cancel it. Then I'll make a profit of 2 rupees. Banker is not going to allow this. Banker will only clearly tell which variant did you enter. Did you enter variant A, variant B, or variant C? So whichever variant you entered, that variant can only be cancelled. I will give you rate for each variant. Apple kg1 is this rate, kg1 is this rate. So apple can be cancelled only with apple. You cannot use apple and orange rate or apple and grapes rate. So that is not possible. So be very clear that in forward contract, December 31 is a different contract and November 30 is a different contract. They are two different products. They are two different products. You cannot use product 1 rate with the product 2 rate and do a cancellation. That is not logical. We should be careful while reading the question. This is okay. A question said a customer with whom the bank had entered into a forward purchase contract. A customer with whom the bank had entered into a forward purchase contract. I asked what is the original position of the customer. Student only read the word purchase. Student only read the word purchase. What is the wording there? Bank has entered into a purchase contract, which means customer has entered into what? Sale contract. Customer has entered into sale contract. These are typical mistake which students make. Be careful when you read the question. There are two types of losses: cancellation gain or effective gain or loss. There's a cancellation gain and there is a effective gain or loss. Cost to company in respect of extension. Now, question will ask some wording like this: cost to company in respect of extension. Whenever you extend, you will have two types of losses. One is a cancellation loss and effective loss. Last problem, cancellation loss was 1,50,000 in my example. Effective gain was 50,000. How do I answer this in exam? I'll write it like this: cost to the importer in respect of extension of forward contract 17,000 in bracket loss on cancellation. However, the effective loss will be 9,800. Let ICI understand what they want, whether they want the cancellation loss or the effective loss, because the question has asked what is the cost in respect of extension. There is no consistency there. There is no consistency there. Let's take this example. A has imported goods worth 1 lakh euros payable on 31st December and entered into a forward contract when exchange rate was 66-68. Today is what day? November 30, and the importer wants to honor contract today. Spot rate, 1 month forward rate. What will be the total outflow by the importer? Total outflow by the importer. When did you originally enter into contract? 31st December. And when do you want to honor it? 30th November. This is not honor. This is cancellation. This is not honor. This is cancellation, because you are coming on which day? November 30. On November 30, you cannot honor your commitment. On November 30, you cannot honor your commitment. This will also involve interest calculation. There's no data on interest. We'll see problem on interest calculation as we proceed. Let's put this in the table format, right? Date, position, action, reference, date, and rate. Date, position, action, reference, date, and rate. Date, position, action, reference date. This heading will keep going through. You will keep doing this only. Date, position, action, reference date, and rate. The question says, I have imported goods worth 1 lakh euro payable on when? 31st December, entered into a forward contract when the exchange rate was this. I have entered into the forward contract, everything is done. I don't know when did I enter the contract. I don't know when did I enter, so call it as day 0. Day 0, original position. Day 0, original position. Day 0, original position. What did you want to do? Did you want to buy or sell? Buy in bracket at ask rate. Buy in bracket ask rate. For which rate, for which date do you want to buy? 31st December. Or today, what is the ask rate for 31st December? 68 minus 68. Minus 68. Minus 68. When do you come back? November 30. Moment you come back, I don't even want to hear anything from you. First I write is opposite. First I write is opposite. Sell in bracket bid. Sell in bracket bid. First I write is opposite. You came, I said, don't tell me anything. You know you're going to tell me something. Let me first cancel your contract. Let me cancel your contract. Only thing I have to ensure is these two are same. So read the question and tell me, on November 30, you'll have to read it like this. On November 30, what is the bid rate for December 31? 67.5. On November 30, 1 month forward rate is the rate for December 31. 1 month forward rate is the rate for December 31. Bid rate for December 31 is how much? 67.5. Positive. I leave it as positive. Why positive? Because this is sell. This is sell. And then I ask, what do you want to do? He says you want to honor now. On November 30, new position. New position, buy, ask rate for November 30 itself. On November 30, what is the ask rate for November 30? On November 30, because you want to do a spot honor. You want to do a spot. See, this is over. That's all. Cancellation is over now. After cancellation, you are telling me that you want to honor now. I says no contract for this. Whatever is the rate, you please pay. Whatever is the rate. What is the rate on November 30 for November 30? 66.5 ask rate. Ask rate 66.5 minus 66.5. Add all the three. That is my effective outflow. Add all the three. Effective rate. $60. So I will be effectively paying 67 lakh rupees. I'll be effectively paying 67 lakh rupees if you want to do a early honor. By doing a early honor, you're going to pay how much? 67. Can you tell me what is the cancellation gain or loss? 0.5. 1 and 2 comparison. Effective gain or loss? Gain loss. Gain of 1 rupee. And there's a cancellation loss of how much? 50 paise. Any doubts on this? Let's understand this. A customer with whom the bank has entered into what? Forward purchase contract. Bank has entered into forward purchase contract for Swiss franc 10,000 at the rate of what? 27.25 to the bank after, comes to the bank after 2 months and requests cancellation 1 month forward rate on the date of cancellation. How much is the cancellation gain or loss? No interest calculation. First tell me what is the scenario? Early cancellation, on time cancellation, late cancellation. Early cancellation. Why early? Because I entered into what? 3-month contract. When are you coming back? After 2 months, you suddenly wake up and say that you want to cancel this contract. You wake up and say you want to cancel. It's early. This should ideally involve some interest calculation, but many times on cancellation, interest data will not be there. So let's put date, position, action. You need not write again and again. So the same thing, okay? Let's keep writing. No heading need to be written. Leave a line gap. Day 0. Day 0, original position. Day 0, original position. Day 0, original position. What is the customer doing originally? Read and let me know. Customer is sell. Sell at what rate? Sell is basically at bid rate for month 3. For month 3. What was the rate entered? Whenever you write a rate, please write plus minus along with that, okay? Please write plus minus along with that. That ensures that you don't make any mistake. When do you come back? Month 2. What do you write in month 2? What should I write? Opposite. Buy at what? Reference date should be on month 2. What is the ask rate for month 3? 1 month forward rate. What is the ask rate for month 3? 27 point plus minus total. Minus means loss. Minus means loss. This is per US dollar. How many US dollars are there? So loss of 2,700. Loss of 2,700. Any doubts on this? Clear? Effective will come into picture only of the third item. There's no third item here. It's only cancellation. That's all. Third item is either you have to honor or extend. Cancellation, contract cancel, everything over. That's all. We are not discussing anything beyond that. New question. Where is it? In this question, new question. Now comes honor before due date. Okay, let me see if I want to do any other question on this first. 59 we just did. Okay, let's come to 60. Let's come to 60. A bank enters into a forward purchase contract covering the export bill for Swiss franc 1 lakh at 32.4 due on 25th April, converted itself for same delivery in local interbank market. On 25th March, exporter sought for cancellation. These are the rates. Calculate the cancellation charges payable by the customer if exchange margin required by the bank is 0.1% on buying and selling. Read question carefully and tell me which scenario is this. Early cancellation, on time cancellation, late cancellation. What was your original due date? 25th April. When did you come back? 25th March, which means you are seeking what? Early cancellation. You are seeking early cancellation. Okay. Interest calculation rule is not needed because there is no data on this. Let's put date, position, action, reference, date and rate. Same thing. Day 0. Day 0, original position. Day 0, original position. Day 0, original position. You are an exporter. Bank entered into a purchase contract. I cannot repeat this again and again. Bank has entered into a purchase contract, which means what did you do? Sell. Sell in bracket what? For what date? 25th April. 25th April. What is the rate? Okay, don't write it as 32.4 alone because there are multiple currency. So what you write? INR 32.4 per Swiss franc. INR 32.4 per Swiss franc, because this will tell you what rate you want. INR 32.4 per Swiss franc. The short form for Swiss franc is CHF. You can write Swiss franc also. You can write it as Swiss franc also. Now, question gave one more information which is of no use. What bank did is, he will buy from you at 32.4 and sell this to someone else at the rate of 32.42 and make his profit. I'm least interested in that. When do we come back now? March, right? March 25. March 25. What should I write for March 25? Opposite position. Opposite is what? In bracket. For which date? So listen, I want ask INR per CHF. That's why I wanted you to write, because you will expand the formula. INR per CHF is equal to INR per something into something. You will have to expand the formula and then get the rate. That is why I told you specifically write INR per CHF, so you know what you want to search now. So let's search that now. Ask INR per CHF is equal to, which is the connecting currency? USD, no? INR per USD into USD per CHF. INR per USD into USD per CHF. When are we coming? March 25. I want what rate? 1 month forward rate. Look at INR per USD. What is the April rate they are giving? Listen here. This is the spot rate. This basically means swap points. This basically means swap points. Some students have thought that this can be pips. I say in this question or some other question gave both answer, but generally these are swap points. Generally these are swap points. Some student thought it will be 49.4100, 49.4200. No, they are not pips. They are generally swap points. When can pips come? Pips can come in the same rate. 49.430 to hyphen 4455. 4455 is the pips portion. 4455 is the pips portion. Clear? Any doubts on this? What is 41? So what is your interpretation of 4100, 4200? Why are you? Where did the question said they are pips? Where is the question saying they cannot be pips? No, so that's also generally it is swap. That is why I'm saying no. Generally it is the swap points. Ascending order, descending order. Ascending order. So add. So I will only do the ask rate. Okay, 49.4455 plus 0.4200, 49.8655 plus 0.1%, only on the INR part, only on the INR part, or on the final rate, or on the final rate. That's your wish. Give me a 4 decimal number. 49 point. For USD per CHF, we are not going to use exchange margin. We are not going to use exchange margin. Again, I am repeating. Last question and this question, there is no difference at all. Last question, all the rates were directly given. In this question, the rates are not directly given. So you have to do your known unknown component or some understanding around that and then solve it. What is the USD per CHF? 1 divided by 1 point. Give me a 4 decimal answer. INR 32 point per CHF. 9475 per CHF. This is in bracket. This is negative. This is negative. The first one is positive. You will know profit or loss now. 32.4 and negative 32.9475. We can also apply this on the final rate if you want. What is final rate is? Don't apply 0.1% now. Calculate everything and apply in the end. You'll get the same answer. Negative means there is a loss. Negative means there is a loss. Any doubts on this? Clear? Can you proceed? Okay, first let me do honor before due date. Honor before due date. Be in listen mode only. Understand the calculations properly and then we start doing proper question. On 1st October 2015, Mr. X, an exporter, enters into a forward contract with a BNP bank to sell US dollar 1 lakh on 31st December at the rate of 65.4. The contract was entered at the rate of 65.4. What banker will do is he'll enter into backup contract. He'll enter into a backup contract whose data may be given, may not be given. I'm least interested if it's given or not given for before due date. After due date, I would want to know the backup contract. For after due date extension, after due date extension or honor or cancellation, I would want to know what did he do at what rate. However, due to the request, Mr. X received money when? 28th November. He requested the bank to take delivery of what? 30th November. Interbank remittance rates on 28th November is as follows. whatever rate you have in the spot, it has a validity of 2 days. This is the international terminology. So the 28th November rate can be used for 29th November as well as 30th November as far as problem solving is concerned. Practical world, I'll keep giving you new dates. Practical world, I'll keep giving you new rates. So whatever you have in November 28 can be used for November 29, can also be used for November 30. Spot rate is given, 1 month premium is given. Ignore this for the time being. Ignore this for the time being. Can you please do date, position, action, reference date, rate and do all the calculation and tell me the numbers. What is the cancellation gain? What is the effective gain? He is asking for early honor. He is asking for early honor. Let's do it together. Let's do it together. Date, position, action, reference date and rate. Early honor. Early honor. Date, position, action, reference date and rate. It's a problem on early honor. On 1st October 2015, right? October 1, 2015. October 1, 2015. October 1, 2015. Original position. Original position. See, we have already done this question. Just that interest is add on here. Interest is add on. Original position. Exporter, importer. Exporter. So what? Sell, bid. For which date we entered the contract? December 31. December 31. December 31. 65 point. INR 65.4 per USD. INR 65.4 per USD. He comes back on which day? You can understand as November 28. You can also understand as November 30. Whatever date you want to write, that's okay. 2 days difference. Does that make any difference in the calculation? Not here, but interest calculation, it makes a difference. Interest calculation will make a difference. November 30 I am putting, okay. November 30. Opposite position. Opposite position. Buy. In bracket ask rate. Same December 31. Same December 31. On November 30. On November 30. What is November 28? Okay. On November 30. What is the ask rate? What is the ask rate for December 31? 65.42. Ascending order. 65.22. Hyphen 65.27. Ascending order 0.10. 0.15. Add them. 65.32. 65.42. Ascending order. Okay. Ascending order I've added. So I'm cancelling at what rate? 65 point. INR 65.42 per USD. Any doubts till this? Then he says, I will do new contract. I will do new contract, new position. What's the new contract you are doing now? You want to honor immediately. November 30. You want to honor immediately. What is the bid rate for November 30 on November 30? 65.22. Bid rate on November 30 for November 30. On November 30 for November 30, 65.22. All those calculations are done. Very simple. We have done all this. Now you write whatever you were writing. Effective rate. Tell me the three total. 65 point. Cancellation gain loss. Okay. Cancellation loss how much? Effective loss. Effective loss is how much? 0.2, no? Original 65.4 compared with 65.2. Original 65.4 compared with 65.2. Now listen. What ICI says is, you cannot write, or ICI ways of this table and all is right. Now write final realization. Final realization is equal to, you need to imagine as if 65.4 got executed. You need to imagine as if 65.4 got executed. That's what ICI wants you to write, okay? Now don't ask me why, how is 65.4 getting executed, does not matter. They are not writing 65.2 as the answer. They are writing that 65.2 in a roundabout manner. They write this in a roundabout manner. So write point number 1, realization 65.4 into 1 lakh. 65 lakh 40. Effective loss 0.2 into 1 lakh. Negative 20. Which means you will get only 65.20. You will get only 65.20. They are saying we will not write directly 65.2. We will write in a roundabout manner. Okay, let me write in a roundabout manner. Let me write this in a roundabout manner. That effective loss is technically called swap loss of the customer. Why is it called swap loss? Because this loss happened because you swapped your 65.4 original with a new contract effectively leading to 65.2. It is called swap loss because you originally had 65.4, but you were adamant saying that no, I don't want this, I will do early honor, all that you said, because of which banker had to cancel the contract. Banker cancelled and took a new contract for you. So effectively what you did is you swapped your 65.4 with a 65.22, 65.4 with a 65.22, where you lost 18 paise and 2 paise cancellation loss. 18 paise you lost there and 2 paise cancellation loss. So ICA is saying don't write 65 lakh 20,000 directly, write 65 lakh 40, write 20,000 separately. Okay, we have written. Now is there an interest rate in the question? If interest rate is there in the question, be ready to calculate interest. Be ready to calculate interest. Now how is interest calculated? How many days early did the customer come? So you have to pay interest for 1 month. You have to pay interest for 1 month. Now on what amount? Banker is saying, I told you to come on what day? 31st December. You suddenly came in between. If you had come on 31st December, I would have got $1 lakh from you. Would have given it to someone else because I do back-to-back contract. I do back-to-back contract. I would have kind of taken care of it. I would have taken care of it. But suddenly in between you came. In between you came giving me $1 lakh. What I have to do with this $1 lakh? I have to go to the market and sell it to some other bank. Sell it to some other bank. You suddenly came in between. No, you did not follow what you said. So what banker is saying is because you have come in between, I got the $1 lakh from you. I got the $1 lakh from you. I have to sell this to someone else. I'll have to sell this to someone who? I'll have to sell this to some other banker. Some other banker. So listen. Now write interest calculation. Interest calculation. Bank buys $1 lakh from customer. Bank buys $1 lakh from customer. Why bank is buying? Because you are a seller, exporter. Bank buys $1 lakh from customer at 65.40 per USD. Assumption is it's happening at that rate. That's how that swap loss was calculated. At 65.40 per USD. On which date? 31st December, November. It's happening today. See, the argument or the challenge only thing is 65.4 is not the right rate because effectively bank is paying how much? 65.2, but ICA says no, don't write it like that. You are paying 65.4 only to the customer and collecting 20,000 because of the stupid thing which the customer did. So don't tell you collected 65.2 or you paid 65.2. You paid 65.4. Customer did some stupid thing because of which you deducted 20 paise from him. Because of which you deducted 20 paise from him. I don't pay 65.4, but you have to imagine as if you have paid what? 65.4. That lesser 20 paise is because of the stupid thing which the customer has done. So I don't want to give benefit to the customer for that. I don't want to give, because if I paid 65.4, I will charge higher interest. How does higher interest happen? You'll understand. So what did I pay to the customer? 65.4. I did not pay 65.2. It can happen the reverse also. That is, the effective loss can be effective gain also. There also we will say you paid only 65.4 because of whatever idiocy customer did. He got some money. So that is his headache. He got money or he paid money. Bank has paid how much to the customer? 65.4. Now he is sitting with this $1 lakh. He went to the ICICI bank. He went to the ICICI bank, told ICICI bank, please take $1 lakh from me. When a bank deals with another bank, the bank is like the customer, the other bank is like the bank. The bank is like the customer, the other bank is like the bank. Point number B, SBI bank. Let's understand. In the first word, please write SBI, okay? Please write SBI. Point number B, SBI bank goes to ICICI bank and sells and sells $1 lakh to ICICI, at what rate ICICI will buy? Bid rate or ask rate? ICICI will buy only at the bid rate. So SBI dealing with ICICI, SBI is starting the contract at bid rate of what? On November 30, what is the bid rate? Spot bid rate. Sorry, 65.22 per USD. Now suddenly SBI started crying, saying that I paid you 65.4 and I got only what? 65.22. He has already charged that extra 20 paise. He has already charged that extra 20 paise. We are not getting into that. He is saying I paid how much? 65.4 to you. ICICI has given me how much? 65.22. I don't want compensation from you on this 18 paise. But please pay me interest on this 18 paise because this happened 1 month earlier. This happened 1 month earlier. If you had waited, I would not have all this headache because I had a backup contract. Because you created all the stupid things, I was forced to pay interest. So you please compensate me for this now. Again, I'm explaining. Till this, I don't see any confusion to you. Okay, this table should be crystal clear because we have been doing this for 4-5 questions now. Now you have to imagine 65.2 is not the realization. You have to imagine what? 65.4 is the realization and 20 paise is the penalty. Now SBI is saying I paid you 65.4. The stupid ICICI is giving me only 65.22. So I have lost how much? 18 paise. This loss I have already recovered from you. How did I recover? I recovered what? 20 paise penalty. Sometimes 20 paise penalty can come. Sometimes more penalty can come. Sometimes less penalty can come. That's banker's loss or gain. Let's not get into that discussion itself. Banker cannot recover that 18 paise. Because what as a customer I'll say is, I don't know what are you doing. Why are you penalizing me for all this? You are charging me 20 paise. I'm paying you 20 paise. He says, great, pay 20 paise. And now on this 18 paise, just give me interest. For how many days? How many ever days you came early? Because you came early, I'm in problem. If you had not come early, I will not be in problem. So listen, point number C, SBI has paid extra. Rupees 18,000. Rupees 18,000 on November 30. Rupees 18,000 on November 30. What is 18,000? 18 paise into 1 lakh. It can happen the reverse also, okay? SBI may pay lesser. If SBI pays lesser, SBI has to give interest to the customer. Saying that customer is saying, I benefited you by coming early, so you give me interest. Practically, both the things. Cancellation loss, SBI may say, I don't want to pay you. And even that is cancellation gain. SBI will tell, I will not pay you. And interest also SBI will tell, I will not pay you. Because both I have a choice. Recovery I will 100% do. Payment I have a choice. Any doubts till this? Interest now. 18,000. What is the rate of interest? 18%. How many days early we are? They don't do month calculation. That is where I had a problem. It can be 31 by 365. It can also be 33 by 365. November 28 if you take. If you take November 28, I think they took November 30 here. How much interest? 275. I'll deduct this also. I will deduct this also and give you what? 65 lakh 19,725. I'll give you 65 lakh 19,725. We have done this earlier also. Earlier we did one problem, I think early honor. The first example I gave you was a early honor. This example is a early honor. We just stopped at this number 67. I said nothing beyond that I need. I technically don't need anything else. But ICICI says no, you will have to imagine as if you have executed the original contract, which they are to some extent logical also. Reason is, customer made stupid decision. Why should I give reward to him for that? I will charge a penalty. I'll also charge a interest on that amount. amount. These are the two things bank wants to charge. Somebody says, I want to stop at this stage. Then your answer is 65 lakh 20, interest alone is missing. Answer is 65 lakh 20, interest alone is missing in our calculation. Interest alone is missing in our calculation. Any customer does not appear on due date. What is customer does not appear in due date is according to the FEDI rules, Foreign Exchange Dealers Association rule, you have a 3 days grace period. You have a 3 days grace period. If you have a 3 days grace period, let's just imagine what is going to happen. Listen, you entered a contract like this, October 1, December 31. You did not come on December 31. Banker was waiting. Jan 1, you did not come. Banker again waited. Jan 2, you did not come. He waited. Jan 3, he will auto cancel. 3 working days, assuming Jan 1 is a working day. 3 working days, he auto cancelled your contract. If you come on Jan 1, first thing he will do is cancel your contract. First thing he will do is cancel your contract. Then what is the point of this grace period? You'll understand as we proceed. Jan 2, you come, he'll first cancel your contract. Jan 3, you come, he'll first cancel your contract. So whether you come on Jan 1, Jan 2, Jan 3, first thing which will happen is what? Cancellation of the contract. Then what is the point of grace period? As we proceed, you will get little bit of clarity on that. So let's assume I came on Jan 3. Opposite position. I have always been telling both have to match. But now, how will I read this? I'm asking you on January 3, what is the December 31 rate? I cannot forecast past. What is the forecasting of past? I can only forecast future. On Jan 3, what is the December 31 rate for cancellation? On Jan 3, what is the December 31 rate for cancellation? Obviously not possible for you to tell, because you will tell December 31 over the rate was there. What are you asking me now? So this is the only benefit. What is the benefit is Jan 3 I will have to write here. Now what is this benefit? I was on December 31. I did not have the money. I did not get the dollar, everything. So I said let's wait for 3 days. And I knew in this 3 days dollar may significantly go up or significantly go down. And I said let me cancel this contract on Jan 3 rate and not at December 31 rate. Let me cancel this contract at what rate? Jan 3 rate and not December 31 rate, because in this 3 days lot of things can change. Lot of things can change. So let me take that benefit of 3 days and cancel it at a different rate, which may become a benefit, which may even become a disadvantage also, which may even become a disadvantage also. But that is what you want to play around. You want to play around saying that let me come on Jan 3 and cancel it at what? Jan 3 rate. I may even come on Jan 1 and cancel it at Jan 1 rate. See, I was thinking in 3 days, lot of changes will happen. First day itself that has happened. First day itself that has happened. I call the bank. I have come. Please cancel now. I have come. Please cancel now. See, on December 31, I wanted to cancel. The cancellation rate was $77. I knew in 3 days the $77 may go down to 74 or 73. Practically, it doesn't change that much. But somewhere I had this intuition saying that in 3 days this will happen. So I said, let me take this loophole. Let me take the benefit of the grace period and go to the bank on Jan 1, Jan 2 or Jan 3 and cancel it. Because on December 30, on Jan 3, I cannot obviously tell a December 31 rate, which is not logical. This is the only benefit. After this, if you want to take a new contract, please take a new contract. You don't want to take a new contract, don't take a new contract. That is, you came on Jan 2, no, and said just cancel. If you say honor, I'll write the new question. If you say extension, I'll again write the new question. If you say honor, I'll write the new question. If you say extension, I'll write the extension. So let's ignore the third part of it for the time being. Let's ignore the third part of it for the time being. So 1 and 2 will give me cancellation gain or loss. 1 and 2 will give me cancellation gain or loss of the customer. Cancellation gain or loss of the customer. So first 2 items are this. What is cancellation rate? What is cancellation rate? Is the rate at which the contract is cancelled. The rate at which the contract is cancelled, which may not be December 31 rate. It can be Jan 1, Jan 2 or Jan 3, because you wanted to play around with 3 days grace period. You wanted to play around with 3 days grace period. Once you cancelled, there could be a payment or inflow or outflow for the customer. That's called amount payable by the customer. Amount payable by the customer. First, I'll do all this calculation. Then only I'll ask you what you want to do. You says you want to honor at the spot rate. You want to take a new contract, please take a new contract. Let me do all my calculation, then only I want to know what you want to do. Don't tell me that you want to honor, you want to cancel. I don't want to know all of that. After due date, please don't write the third position in the table. Don't write the third position in the table. That can lead to some confusion for you. Is it okay to write? Nothing problem. But the third position can unnecessarily lead to some confusion for you, because when you write the third position, you write something called as a swap loss. There is a swap loss for the customer. There is also a swap loss for the banker here. So if you write two things, you'll unnecessarily get confused. So I don't want you to write the third position in the table. I don't want you to write the third position in the table only for which scenario? After due date. If you write, is there any problem? No problem, provided you have perfect control on numbers, which many a times you may get confused. Okay. Then banker was waiting on December 31. Banker was waiting on December 31. Banker did not know what you want to do. Jan 1, Jan 2, Jan 3, you can come and suddenly do something. FEDI rules has told banker that you have to always take a backup contract. You always have to take a backup contract. So when I took a original contract, he took a backup contract. He took a backup contract. For that backup contract, he cannot tell ICICI and all, please wait. So he has to cancel that contract on December 31. Why he has to cancel? Because you did not come. You did not come. After cancelling that contract, rules tell that you have to take the next available contract. You have to take the next available contract. You have to take the next available contract. In this process, the bank may suffer a loss which is called swap loss of the bank. The bank may suffer a loss which is called swap loss of the bank. Bank will also suffer a cancellation loss. Bank will also suffer a, what is cancellation loss? Comparing 1 and 2. What is swap loss? Comparing 1 and the effective rate. Comparing 1 and the, like you did the table for a bank customer, you will do a table now for the bank. What will you do? Date, position, action, reference date, rate. ICICI's original position with SBI, ICICI's cancellation with SBI, ICICI's new position with SBI, effective rate, loss or gain on cancellation, loss or gain on effective basis. That effective gain or loss, banker will call the customer and tell him to pay. Banker will call the customer and tell him to pay. On the cancellation loss, some interest will be charged. Why is that interest charge? I'll explain later. As we proceed, I'll explain. So you have to pay one cancellation loss, swap loss of the bank, interest charges of the bank. All the three you have to pay. After paying all the three, what will you do? You tell what you want. You want to cancel? Over. You want to honor? Honor it. You want to roll over? Roll over it. After all the three are done. After all the three are done, you have to do this calculation. Clear? Any doubts in this? I'll take a 15 minutes break and then we resume doing the calculation on late honor. Take 5-10 minutes and then just revise what we did, whatever we have done. I'll explain this again after the break. Okay, I'll summarize again what happens if the customer comes after due date. Listen, till now what we did, let me quickly summarize. If it's before due date or after due date, there is an interest element which can come into picture. In that, few question interest rates are not given. Let's ignore, be happy and then keep going ahead and complete the question. If interest rates are given in the question, then you'll have to do our normal table. Date, position, action, reference date and rate. Date, position, action, reference date and rate. You do your normal table, analyze the first transaction, analyze the second transaction, analyze the third transaction, you'll get your effective rate. But ICICI says, please don't write effective rate directly as the final realization. Please write the original rate and the gap between the original and effective is swap gain or swap loss, and the gap between the first rate and the third rate will be the inflow or outflow of the bank. Inflow or outflow of the bank. One thing is you cannot compare them directly because both will be positive rates. That's why you can write the wordings and then see whether there's an inflow or outflow for the bank, and on that bank is going to charge interest or pay interest, and there can be a flat cancellation charges. Then customer does not come on due date. If you do not come on due date, you have only one benefit. One benefit is you have another 3 days of grace period to do your calculation. Whenever a customer does not appear on due date, I need to do two calculation. One from a customer point of view, one from a bank point of view. Customer point of view, I'll stop at 1 and 2. I don't want to do the third one. I don't want to do the third rate. Can I write the third rate? Yes, possible, but I don't want to do the third rate. Unnecessarily complications will come. 1 and 2 will give you cancellation gain or loss. That will answer part 1 and part 2 of the many question. Many question will ask cancellation rate and amount payable by the customer. Then on top of that, you have to do a banker analysis. Banker analysis SBI doing with ICICI. When you do this, please don't look into whatever is the customer side data. As per FEDI rules, you'll have to take the current contract and take the next available contract. Take the next available contract. That is what FEDI rule says. So if you have a contract which is expiring on June 15 and the next contract is June 30, please take the June 30 contract. Take the June 30. You have a contract expiring on June 15 and next contract is June 16. Take the next contract June 16. Take the next available contract. This is as per FEDI rules. Obviously, you will not try to take the 16 because you have 3 days of grace period. So you will work for this 3 days of grace period and do the calculation. Like we have a customer side analysis, banker side will also give you 3. Only difference between customer and banker side analysis, when you do banker with banker, no exchange margin. When you do banker with the banker, no exchange margin, because one bank will deal with other bank what? Without exchange margin. When a bank deals with the customer, with exchange margin, Let's look at this example. No need to write anything. An importer booked a forward contract with a bank on 10th April for USD 2 lakh, due on 10th June. The bank covered its position in the market at what rate? I would not want to know this, because I would want to know what did you do with ICICI Bank. I would want to know what did you do with ICICI Bank. Bank does something with customer, something with another bank. So I would want to know what did you do with the other bank, because without that I will not be able to proceed. So what he did with the other bank is at the rate of 64.28. His plan is very simple. A importer booked no, so he wanted to sell to the importer at what rate? 64.4. What will he do with 64.2? He will buy at the rate of 64.2 from ICICI Bank and sell it at the rate of 64.4. Very happy, 12 paise into 2 lakh, 24,000 profit. Suddenly I get a shock. The shock is the importer came on which day? 13th June and said he wants extension. On 10th June, bank swaps by selling spot and buying 1 month forward. That line is not needed also. That's the FEDI rule. The FEDI rule is you will have to swap by taking the next available contract. So there is a rate given on June 10. There's a rate given on June 13. This is the rate for June 10. I have no idea what do they mean by spot June, but every exam they give. You can understand, this is just for your understanding, that this is the rate from June 11 to 30th June. June 11 to 30th June. Any date on this. This is how exam questions are. And this is the rate from June 14. June 30. This is the rate for July 1 to 30, July 1 to 31, August 1 to 31, August 1 to 31. That is, there is a rate on June 10, there is a rate on June 13. When you want to do the table, you will understand. Let's first do the customer table. Then we'll do the banker table. Then I answer all the 3 together. Customer table. Date, position, action, reference, date and rate. Customer table. Date, position, action, reference, date and rate. Let's just focus on this example first. When did I enter into contract? April 10. April 10. Original position. The heading for this is customer with SBI. Then we will do SBI with ICICI. Customer with SBI. Original position. We are importer, exporter. Buy in bracket ask. What was the date we wanted? What was the rate we have entered the contract at? Negative 64.400 per USD. When did you come back? June 13. Opposite position. I don't want to know what you want to do now, okay? You want to buy, honor, cancel, all that later discussion. Please don't tell me anything now. You have come, first thing what I'll do? Cancel your contract. What is the benefit? I will cancel it at what rate? June 13 rate. Between June 10 and June 13, if a lot of things change, as a customer, I may get benefited. Practically in 1 or 2 days, nothing much will change. But if a lot of things are changing, I get benefited with that. That's the only benefit of the grace period. So, sell, bid. Now comes the exception to the rule. I said both have to match. Both have to match. Now I cannot ask you on June 13 what is the June 10 rate. What, that will be like a stupid question. Asking today what was the March 20 rate. You will say go to March 20 and take the rate. Why are you asking me today what is the March 20 rate? Today March 20 rate. On March 25 I ask you what is March 25 rate. It makes sense because it can change. On March 25 I ask you March 20. On March 21 if I ask you March 25 again it can change. March 22 March 25 again it can change. It can keep changing on a daily basis, but only future can change. How can the past change? How can the past change? So exception to the rule. On June 13 what is the spot bid rate? Exchange margin is how much? Subtract and make it in 0.0025 multiple. 63 point. This 6175 is called cancellation rate. Exam question will ask what is the cancellation rate. This is the cancellation rate. This is the cancellation rate. Cancellation loss or gain. It can be loss, it can be gain. I think it's a loss here. How much is the loss? Sorry? 7825 or tell me the overall loss. Into how many dollars? 1,56,000. So I will tell the customer moment he came on June 13, before even he tells me anything, first give me 1,56,500. Give me 1,56,500. It doesn't end there. He will say I have done your analysis. Let me now do my SBI with ICI analysis, and I'll ask you money from that also. I'll ask you money from there also, because SBI unfortunately had to cancel their original contract and do what? Take the next available contract. Take the next available contract. Any doubts on this? Next, SBI with ICICI. SBI with ICICI. Only merchant rate. No exchange margin. Only merchant rate, no exchange margin. Only merchant rate, no exchange margin. Date, position, action, reference, date and rate. When you do this table, please don't bring customer into picture and confuse yourself. That 64.4 or he cancelled at 63.6175. He did something. I'm least interested in knowing all that. I'm least interested in knowing what did you do with the customer. Before I write, you can write ICICI, sorry, SBI. SBI entered into a contract to sell dollar to customer at 64.44. 64.4. This is of no use, but this will give you the story, because if you understand the story properly, automatically you can write. How can I sell this dollar? I have to buy. How can I sell this dollar? I have to buy. And for that there was a backup contract given. They mentioned on the bank covered is the backup contract. Covered is the backup contract. SBI will sell this. SBI will sell these dollars by buying from ICICI at what rate? 64 point. When I come to this table, I'm least interested in 64.4. I'm least interested in 64.4. Why I wrote this line is because I'll be saying original question is buy ask. Student had lot of doubt because customer also buy ask. Why will the bank will also have buy ask? Shouldn't the bank be sell bid? I'm not doing bank with customer. I'm doing what? Bank with another bank. Bank with another bank. So imagine from ICICI SBI point of view. Imagine from SBI point of view. What SBI wanted to do is they wanted to buy at 64.28 and sell to the customer at what rate? 64.4 and earn what? 12 paise profit. Any doubt? Is there a doubt? Is there a doubt? Clear? Can you proceed? Okay, now write April 10 original question April 10 original position, buy in bracket ask, June 10 INR 64.2800 per USD. As long as you don't confuse by looking at irrelevant numbers, you'll automatically get the answer. If you look at irrelevant, then yes, it leads to challenges. Any doubts till this? I am not interested in analyzing 64.4. That's already done. Let's close. Okay. Now, on June 10, I was waiting for the customer to give me instruction. Unfortunately, this guy said nothing. This guy said nothing. So FedI rules came into picture and said, please cancel and take a new contract. Cancel and take a new contract. So June 10, opposite position, sell in bracket bid. What is the spot bid rate on June 10 for June 10? No exchange margin, nothing. Okay. What's the rate? 63.8000 per USD. This is as per the FedI rules. This is as per the FedI rule. I had to go ahead and do what? Cancel my original contract. Cancel my original contract. Then on June 10, new position. Buy ask. On June 10, new position. Buy ask. On June 10, new position. Buy ask. What did I do? I took the next available contract. What is the next available contract? June 11 to June 30. That spot June is there, no? That is June 11 to June 30. I don't know whether it is 11, 12, 13, 14, 15, 16. I don't know. See, ideally, they should not use two spot USD spot June. It is unnecessarily confusing. It's unnecessarily confusing, but I can't help it. This is how exam question will be. They'll keep using such words only. So basically, this is today's contract, the first one. And the next rate is the next available contract. The next rate is the next available contract. Don't tell me next available is July. If you do that, you will not get marks in exam because that will become error. That will become error. Today, spot USD. Next available is spot June. Spot June. That is the next available contract. That's the next available contract. Is there any logic in this? I have no idea. I can just tell you one thing. Spot USD is June 10. The next one is June 11 to June 30. So that's the next available contract. That's the next available contract. So next available contract, I'm not giving a date also. Next available, I don't want to write a date, you will unnecessarily confuse. Next available. What is the next available ask rate? Negative 63 point. Give me effective rate, cancellation, loss, effective loss. Effective loss is otherwise called swap loss of bank. Effective rate, cancellation loss, effective loss or swap loss of bank. Cancellation is 0.48 or rupees 96,000. Any doubts in this? These are the numbers. As long as you don't confuse yourself, you will get the right answer. If you are confusing yourself, nobody can do anything there because you unnecessarily complicate things by thinking about certain numbers which are not there. I'll repeat the calculation. First is customer analysis, where zero change in what we have been doing. Zero change in what we have been doing. The only change is the effective, the reference date will not match. The reference date will not match. And then I come to SBI with ICICI. Now, what is the use of this? I will tell the customer to pay this. Pay this. Why pay 30,000? Because this is the real loss of the bank. This is the real loss of the bank because effective loss is always the real loss. I have told you effective loss is always the real loss. What will I do on this 96,000? On this I will charge interest. What interest? I have to pay this 96,000 unfortunately to ICICI on June 10. Unfortunately to ICICI I have to pay on when? June 10. You are coming happily on June 13. So first I'll tell, pay me interest on this 9. Why I'm not charging entire 96,000? Because that's not my loss. My loss is only 30,000. My loss is only 30,000 because my new contract is coming at a lower rate. New contract is coming at a lower rate. So SBI is saying, I don't want you to give me 96,000. Give me interest on 96,000 because you did not come. You did not come. So give me interest on what? 96,000. Give me interest on 96,000. Can you tell me 96,000 into what is the rate of interest in the question? Into 3 by 365. Okay, my printed solution has this. For the time being, ignore this. Okay, for the time being, ignore this calculation, ignore loss on cancellation. Sorry, consider loss on cancellation and total loss on cancellation, but ignore effective loss. All that I don't need. All that I don't need. Unnecessarily, it'll complicate things for you. When you do customer side analysis, this is customer side analysis. I just want two numbers: original rate, opposite rate, and be done with it. Okay. So these are the numbers you have in your notebook. Cancellation rate 63.6175, amount payable 156,500, swap loss 30,000, interest on outlay fund 95, and then there will be a new contract. There will be a new contract. What is a new contract? Depends on if you want to enter into a new contract. What did the question say? He wanted to honor when? 10th August. So please use the 10th August rate from here. Please use the 10th August rate from 64.18/25. You take the 10th August rate because that's the rate for August 1. Why this side? Because you are coming on June 13. You are coming on June 13. So on June 13, what is the August 10 rate? 64.18 or 25, whichever is the relevant rate. Add or subtract the exchange margin. Add or subtract the exchange margin. Go through this for a minute. Go through. Okay. There was one question on something called as a time value and a currency fluctuation component. There was something called as a time value component and a currency fluctuation component. This question is not purely a forward contract question. I can discuss it anywhere I want to. So let me first discuss this. Time value of money component is the discount a company can get by making early payment. Amount of discount a company can get by making early payment. 2 by 10 net 30. This is how discount terms are practically mentioned. What does this mean is you will get 2% discount if the payment is done in 10 days. Otherwise, you have to make the payment when? 30 days. Otherwise, you have to make the payment on 30 days. What is currency fluctuation component? There are two components which will come. What are these components? You'll understand. Currency fluctuation component is today the rate is 85. If you wait and pay, it will be 87. So you have to pay extra 2. You have to pay extra 2. That's called currency fluctuation component. Example, I have USD 1 lakh India imports. Firm in New York offers 2 by 10 net 90 terms. 2 by 10 net 90. What is 2 by 10 net 90s? You will get 2% discount if you make the payment in 10 days. Otherwise, you have to make the payment on when? 90 days. Today the rate is 55. 90-day forward rate is 56. How much is the time value of money component? Protection from currency fluctuation. I'll explain that. Tell me, if you pay today, what is the outflow? If you pay today, what is the outflow? If you pay today, what is your outflow? Will you pay $1 lakh? You'll pay how much? 98,000 into what? Assuming 55 is the rate which is there till day 10. Till day 10, that's the same rate, okay? What is the payment? 98,000 into 55 is? If you wait and pay how much? 1 lakh into? The gap is how much? 2 lakh 10. That is the extra payout because you lose interest and currency is fluctuating. Because you lose interest and currency is fluctuating. Now this can be answered in two different ways. It is like when you do your material variances in standard costing. In costing, when you do variances, there's a price variance and a usage variance. Price variance, the difference in price was multiplied with actual quantity. There's another view that the difference in price can be multiplied with even standard quantity. So something like that is here. Now 1 rupee difference is there. 1 rupee difference is there. You can multiply this 1 rupee difference with 98. or you can multiply with 1 lakh. 1 rupee difference can be multiplied with 98,000 or 1 lakh. If you multiply with 98,000, currency fluctuation is 98,000. Balance 1 lakh 12 is cash discount component. Balance 1 lakh 12 is cash discount component. If you multiply this 1 rupee with 1 lakh dollar, with 1 lakh dollar, then the balance is what? 1 lakh 10,000. So the cash discount is $2,000. I said no. The 2,000 can be multiplied with 55, 56. Can be multiplied with 55 or 56. The $2,000, which is your discount, if you multiply with 55, 1 lakh 10 is the discount. Balance 1 lakh is the currency fluctuation. Balance 1 lakh is the currency fluctuation. Two approaches are possible. What ICI has told is whatever discount you get, $2,000, you multiply this with the exchange rate on due date. Exchange rate on due date. If you tell me, can I do today's rate? Can I do? Logically, yes. I don't have an answer to that. I don't have a no or yes to that. Both can be debated on. This is there in the ICI material. This is there in the ICI material. That is, you multiply with what? Exchange rate on the due date. On the due date, what is the exchange rate? 56, which means discount is 112. Balance 98,000 is the component of currency fluctuation on $98,000. Now don't do it on $1 lakh. Now don't do it on $1 lakh. That is, either you follow a combination of 50, for cash discount use 56, and for currency fluctuation use 98,000, or for cash discount use 55, for currency fluctuation use 1 lakh. You cannot do both. You cannot do both because the component will increase. The component will increase. So here 2 lakh 10, time value of money component is 1 lakh minus 98,000 into 56. 1 lakh minus, that is the discount is multiplied with 56. Discount is multiplied with 56. Can I multiply with 55? If you ask me, I don't have a no to it. I don't have a no. I cannot say no to that. I'm only telling you this is what ICI has done. Please follow this in exam. If they ask you currency fluctuation component and something called as a cash discount component, I can explain you the logic. Logic is very simple. Time value of money is basically the discount you get by making early payment. Is the discount you get by making early payment. How much discount you get? $2,000. Now you are asking me, should I multiply with 55 or 56? I don't have an answer to that. I don't have an answer to that. Both are okay. We will follow what ICI has done. We will follow what ICI has done, and ICI has multiplied with what I said, 56. ICI has multiplied with 56. Balance is your other component. Clear? Any doubts on this? This is what that question was. Okay, in one exam question, ICI asked something like this. There is a logical gap on this. Just read this, I'll explain. You first read this. There is a logical gap in this. If it repeats in exam, you can do it. Same question. Okay. First you read this fully. Okay, let me explain. A company gets a 60-day bill from customer. What is 60-day bill from customer? Is customer will pay after 60 days. Customer will pay after 60 days, but there is a transit period. Transit period is how much? 20 days. When you're exporting, it can take a lot of time for it to reach. So customer will now pay only after 80 days. Customer will pay after 80 days. So I wanted to take a forward contract for 80 days. Question had data on 2 month and 3 month. I said if you have 2 month and 3 month, relevant is 2.67, round it off to 2 months and take the 2 month contract rate. Take the 2 month contract rate. Why 2 month? I have no idea. I thought I'll use interpolation. 2 month, 3 month, calculate in between 80 days. Calculate in between 80 days. Same question gets repeated. Again, I'm talking only about same question gets repeated in exam. Please do it. Some other question, interpolation possible, please do interpolation. Okay, don't get into the same question gets repeated, and it can also happen that the same question gets repeated and ICI does interpolation also. So these are unfortunate things. They may correct the error which they have done. Logically, I'll have to do interpolation. I don't want to deviate my answer because many times I deviate, then student keep asking, should I do this? Should I do that? Now I'm in a very tricky situation. If I say follow the logical answer, ICI doesn't award marks. I feel bad about it. So I say follow ICA solution. Then you ask me it's not logical. Then what should I do? Why are you asking me this question? What should I tell you? You are asking me a question. You expect an answer from me. If I tell you follow 2, then you are saying why should I not follow 1? If I say follow 1, you are saying why should I not follow 2? Then what should I as a faculty tell you? So these are elements which are not under our control. So question said you calculate the forward rate. Which forward rate? 2 months. Question also said interest is to be calculated. Now what is interest is to be calculated is you sold the goods today. You sold the goods today. You're going to get money after 80 days. You're going to get money after 80 days. Now I was thinking what is interest in this? Then the logic is when you sold the goods, no, you produced it. How did you produce? By taking a loan. How did you produce the goods? By taking a loan, because you need money to produce the goods. You need to buy raw material. You need to pay your laborer. So understanding is that you produced it by taking a loan, and after 80 days you get the money. So for 80 days charge interest. For 80 days charge interest. Let's take an example. Measures Sky Products of Mumbai, an exporter of seaboods, has submitted a 60-day bill. For euro 5 lakh drawn under an irrevocable letter of credit for negotiation. Company desires to keep 50% of the bill in EFC. 50% of the bill in EFC. Transit period is 20 days. Interest on, okay, this is not pre-shipment. Interest on what? Post shipment. What is post shipment? Is after the shipment is done, you take a loan. After the shipment is done, you take a loan. How do you take a loan after doing the shipment? You'll understand. The inflow will be realized at an effective rate of what? 80. How much would the interest be paid by the company? This 80 is the rate at which you will realize. What is the bill amount you have? 5 lakh euros. 5 lakh euro. I go to the bank and tell, in this 2 lakh 50 euro, I'll keep it in my EFC account, foreign exchange earners account. Balance 2 lakh 50, I show it to me as a security and take a loan. Only balance 2 lakh 50 you can take a loan. Only balance 2 lakh 50 you can take a loan. Why you cannot take it on entire 5 lakh? Because you are not planning to realize 50% of the money. What you can do is in the international parlance, you can get the money and keep it in dollar itself. What is the use of this? If you keep it in dollar, you can use it to pay. In this process, converting dollar into INR into dollar is not needed. So you save bid and ask. You save bid and ask spread. So in this case, I took this bill with me. You are the banker. I gave you the bill. Told, give me a loan. He says, I will not give you loan for entire 5 lakh euros. I'll give you loan for how much only? 2 lakh 50,000 euros. So now write interest is equal to 2 lakh 50 euros into 80 2 lakh 50 euros into 80. Would it be 80? Logically no, but that's the effective rate the question is talking about. Into 80. How many days interest you will charge? 80 by 360. 80 by 360. 360 is the question words used there. Sorry. Rate of interest is how much? Rate of interest, tell me. Into 8%. Add a 8% there. Add a 8% interest. Question is asking you to calculate interest, no? It was a bigger question. I've broken down into 2-3 questions. I'll show you the question. I'll show you the question in a minute. See, you have two types of loan. One is called pre-shipment loan and second is called post-shipment loan. It's technically called packing credit. Practically what happens is, when I want to start manufacturing, I have to buy raw material. So for buying raw material, I'll take a loan. This loan will be closed by taking a post-shipment loan. Before, see, pre-shipment is loan against inventory. Post-shipment is loan against receivables. You wanted to buy inventory. In the balance sheet, you have inventory. Against that, you have a loan. Inventory sold, loan has to be closed. But I don't get the money because inventory has become receivable. So I convert the pre-shipment loan into a post-shipment loan, which is against receivables of the company. This is what practically happens. The next example is that the illogical part. I have a 60-day bill. Transit period is 20 days. I have 1, 2, 3, which is the relevant exchange rate. 2 months. You have to round off to 2 months. Okay. In one exam question, ICI asked something like this. Go through this first. There's nothing much there. Just go through this first. There isn't much to calculate there. It's just a quick concept discussion. What is the question's requirement? Contribution to sales ratio, whether it should hedge its exposure risk or not. Now, I've done sales worth 78 lakh. I want you to calculate and give me the answer. If I hedge, I'll realize at this rate. Division, multiplication, which rate? You decide properly and tell me. 78 lakh into our division and which rate? I have no idea. You can decide. Okay, division what rate? Sure, confirm. Can you do known unknown component? Can you do known unknown component? Can you please do known unknown component, guys? Please. Because I've answered this question at least 5 times to students and I'm very tired answering the same doubts of the students. So can you please do it? You gave me answer. I want you to check again. You may be right also. You may be right. But my mind is saying 2.427. So you check and let me know. And then you will say ICI is not awarding marks. Then you will say you did everything perfect. ICI is not awarding marks. What should I do? It will be, I think, bid rate, but it will become 1 by ask. It will ultimately become 1 by ask. I think that is what will happen in this question. That is what I remember. Now, after doing all this, I'll give you a very short way of doing question, which will work in 99% of the questions. 78 lakh divided by 2.397 is how much? Write that number. Write the number. And 78 lakh divided by 2.427 is how much? This is how I resolve most of my doubts where I want quick answer. Wherever I'm looking for quick answer, this is my approach. If you are going to collect something, bank will give you the lower amount. Bank will only give you the lower amount. The bid and ask rate will be used in such a manner that when you use both the rates and you are planning to realize something, it will be the lower realization. And if you are planning to pay something, it will be the higher payout. It will be the higher payout. This is something which I keep doing in my mind. That is what I did. And I thought it should be 2.427. Let's see. Again, I'm not sure. Yeah, 2.427. And if you realize it at the spot rate, that is 3-month spot rate, that is not today's rate. Today's rate realization cannot happen. Today's rate realization cannot happen. So if you realize it's 32 lakh, and if you don't hedge, it is 31 lakh. If you don't hedge, it is 31 lakh. I can say for Japanese yen, forward contract is better. For USA, spot is better. For Europe, hedging is better. But question said average contribution. You don't tell me to do separate analysis for 1, separate for 2, separate for 3. I have one policy, either hedge or no hedge. Don't tell me do one policy for USD, do one policy for Europe, do one policy for Japanese yen. I don't have time for all that. My job is to do business. As a CFO, tell me which policy we want to adopt, either hedge full or no hedge. So if you hedge fully, 19.56%. If you don't hedge, 19.17. So go ahead and hedge all the three. Go ahead and hedge all the three. Logically speaking, USD should not be hedged. USD should not be hedged, but I'm not here to do separate analysis. Let me do a single analysis and then be done with it. I will do a single analysis and be done. How to calculate contribution and all, don't ask me now, okay? Sales less variable cost, all that calculation is your headache. I don't want to get into all that part of the computation. What students made mistake is, one, they did individual analysis, which I also did first time. I also thought individual analysis only, but because they used the word average contribution. And second problem is division multiplication. And I have answered this bid rate doubt at least to 15 students, because everyone would have messaged me at different points of time. Why are you not using 2.9397? Mind is very clear. Okay, we are selling, bank is buying, bid rate, that's all. Beyond that, there is no thought process, zero thought beyond that. Bid rate, only thing you have decided is you want to use bid rate. You have already decided that, then how do I answer that doubt? That's why I said do known and unknown. And I told you, first class, when I started, I said we will discuss after some time and you will make a mistake, and see, you made a mistake now. You made a mistake now. This is natural for you to make a mistake unless you go through detailed calculation. You may think that my approach takes little bit extra time, but it's worth taking that time. It's worth taking that time, because moment you think you are confident, ICA will surely put a surprise there. They will put a surprise element there. So this was the last concept in this area. Technically, whatever I've done in forward contract, even without reading the bigger book, with this itself you can kind of summarize everything. We should compute average contribution to sales ratio for all currencies together and compute it. We will have one ratio if hedging is done and another ratio if hedging is not done. Based on this analysis, we have to decide whether to go for hedging or not, all together, no separate analysis. Time value and currency fluctuation component, I explained. I have an example. I need to move to money market hedge. I take a 15-minute break. We will revise forward contract after 15-minute break, because I cannot revise the entire chapter together. So entire forward contract would be revised after the 15-minute break, and then I go to MMH and then we take the third break. That's your lunch break. Okay, let's resume now. So I'll quickly summarize what we did in forward contract. Guys, please. Let's quickly summarize what we did in forward contract. So we learned forward contract is basically used to freeze a future interest rate or an exchange rate or a commodity price. Anything can be done. It is a OTC product because it is an over-the-counter product which can be customized according to my requirement. So technically, I don't have all those challenges which are there, like basis risk or number of contract in decimals. All those challenges do not come because I'll customize according to my own requirements. Now, the basic rule is very simple. In case of a receivable, take a forward contract if you realize more. In case of a payable, take a forward contract if you're going to pay less. What is the cover rate? Cover rate refers to the rate at which the contract is getting executed. One, it can be done through IRPT. If IRPT is not given or not possible, then you go through an approach called spot rate plus upfront premium plus interest on upfront premium. Spot rate minus upfront premium minus interest on upfront premium. The cover rate will give you realization using forward rate or payable using forward rate. Compare that with realization using spot rate or payable using spot rate, and the gap. The gap is technically called as your gain or loss due to forward contract. Then there's another type of a loss which you can calculate, which is with hedging and without hedging. That is, today if you realize this is the payment, with forward contract this is the payment, that difference is called expected gain or loss with hedging. Today this is the realization. Tomorrow without hedging this is the realization. Expected loss or gain without hedging. Relevant forward contract rate. If you have a data which says that you are selling something and it will realize in 60 days, there's a transit period. We round off to the number of months and then we round off to the lower number. 2.67 was rounded off to 2 months. Interest calculation will be calculated for the amount of transit period against the loan which you have taken. Loan taken is equal to receivable which is going to be realized ultimately. Receivable which is going to be realized ultimately into the exchange rate. Any doubts on this? The next part is closure of forward contract. A forward contract can get closed in multiple ways. There are 9 ways of closing a forward contract. One is honor, second is rollover, and third is your cancellation. This can happen on due date, before due date, after due date. whichever approach you do, other than honor on due date, everything will involve cancellation. Wherever you're doing before, interest calculation is needed. Wherever you're doing after, interest and banker analysis needed. Interest and banker analysis is needed. Now, how I do this analysis? First, I do date, position, action, reference date, and rate. First is the original contract, then there's an opposite contract, then there may be a new contract, gives you effective rate, cancellation loss, effective loss. This is normal problem. Then if you do early honor, then interest calculation needs to be done. This part of it you do, effective rate you can write, cancellation loss you can write, effective loss you can write, but you will have to ultimately write saying that I honor as per the original spot rate, original contracted rate, and then I do something called as a cancellation loss or swap, sorry, effective loss or swap loss, effective loss or swap loss. On top of it, there will be a charge of interest by the banker, which is calculated by comparing rate 1 and rate 3 into the number of days you are early into the rate interest rate. The banker may also pay interest, the banker may also receive interest. Then you do not come on due date, which is grace period comes into picture, which is a 3-day grace period. Again, date, position, action, reference date, and rate calculation. Grace period, the benefit of the grace period is instead of contract getting cancelled on the November 30 date, I get the benefit of using a December 1 or a December 2 or a December 3 date. First do the customer analysis, only 1 and 2, don't do the third rate, don't do the third rate, and calculate the cancellation rate, cancellation loss. Cancellation rate is the rate at which the contract got cancelled. Amount payable on that is called as the cancellation loss. Then do the banker analysis where there will be an original contract, opposite cancellation contract, and he has to take a new contract. He has to take a new contract. That new contract will be taken by the banker, and this will give you cancellation loss, effective loss. Effective loss will be recovered from the customer. Cancellation loss, interest will be charged, and then whatever you are doing needs to be considered. Then we did few more concepts. One is average contribution to sales ratio, where you combine all the securities together, all the currencies together, and calculate average contribution to sales if hedging is done, if hedging is not done. Time value and currency fluctuation component. Time value is the amount of cash discount into the exchange rate on due date. Currency fluctuation component is the difference, which is technically the difference in the two exchange rate into whatever payment you are doing post the discount. Overall value you get, and then split into two. Now I move to the next area, which is called money market hedge. I think we just need to cover money market hedge. Currency futures and options, we have already done futures and options. Same analysis needs to be done. Now directly a question on money market hedge so that you get clarity on that. Go through question 78. It is the rule, that's all. Grace period only gives you the flexibility of, yeah, Federal rule. The grace period can only give you that rate. Instead of using a November 30 rate, you can use a December 1, 2 or 3 rate. That's all. That's the only benefit. Not a good, well, it depends. Okay, let's come to this. An exporter is a UK based company. Invoice amount is 3,50,000. Credit period 3 months. Exchange rate in London. 3-month forward rate. Rate of interest. Compute and show how a money market hedge can be put. Compare and contrast the outcome with a forward contract. Assume I do forward contract. 3,50,000 into or divided by which of these rates? 3-month forward into or division. Tell me and which rate. If you have a doubt, please go through known unknown. Whenever INR is not there, be little cautious. That's the only thing I can tell you. 3,50,000 into or division and what rate? INR not there. Caution is very critical. Okay, okay. Forward contract is done. Now let's discuss the money market hedge. Let's discuss the money market hedge. Money market hedge is very simple. There are series of steps. I'm not going to give any of the step. I'm not going to give you any of the step. Open a balance sheet. Open a balance sheet. In exam, don't write it as balance sheet, but these are the steps. Liabilities, amount, asset, amount. Liability, amount, asset, amount. What is that 3,50,000? Is it a liability or an asset for me? asset, debtor. How much is the debtor? Which currency? Debtor USD 3,50,000. Which country I am in? UK. So I have a problem. What it will realize? I go to the bank. Okay, I go to the bank and take a loan against this. Take a loan against USD loan. USD loan. What is the USD loan rate? 9% is for a year. 9% is for a year. 9% is for a year. So how much is the proportionate rate? Tell me the amount of loan you took. 3 lakh 42. Okay, I'm not writing the decimal. I can write the decimal part also. So I went to the bank. I showed them the debtor. Told them give me a loan. Which is my country? UK. I don't need this money. Okay, I don't need this money. I got it from the bank. I got it from the bank. I want to create a GBP deposit. My country. So convert this using the spot rate. Convert this using the spot rate and tell me how much you have. Convert this using the spot rate. Division, multiplication, please take care. Divided, multiplied. By what rate? 1 point. I am going by whatever you guys are saying. I'm not even applying my mind, okay, as of now. I'm going by whatever you guys are saying. If it's wrong, then we'll have to change the answer. What's the GBP deposit? What's the rate of interest you learn on GBP deposit? 5% is for a year. 5% is for a year. Any doubts on 215, 206? I don't know. I'm going by whatever you guys are telling me. Okay, now what is happening in a money market hedges? I was to receive USD 3,50,000. I went to the bank, told them give me a USD loan. He gave me this loan. I took this money, converted into GBP. Converted into GBP. After converting this into GBP, on the last day, add interest on this and tell me how much you will realize. Add interest on this. 1.25% interest. 1.25% is for a year. 217. 8. Now I'll explain step by step. First, identify whether a foreign currency asset or a liability exists. There was an asset, against that I created a foreign currency liability. Against that I created a foreign currency liability. I converted that into GBP, which is my home currency. On the last day, this guy will pay me this amount and I will close this loan. He will pay me this amount and I will close this loan. Exchange rate went up. No botheration, because I will get 3,50,000, I will close 3,50,000. I will get 3,50,000 and I will close 3,50,000. Exchange rate went down. No problem. I'll get 3,50,000, I'll close 3,50,000. My job was very simple. Get 350, close 350. What is my ultimate realization? 217,896. Ultimately, my home currency is GBP. My home currency is GBP. So I'll ultimately realize what? 217,896, irrespective of whatever happens to exchange rate. Irrespective of whatever happens to exchange rate. In short, you have converted a foreign currency asset of a debtor into a home currency asset of a GBP deposit. Into a home currency asset of a GBP deposit. GBP is your home currency. GBP is your home currency. Understand the calculation. Steps will be there. 217. Answer is wrong. Where did you make a mistake? 215. This is 215, 215. You divided by the right number. Why did you tell me the wrong answer? 217. Guys, calculation part I cannot worry into it. I don't want to get into the calculation. Again, I'm repeating. I'll show the next question again with the balance sheet. You understand that. Thereafter, your wish, you want to do balance sheet way, do it balance sheet way. You want to do the steps, you do the step way. But practically, this is what is happening. What happened? I had this asset. Against this, I took a loan, converted today, invested, got the money from the supplier and repaid the loan. Got the money from the supplier and repaid the loan, and ultimately this is my realization. Ultimately, this is my realization. Here, this is the realization. Which is better? Money market is better. So I'll do money market hedge. I'll do money market hedge. Let's come to 79. Let's come to 79. A UK company owes a German company 25 lakh euros payable in 3 months. Spot rate 1.25-1.27. Company can borrow pounds, deposit pounds, borrow euro, deposit euro. What is the cost of money market hedge? Listen, some question will not even tell money market hedge, but if they give you interest rates like this, only MMH is possible. Only MMH is possible. Any doubts on this first? Any doubts on the question? Very simple, straightforward question. Let's create the balance sheet. Which country we are in? UK. Liability, asset. So liability amount, asset amount. Liability, asset, asset, liability amount, asset amount. This please do known unknown, otherwise you'll surely make mistakes. You will surely make mistakes here. You'll understand when I explain this. Tell me, what is the asset or liability I have? Creditor euro 25 lakh. Against this, please give me a euro deposit which I'll create today. I want to create. I'm not creating as of now, but I want to create. Euro deposit. How many months is this? 25 lakh divided by 1 plus 2.5%. Euro how much? 24 lakh. 39,000. 0. I want to create this deposit now. I want to create this deposit. Many times students think you have this money hand. I don't have this money hand. I want to create this deposit today. I want to create this deposit today. Below the table, known component. Euro 24 lakh 39,000 24, which I want to buy. Why I want to buy? So that I can create a deposit. I want to buy this and put it in a fixed deposit. I want to buy this and put it in a fixed deposit. Unknown component. What is my home currency? What I am trying to calculate is, I'll take a GBP loan today. I'll take a GBP loan today. Listen, I'll take a GBP loan today. After taking the loan, I will use that loan to buy 24 lakh 39,024 euros. I will use that to buy what? 24 lakh 39,024 euro. When they do this part of the calculation, many students think I have euros in hand and I'm selling it. No, I'm not selling euros. I'm not selling euros. Many think, because the question will say euros has to be converted into GBP. So your mind thinks that you have euro in hand and you are converting it to GBP. No, you don't have euros in hand. You don't have euros in hand. You are trying to buy euros. You are trying to buy euros. So do the calculation. GBP is equal to euro into GBP per, what's the denominator currency? Euro. What are you doing? Buying. What is the bank doing? Bank will sell it. Ask rate. If you have GBP per euro, okay. Otherwise, tell me 1 by bit. 1 point. What's the amount you get? 19 lakh. Any doubts on this? Now, what we have done indirectly is, I have converted a foreign currency liability into a home currency GBP loan. Into a home currency GBP loan. What will happen on the last day? I will redeem the euro deposit and pay my supplier. Redeem the euro deposit and pay my supplier. On this 19 lakh loan you took, you have to pay interest, and that is your final outflow. That is your final outflow. On the 19 lakh loan, what is the rate of interest of 8% for a year? 2%. 19 lakh 90,243. 19 lakh 90,243. This is including the loan. This is including the loan. I'll be touching upon money market hedge again when I go to comprehensive question. When I go to comprehensive question, I'll again touch upon money market hedge. Only thing you need to do is imagine the balance sheet and do it. In exam for steps purpose, your wish. You want to do it in balance sheet format, then do it little in a neat form and then explain it. Or you do the steps this way. Now let's just test a little bit of this. If you have got it properly, tell me the answer to this. If you have understood, you'll be able to tell me this. We are having a foreign currency asset. Against that, I'll create a foreign currency liability. Against that, I'll create a foreign currency liability. When I create a liability, what is the rate of interest? 8% per annum. So for 6 months, it is 4%. Any doubts on this? Tell me this. It will involve known unknown component. Don't try it in a hurry. You will surely get it wrong. Think through and then give me the answer. Foreign currency asset liability. Participate, guys. First, tell me what is the foreign currency asset you want. How much amount you want asset? 10 lakh divided by what? 1 plus 2%. How much is that? 9. If you want to buy 9,80,392 dollars, that's the known component. Unknown component is question mark INR. INR is equal to USD into INR per USD. I am planning to buy USD. Bank is going to sell. Bank will sell at ask rate, which is 81.60. Which is 81.60. Multiply. Tell me the answer to this. Foreign currency asset, foreign currency liability. Foreign currency asset. Against a foreign currency asset, I want a foreign currency liability. What is the foreign currency here? USD. So it should borrow in USD and create a deposit in INR. Borrow in USD and create a deposit in INR to complete MMH. Okay. Think and tell me what is the answer to this. You see how do you want to answer this? MMH, all steps done. I've given the final number there. money market hedge, it is 20 lakh amount paid. If you take a forward contract, 25 lakh into or divided by what? 1 point? What's that amount? So I'll obviously go with money market hedge. Clear? Any doubts on this? So we'll do currency futures. Currency futures is same as normal future. There's only one headache with currency futures. The headache is, for example, I wanted to buy 10 lakh shares of TCS. So you did date, position, action, reference date, you calculated the amount to be hedged and then divided by the number of contract, divided by the value of one contract and got the number of contract. The problem is the quote today given is rupees 3000 per share of TCS. 3000 per share of TCS. You are saying you want to buy TCS or you are saying you want to sell TCS. You are doing hedging, everything is perfect. When I come to currency, the rate today is USD 1.5 per GBP. USD 1.5 per GBP. Now the question may say you want to buy GBP. Question sometimes may even say you want to buy US dollar. See, understand the two quotes. When we were doing normal, the product is very clear and you want to buy or sell the product. Here the question may say that you want to buy the price. You may want to buy the price, where the analysis is exactly reverse. Where the analysis goes exactly reverse. You are saying that you want to buy US dollar. You don't want to buy GBP. If you are planning to buy US dollar, it means you are selling GBP. Which means my original contract is sell. And not buy. Because in futures what we did two calculation. One on the last day, the amount will get realized at what? At the spot rate. And then you have to do date, position, action, reference date, rate, calculate profit or loss. In that you write on original position, no? So question saw exporter. Student, very clear. Exporter, original position sell. Importer, original position buy. And the answer is opposite. Reason for that is your exposure currency and the contract currency may match, may not match. It may match or may not match. So whenever I do a currency future, I will write it like this: USD 1.5 per GBP. In bracket I'll say this is the rate at which you can buy GBP and sell GBP. And if you want, no two rates here, no bid rate, no ask rate and all. If you want to buy GBP, 1.5. You want to sell GBP also, 1.5. But you cannot buy USD with this. You will have to reverse the rate. We don't get into reversing rate and all. We will leave the rate as it is. No concept of reversing the rate. Then how do we solve? You will understand. Let's take an example. Currency futures operate similarly to regular future with the distinction of involving what? Two currencies. This differs from standard futures. Standard futures is what? INR is typically paired with another commodity. Our format: amount of exposure, size of one contract, number of contract, action taken. The headache is this: exposure currency versus contract currency. We should ensure that the exposure currency and contract currency is same for computing number of contract. In case they are not same, we should convert the exposure, not the quote. 1.5 cannot be converted. What can be converted? 10 lakh dollar can become 6 lakh pounds. 6 lakh pounds can become 10 lakh dollar. Don't go and touch the rate. Go and touch the amount. And then you can do it. Format for computing future settlement, you very well know: date, position, action, reference date and rate. In futures, we will have to pay some margin money. What is the margin money? Like we have been normally paying, like we normally do that. The only thing is, question will give margin money. When is margin money paid? Day 0. When will you get this money? After 3 months or 6 months. So you have to consider interest on margin money. Many students ask why margin money is not considered. Margin money is not my expense. What is my expense? Interest on margin money. Let's take this example. Things will become very clear to you. XYZ is an export-oriented business house based in Mumbai. Company invoices its customer. It has a receipt of USD 1 lakh which is due on September 1. Currency future size is 4 lakh 72. September futures is quoting at USD 0.02118. On September 1, the spot rate and the futures rate is not matching, which leads to basis risk. What will be my futures profit or loss on maturity date? To calculate futures profit or loss, I need date, position, action, reference date, and rate. And I also want to know how many contracts did you do? Working note 1, computation of number of contract. Working note 1, computation of number of contract. Computation of number of contract. Particulars amount. Particulars amount. Amount of one exposure. Exposure. That is, what is the receivable or payable I have? USD 1 lakh. Size of one contract. Currency with currency. Now I get the headache. I cannot divide them. Why I cannot divide? Because one is in USD, other one is in INR. What is the futures rate given in the question? Futures rate. 0 to, please convert 1 lakh into INR using this rate. Futures rate. Using the futures rate. R INR 47 lakh. If those two risks I said no, that is number of contract in decimal, and the basis risk is not there, final realization will be 47 lakh 21,435. Final realization will be 47 lakh 21,000. You need not do any step. Finally, you will get 47 21 435 if those two risks are not there. 47 21 435. Tell me the number of contract. 10 point something came, or exactly 10? Which means there is a issue with the number of contract. Number of contract is 10. Action which I am planning to do. What is my action is, listen. Sell dollars and buy INR. I am writing it here, okay? Now I am writing it. Later on I don't want to write. I plan to sell dollars and buy INR. Why sell dollars? Because I'll be getting $1 lakh. So my plan is to sell this 1 lakh. $1 lakh after what time period? Whatever time period the question gives. So if you're selling dollar, it means what? You are buying INR. Any doubts on this? You are planning to sell dollars and buy INR. It has a lot of implication in the calculation. Next, futures profit or loss. Futures profit or loss. Date, position, action, reference date, and rate. Date, position, action, reference date, and rate. Date, position, action, reference date, and rate. Day 0, original position. I don't want you to write the action. September 1, the rate was USD 0.02118 per INR. USD 0.02118 per INR. Now my question to you, tell me what are you going to do with INR? Because INR is the product. What are you going to do with INR? What did you write above? Buy. Many students write this as sell because their mind has told he is an exporter. And you end up writing sell. It's not sell, it is what? Buy INR. I'm buying INR. Any doubts on this? Yes. Because that is what you do, no? Rupee 3,000 per TCS. You always were telling for TCS. There no confusion was there because only TCS was the product currency. If I tell the quote is TCS 0.01 per rupee, then only confusion will come. In Forex, that confusion can happen. Buy means, please put it in bracket. September 1, opposite position. Only benefit is no bid and ask here. Okay, ask on September, sorry, sell on September 1. What is the sell rate for September 1 in futures market? 02134. There is that basis risk slight bit there. Slight bit of basis risk is there. Okay, let's not worry about that. 0.02 what? 134. Add this together, profit or loss. USD, please write. Don't write the number directly. You will end up making a mistake. USD 0. What? 0 00016 per INR. The profit is per INR. So final profit is calculated in US dollar. The profit is calculated in US dollar. For example, if you make profit rupees 5 per TCS, your final profit is rupees. Nowhere you would thought that the profit will be TCS. Here your mind is thinking INR is my currency, so profit should be in INR. No, INR is your currency, but INR is the product here. INR is the product. That is why I wrote USD 0.00016 per INR. Total profit 0.00016 into 10 contract into what was the size of one contract? Multiply all this. USD how much? To solve the question, we will convert this into INR in the end because INR is our final calculation. In this MCQ, this is sufficient. USD 755.20. How will you convert this into INR? Using this rate 0.02133. Using 0.02133. In this case, we will enter into a buy contract as we are planning to sell USD and buy INR. INR is the product currency and hence it will be buy contract. Yeah, tell me. Price today is rupees 3000 per TCS. Price tomorrow is 3200 per TCS. Tell me what's the profit? Rupees 200 or TCS 200? Why not TCS 200?
That is okay, but when we do
Same thing, no? It's the same thing, no? You see both. Is there any difference in this? INR is the product now. So how can I say profit is INR so much? USD 0.00016 per INR. See, the point is it could be little different from the normal scenario. That is why I am discussing this. If it is a normal scenario, I wouldn't have discussed this, no? So profit is rupees 200 per TCS and you will multiply and say finally profit is rupees so much. Similarly, USD so much, USD so much, USD so much, final profit is USD. Final profit is USD. How can my final profit be INR? Any doubts in this? This itself is maybe, this is relatively better. You can have two currency where INR is not there, where a lot of confusion will come. So that is why be clear on your thought process. Be clear on the thought process. As long as you have clarity on your thought, things will become simpler. If you keep thinking about 1000 things and suddenly you start solving, when you are solving an exam question, my friend told Forex is difficult. My relative told Forex is difficult. This person told Forex is difficult. Everyone told Forex is difficult. Then you make wrong answer only. You are thinking about so many things rather than solving the question. Again, I am repeating. As long as you solve question with the right thought process, you will get the answer. If you are thinking about too many things, I cannot help it. I cannot help there. Let's look at the next example. Put it the same way. Put the number of contract and calculate date, position, action, reference date and rate. First put the number of contract, size of exposure, amount of one contract, number of contract. Right size of exposure, amount of one contract, all that you do it. Exactly same way, please guys, I want you to do this. Exposure, size of one contract, number of contract, action, and then futures profit or loss calculation. If you don't find something, let me know, I'll tell you. Contract size, if not given, is equal to the amount of exposure. Is equal to the amount of exposure. What is the amount of exposure?
4 lakh USD.
4 lakh USD. What is the exchange rate? 44 per USD. So the product currency is USD. The product currency is USD. So my size of one contract is also USD 4 lakh. My size of one contract is also USD 4 lakh, which means number of contract is 1. I don't have the decimal issue. I don't have the decimal issue. After writing this, please write action. What are you doing with dollar? What are you doing with INR? And then only do the next table. This table will not give you confusion because this is the normal way of understanding. This question will not confuse you. Please do date, position, action, reference date and rate. Some of the formats are there to save lot of your time. If you follow that properly, you will get the answer. Otherwise, it will happen what happened to that average contribution to sales ratio example.
The March dollar future.
So then write March 31. March dollar future is given means. I wanted 15th February. I don't have 15th February. I'm taking March contract. Whatever is available in futures contract, you can take only what is. See, in forward contract, you can get Feb 15. In futures contract, you may not get exact date. So take whatever is available. On Feb 15, what is the March 15 futures rate? Profit loss 4 per USD. 4 into 4 lakh is 16 lakh profit. 4 into 4 lakh, this profit is in rupees. This profit is in rupees. Any doubts on this? Now let me discuss the option contract part of it. Again in concept book. Now in option contract also I have the same headache. What's the headache is your exposure currency and contract currency may not match. Your exposure currency and contract currency may not match. Option also has one more thing. What is option has? You have to pay premium. You have to pay premium. Premium will be paid when? Day zero. So you will have interest on premium. You will have interest on premium. Like you had forward contract and non-forward, like we had forward contract payable and forward contract receivable. So here there will be a strike price. On top of that, premium will be paid. On top of that, interest on premium will be paid. You will realize strike price, negative premium, negative interest on premium. That is, if you are having a outflow, let's call it as outflow. If you have outflow, premium is outflow, base price is outflow, interest on premium is also outflow. If you have an inflow, then strike price is your inflow, premium is your outflow, interest on premium is outflow. This interest on premium will not be calculated in few question. Because the question will not give you interest rate. Question will not give you interest rate. Other analysis I'll do it in some time. Let's come to this example. XYZ, an Indian firm, will need to pay Japanese yen 5 lakh on 30th June. Spot JPY per INR is 1.9516, 1.9711. Prices for Forex option on purchase and sale is follow. Strike price, call option, put option. What is the premium to be paid on hedging the exposure through option route? Hedging the exposure through option route. It will look very simple. Lot of complications are there in this example. So when you do this at home, the MCQ part of it, this itself will take you at least 6-7 minutes to solve because there are a lot of complications in this. I'll explain what is the complication. Tell me what is the exposure. Please, with the currency always. Strike price. If this and this that is the product of the currency, product of the contract, and this does not match, it will lead to a lot of complication. When I say a lot of complication, you need to keep in mind what you are likely to do, because here my strike price is JPY 2.125 per INR, which means you can buy INR or sell INR at the rate of 2.125. You can buy INR or sell INR at the rate of 2.125. You cannot buy JPY at that rate. You cannot buy JPY at that rate. Now write size of exposure. Size of exposure. Size of exposure. JPY 5 lakh or please convert at 2.125. Whether it is useful, not useful, please keep converting in every question. INR how much? 230. Okay. Size of one contract. Now contract will not be, the size of one contract will not be so many Japanese yen. Size of one contract will not be so many Japanese yen. Why it will not be so many Japanese yen? Because what is the strike price? 2.125 per INR. So my exposure, see, they can say size of one contract is 5,000 INR, 10,000 INR, because the product is INR. The product is INR. Two choices. Size of one contract is INR 1. Our size of one contract is INR 235, 294. Size of one contract is INR 1 or INR 235, 294. Doesn't make any difference. Doesn't make any difference. Let me take INR 1. Number of contract 235, 294 contracts. 235, 294 contract. Any doubts on this? Again, I'm repeating the rate, the strike price is what? 2.125 per INR. In a normal scenario, what the strike price will be? INR so much per share of TCS. INR so much per share of TCS. Per share of TCS. Here they have done the reverse. They have done the reverse. JPY 2.125 per INR. Our action. Tell me what you want to do with JPY. Our action. Why do you want to buy? Okay, buy JPY and sell INR. Our action is this. Our action is buy JPY and sell INR. Now listen, my question is very clear. What are you going to do with INR? I don't want to know what you do with JPY. Sell. If you want to sell, please take a put option. Please take a put option. Your mind will in exam will tell I'm going to pay, let me take a call option. Your mind will tell let me take a call option, but you need to take what? Put option. You need to take put option. Why put option? Because your plan is to do what? Sell INR. Your plan is to sell INR. This is an example where exposure currency and contract currency is not matching. Exposure currency and contract currency is not matching. It will need lot of concentration. If you try to rush through, I cannot help it. If you try to think through lot of other examples, other scenario, I cannot help all in that. Now write type of option. Type of option. Put option. As we plan to sell INR. As we plan to sell INR. Premium to be paid. Doesn't end here also. Premium to be paid. How many contracts are there? Into INR 1. Into what's the premium? Which currency? JPY 0.098. So you'll get the premium in JPY, which you need to ultimately convert into INR. You'll get the premium in JPY. The premium is, see, basically this product is in Japan. It's not in India. This product is in Japan. Everything will be in Japanese yen for them. Everything will be in Japanese yen. Tell me the premium. 23.05. Is that there in the answer? No, it's not there. It's not there. So then convert into INR. Then convert into INR. How will you convert into INR? Using the spot rate. Using the spot rate, which is 1.9516 or 1.9711, where you need to decide division, multiplication, bid rate, ask rate. I don't want to get into all of this, but that is a control you need to have. Premium is INR 11815. Premium is INR 11815. Please go through this and tell me what type of option you want to take. What happened? What is the confusion? Sorry? INR is no.
I got it and I picked that.
That's wrong, no. That's why that MCQ has that option, no.
Why not start with it?
I don't want any of them. Tell me call option, put option. That's all. The only thing.
I'm asking doubt of previous.
What is the doubt you have?
Why are we not dividing by 0?
What is divided by 0.09?
Premium.
Premium is 0.098 per INR. 1 rupee of INR, premium is 0.098. 2,35,294 INR into 0.098. That's all. Where is the known unknown? Where is division? All that coming into picture. What is the premium given in the question? 0.098 for 1 INR. 2,35,294 INR into 0.098. I'm not telling you to convert INR into JPY, JPY into INR. Nothing is happening there. It's just the premium which is getting calculated. Tell me what should be done here.
Option, sir.
Okay, I got an answer in live online. Call option. Is it call option, put option? Tell me. Which is the product currency for the strike rate? Guys, please participate. Which is the product currency for the strike rate? GBP. Tell me what do you want to do with GBP? Do you want to buy GBP or sell GBP? Sell GBP. Please use put option. Please use put option. Okay, let's start now. I'll quickly cover that one small area which is pending, which is on cash position versus exchange position. Let's first understand what is this cash position versus exchange position. Before that, there are three types of bank accounts which are there in the banking industry, in the forex industry. The exchange position versus cash position discussion, whatever I'm doing, is from a bank point of view, nothing from an importer or an exporter point of view. We have three types of accounts: nostro account, vostro account, and loro account. From a problem solving point of view, it will not make any big difference, but still these are the three types which you may have to know. Nostro means our account with you, that is ICICI India has a US dollar account with Citibank USA, our account with you. What is Nostro account for us is the Vostro account for them. A US company will say your account with us. So ICICI Bank having USD account with Citibank USA is a Nostro account in India and a Vostro account for USA. It's a Vostro account for USA. Our account with you. They will also say this is our account with you. So sorry, your account with us. They'll say this is your account with us. Vostro is exactly opposite. A Citibank is having a INR account and Loro is an intermediate account which is used sometimes. For example, I want to convert dollars into INR. Direct conversion is not possible. I want to convert dollars into GBP, GBP to INR. So in between, I'll translate into GBP in my Loro account and then transfer it to the next account. Does this make any difference in our problem solving? Not really. XYZ Amsterdam wants to purchase rupees 25 million against GBP for funding their Nostro account, and they have credited Loro account with Bank of London. They've credited Loro account with Bank of London. Calculate the amount of GBP credited. Certain dates are given. You will start doing it, but let me explain the context of this Nostro, Vostro and Loro. XYZ Bank Amsterdam, so it is in another country. It wants to buy INR. So maybe it has an account in India, something which is an INR account. For them, they will say our account with you. In order to solve this, very simple. Known component rupees 25 million, unknown component question mark GBP. Start doing it. Known component rupees 25 million. It's like one bank dealing with another bank or one customer dealing with a bank. It's similar to that. Whoever is initiating is the customer. Known component rupees 25 million. Do you want to buy GBP? Sorry, do you want to buy INR or sell INR in this?
Want to buy
XYZ is like a customer. So whichever. Buy or sell? Buy. Unknown component question mark GBP, which has to be sell. They are saying how much GBP is credited. I will give the GBP and sell it off to get the INR. GBP is equal to INR into GBP per INR. GBP is equal to INR into GBP per INR. What's the denominator currency? What are we doing with INR? We are buying. What is the other bank going to do? Sell. Other bank will sell it. Ask rate 2 crore 50 lakhs. GBP per INR. What's the connecting currency? GBP per USD into USD per INR. From a problem solving point of view, it makes no difference at all. One change can be that no exchange margin, because one bank is going to deal with another bank. Ask GBP per USD into USD per INR. Do you have GBP per USD in the question? Tell me one by bid. Do you have USD per INR in the question? One by bid. That's all, it ends here. It ends here. 61.3625. You get to the number. How much? 2,66,982 GBP. To again repeat, Nostro account means my account with you. Indian company's account with US bank is called Nostro account. They will call the same account as Vostro, because they will say it is your account with us. It's your account with us. Loro is an intermediate account which is used for doing transactions. Any doubts on this? Clear? Okay. Now, an extension of this discussion is something called as exchange position versus cash position. Understand, this is very, very critical. Questions have started coming from this area in exam, and students normally find it very difficult. Okay. Cash position refers to, I prepare my balance sheet. Cash position refers to the actual US dollar or GBP available in my balance sheet. Cash position refers to the actual balance available in my balance sheet. Exchange position refers to not the actual balance available. Actual balance plus or minus lot of other things can be there. What is plus or minus lot of other things? I am going to get a payable after 1 month. I'm going to get some money after 1 month. I'm going to receive some money after 1 month. So exchange position records all purchase and sale of foreign currency transaction irrespective of the cash flow. In this question, please, or in this chapter, please understand, or in this segment of the discussion, please understand that whatever foreign currency here, it is a product. It is like a product. That is, you can buy the product, you can sell the product. Just imagine that it is a product. So if you purchase, normally there will be outflow of money. But if you purchase here, it's going to be inflow of product. If we purchase, it is a inflow of the product. We are doing the analysis for that product, not INR. We are not doing the analysis for INR. So if you purchase something, it is inflow of the product. If you sell something, it is outflow of the product. Understand it is a product. Understand it's a product. Now, there are certain transactions where there will be immediate cash flow. If you do immediate cash flow, please record in both. The books. Exchange position as well as cash position. See, exchange position will record everything which a cash position records. So if cash is going up, exchange will also go up. Cash is going down, exchange will also go down. Certain exceptions are there. I do a demand draft. What is a demand draft? Is you came to my bank and created a DD for $5 lakh. Immediately $5 lakh will not go from my bank account. $5 lakh will not go from my bank account. When will it go? You will give it to Bharadwaj Institute. We'll have to present this to the bank. So in my actual balance, it will get realized only when the draft is realized. It will be impacted only when the draft is realized. Again, understand, it's a demand draft of the foreign currency which I am issuing it to. Don't bring INR into picture. You will say, if there is a DD, it is an inflow. I am not talking about all of that here. Please understand. You came to Bharadwaj, you came to ICICI Bank and said, give me a DD of $1 lakh. Moment Bharadwaj presents this, $1 lakh will be the reduction in balance. $1 lakh will be the reduction in balance. So this is a sale transaction. This is a sale transaction. Bills purchase. You came as an exporter. You came as an exporter and gave me a bill to me. You gave a bill to me. What did I do with the bill? I said, okay, bill has come. At some point of time in future, this money will come to us. So what you did, you gave a $1 lakh bill and told, give me money against this. I gave you 70 lakh rupees. You are done. I have the bill with me. I've already purchased it. I've already purchased the bill, but I have not got the dollars against it. I've not got the dollars against it. When will I get the dollars against it? When the bill is realized. When the bill is realized. Forward purchase sale, self-explanatory. If I do a forward purchase, I will not realize it. I'll realize it only later. So first the transaction will go in exchange position. Then the transaction will go in cash position. For example, question says DD realized. Don't record again in exchange position. It can only get recorded only in the cash position. What is cash position? Only important thing is I want you to clearly understand that it is a foreign currency which is a product. I tell students that you are preparing a price stores ledger. What is a price stores ledger? That records receipt of product and issue of product. If you remember, you would have done price stores ledger, FIFO method, LIFO method, at some inter-level you would have done. So like price stores ledger, we have to prepare. When there is a purchase, inflow will be there. And when there is a sale, what? Outflow will be there. Purchase is inflow and sale is outflow. Outflow of what? The product. Outflow of the product. I'm not talking about outflow of INR. If you sell something, there will be inflow of INR. There will be inflow of INR. I'm not talking about INR. Moment you bring in INR and then do, I cannot help it. I cannot help it. You will end up making a mistake. You will end up making a mistake. Clear? Any doubts in this? Purchase means inflow of foreign currency. Sale means what? Outflow of foreign currency. Receipt means if the foreign currency comes in, because purchase means it will not come in immediately. It can come later. It can come now, depending on when it is realized. When the actual receipt comes, my balance goes up. When the actual amount goes out, my balance goes down. So this records receipt and payment. This records receipt and payment. This records purchase and sale. Purchase and sale. Purchase will lead to receipt of foreign currency. Purchase will lead to what? Receipt of foreign currency. And sale will lead to what? Payment of foreign currency or outflow of foreign currency. Payment of foreign currency or outflow of foreign currency. Please be very clear because you will keep confusing yourself with this. Purchase means I'm purchasing a product. It comes into my home. I purchase the product. It comes. So moment I tell Bharadwaj Institute, sir, moment I go to a shop and say that I want to buy this, I'll record it in exchange position saying that this is going to come in few days. Moment it reaches my home, my mother will record saying that okay, it has come in, now the balance has gone up. So cash position will get recorded when you actually get the product or actually take the product out. Purchase position, purchase or sale of a transaction which is entered will get recorded first in the exchange position and then will get recorded in the cash position. For example, you go to the bank and you go to the market and do a spot purchase. Spot purchase means record here as well as here because immediately inflow came. Immediately inflow came. Cash position is a cash book. It will record all inflows and outflow. Exchange position is more like a stores ledger. Stores ledger. What are the purchase? What are the sales? What is the inflow? What is the outflow? Certain names. Purchase in exchange position. Purchase of bill. Cancellation of DD. What is cancellation of DDs? When you issue DD, it's a sale transaction. When you issue DD, it's a sale. You went to ICICI Bank, got a DD for $1 lakh. So ICICI is saying, I have sold $1 lakh to the student. They will give it to Bharadwaj Institute and then the payment will happen. But I cancel the DD now. I cancel the DD. Spot purchase, DD purchase, purchase of check, outstanding forward purchase, bills purchase. Any purchase or anything which is a cancellation of a sale. Any purchase or anything which is a cancellation of a sale is the purchase. Opposite, forward sale, cancellation of purchase, remittance by TT, sold forward, outstanding forward sales. All this is what? This is sale transaction. Issue of DD is a sale transaction. Inflow in cash position, please allow me to get the money. Money comes in, okay. Money goes out, then okay. So inflow in cash position can also be inflow arising out of past purchase. Inflow arising out of past purchase. Now tell me, cancellation of DD will be recorded as how? Don't see the above point in the 4 which is right. Cancellation of demand draft. First tell me cash position, exchange position. Cash it will not get recorded. TK. In exchange where? When you issue DD, what it is? Sale. When you issue DD, it is a sale transaction. So cancellation of DD is purchase. Spot sale of foreign currency. First tell me, will it be recorded in exchange position? Participate. Okay, cash position. Okay, see which one is right. I'll suggest not to see the option, okay? Please don't see the option. You first tell me without seeing the option. Otherwise, it will unnecessarily complicate things for you. Spot sale of foreign currency. In exchange position, where should I record? Sale. Very clear. In the cash position, outflow. Clear? So, sale in exchange position and outflow in cash position. Purchase. How is forward purchase recorded in cash position? We are not going to record forward purchase in cash position. Clear? Now let's see a question and then I come to the next concept. Again, I'm repeating, please imagine this to be like a price stores ledger. Let's come to this question. Question 81. Question 81. Please go through 81. You as a dealer of foreign exchange, have the following position in Swiss franc: balance in the nostro account credit, opening position overbought, purchased a bill, sold forward TT, forward purchase contract cancelled, remitted by TT, draft on Zurich cancel, and then there are certain requirements. I'll come to the requirements in some time. Right, exchange position, particulars. Purchase will lead to what? Inflow. Sale will lead to same way cash position. In that purchase, sale will not be, receipt payment will be there. Cash position, receipt is inflow and payment is outflow of the foreign currency. Please imagine this to be a product. Moment you think that it is a currency, you will end up making a mistake. Moment you think it is a currency, you will make a mistake. Both has a opening balance given. Tell me the opening balance. Nostro account has how much balance? 1 lakh. Why they use the word credit? Credit means if I have credit balance in my bank account, it means I have the balance. So 1 lakh is my balance here. What's the balance in this one? Exchange position.
Opening position overbought.
50,000 overbought. What is this overbought means? 1 lakh which is there plus or minus purchase and sale transaction already entered. So he could have entered some past buy transaction and past sell transaction all put together. My risk, see, this is the real currency in my books, but this is my real risk. My real risk is the exchange position. My real risk is the this 50,000 includes this 1 lakh. This 50,000 includes this 1 lakh, which means negative 50s. You have sold a lot of things in the past and maybe you have done extra sale of 50,000. You have done extra sale of 50,000. What's the first transaction? Purchased a bill. Will it be recorded in exchange, cash, both? Exchange, purchase of bill. How much? 80,000. Sold forward. Forward means it is not happening today. Forward means it's not happening today. Sold forward. How much? Where should I write? Sale. What's the next transaction?
Forward purchase.
FPC cancelled. Where should I write?
Sale.
Sale. 30,000. Understand as purchase sale, that will be more easy for you to do. But why I write inflow outflow? Because what gets recorded here will ultimately get recorded at this side. Will ultimately get recorded in this side. That's why to have uniformity, I've used the word inflow outflow. What's the next transaction? Remittance by TTs, remittance by telegraphic transfer. They have not mentioned whether it is a spot remittance or for forward we are going to do later. Nothing is mentioned, so spot remittance. It is a spot remittance. Remittance means it's going out. It is going out. Remittance made at both the places. Remittance made how much?
75.
And this side also write remittance made. Listen, if the question says remittance made for a past sale, remittance made for a past sale, you did the sale already, you came to the shop and said you have sold this 75,000 to me, please now give this 75,000. I'm giving you the bill, you give me the 75,000. Then it will not get recorded in exchange position. It could be that you see here, no, sold forward TT, that is now getting executed. That can get executed now. You already recorded there. Now it may get executed. Nothing is mentioned, so I'm writing both. Remittance by TT. Remittance by TT, how much? 75,000. What's the next transaction? Issue of DD. Purchase, sale. First tell me. Issue of DD. Issue of DD. It is a sale transaction. Again, I'm repeating. You went to ICICI Bank, took a $1 lakh demand draft. So what ICICI did? They gave this demand draft to you, and in their books they said we have sold $1 lakh to this person. You gave it to Bharadwaj Institute. We will present this $1 lakh when we want, maybe in a day or two. When we present, they have to pay us $1 lakh. The ICICI Bank has to pay us $1 lakh. Now it's cancellation of that, cancellation of DD. Where should I write? Purchase. How much?
20,000.
That's all. It's very simple. Now they'll give some target balance. For target balance, first you should close cash position, then only the exchange position. First cash, then exchange. How much cash balance you want? How much we have now?
25,000.
Do spot purchase. 5,000 I'm buying and writing at both the places. That's why I first close cash position. First cash position close, spot purchase. And write it at both the places. Why always cash first? Because cash will impact exchange also. Is the cash position closed? We have a balance of 30,000. So just close it. Total 1,05,000. 75,000 closing balance, or you can put a line in between closing balance. Balancing figure 30,000. Balancing figure is 30,000 closing balance, which will become the opening balance for next time. Any doubts on this? Any doubts on 30,000? First you should balance what? Cash position. Now I come to exchange position. Can you tell me what's the balance now? What's the balancing figure you get? You're getting? You have to record spot purchase at both the places. Spot purchase have to be recorded at both the places. It has become 0. Any doubts on this? What's the requirement? Overbought 10,000. Listen, if you do a spot purchase, it will get recorded here again in cash. So if I want only the exchange position, write forward purchase. No spot purchase. Spot purchase will go to the other book also. Forward purchase. Put a total balancing figure. Closing balance. Forward purchase. 10,000 balancing figure. This will become the opening overbought next month. I'll do one more question and then I discuss the concept again before I move to the next concept. Any doubts? Clear? Can you proceed? Okay. Now before I go to the next question, Tell me, this is the scenario, okay? Please listen and understand and tell me this. A bank has an overbought position of 1 lakh and cash balance of 25,000. Don't look at the options, okay? Please don't look at the option. You have 1 lakh overbought, 25,000 cash balance is there. I want cash balance to become 80,000 and overbought to become what? 1 lakh 50,000. Overbought to become 1 lakh 50,000. What action should I take? What action? Don't look at the option. Don't look at the option. Please see and then let me know. Spot purchase 55,000 will make the overbought 1 lakh 55. Will make the overbought 1 lakh 55. So to reduce it, do a forward sale of 5,000. To reduce it, do a forward sale of 5,000. Spot purchase of 55,000 and a forward sale of 5,000. Next one, see. 15,000. Which market? Spot market. I'll buy 15,000 in the spot market. Now, in the Forex, there are two types of exposure you can have. One is called transaction exposure and second is called operating exposure. What is transaction exposure is any increase or decrease in my profit, any increase or decrease in my profit due to variation in exchange rate, due to variation in exchange rate. I did sale of 1 lakh units today. If I realize money today, my profit is rupees 20 lakh. Afterwards, when I realize 20 lakh profit can be 25 lakh, can also be 15 lakh. This is called transaction exposure risk, which is where forward contract and all came into picture. What is operating exposure is changes in profit due to changes done by the company on selling price, cost price, unit sold. Wherever you make any changes on the operation, wherever you make any changes on the operation. In transaction exposure, units remain same, selling price remains same, cost price remains same. What changes is the exchange rate. What changes is only exchange rate. In operating exposure, what I'm saying is keep the exchange rate same. Keep the exchange rate same and then keep changing whatever you want to change. So here, profit as per spot rate and profit as per expected spot or forward rate in future. This is existing profit as per spot rate, revised profit as per spot rate. Rate does not change. I don't want the exchange rate to change. I don't want the exchange rate to change. Then what can change for profit? Units sold can change, selling price can change, cost price can change, number of units sold can change, variable cost can change, fixed cost can change. Lot of changes can happen. Lot of changes can happen. Today, if this happens, my profit is 10 lakh. Suddenly company says, no, please revise the budget. Please revise the budget. You prepare a new budget. You prepare a new budget that gives you profit of 12 lakh. That difference is called operating exposure. That difference is called operating exposure. But the 10 lakh which I wanted to realize, because of exchange rate, I'll realize 11, 12, 9, 8. That is called transaction exposure. That is technically called transaction exposure. Let me show an example. You'll understand it better. Let's come to this question. Go through 85. The operating exposure question I'm not going to discuss because there are a lot of logical gap in ICA solution. I've given twin answers. 84 is that question. At home later on see it. Shanti exported 200 pieces of designer jewelry to USA at $200 each. To manufacture and design this, the cost is 6,000 Japanese yen for each piece. Labor cost, everything is given. Please calculate profit if you realize at this rate. Please calculate profit or loss if you realize at this rate. Wait. Then calculate profit or loss if you realize or pay at this rate. If you realize or pay at this rate. So particulars, existing spot rate, future spot rate, there will be difference in the profit. There will be difference in the profit. When I say realize, not only realize, even payments. Even payments. What is the payment? We are bought a raw material at the rate of Japanese yen 6,000 per piece. Right? Particulars. existing rates, future rates, existing rate and future rates, existing rates and future rates. Point number one, sales. Sales. How many units are sold by us? At what rate? If you realize today, what rate? 65, 66. 65, ठीक है. If you wait and realize, what rate? This extra or lower is the transaction exposure. This extra or lower is the profit or loss due to transaction exposure. It doesn't end here. Less. Purchase 200 units. How many Japanese yen? Division, multiplication, what rate? Today means what rate? Okay, no direct rate. So then do the known unknown and go through it. Do known unknown and go through it. You have to pay 6,000 Japanese yen. 200 into 6,000 Japanese yen. Go through known unknown. I don't know division, multiplication. You let me know. Divided by what rate? Multiplied with what rate? Divide by 115, multiply with 6. I'm going with whatever you're saying. Divide by 115, multiplied with 66. What is it for the other one? Divided by what rate? Divided by 105, multiplied with 69.25. Less labor cost and other things. Labor cost, which is no problem, it's an INR. 200 into how much? How much the labor cost? 200 into 1300. 200 into 1300. Variable over it. 200 into 650. And profit. If profit increases, transaction exposure is helping you. Profit decreases, then transaction exposure is a problem. $53,267 is my extra profit. If you realize today and if you realize later, transaction exposure. Now I'll give you an example of operating exposure. Any doubts in this? Any doubts in this? Same existing rates only I'll copy. Same existing rates I'll copy. Listen for a minute. What is, see, difference between existing and future rate is called transaction exposure. What is operating exposure is, you are saying not 200, you will sell 250 units. You will sell 250 units, not $200. I'll sell it at $180. I'll sell it at 180. I'm not changing 65. Don't touch the rate. Don't touch that 65 alone. Minus 200 into, we had, sorry, now it is 250 units. 250 into, not 6,000 Japanese yen, it's only 5,000. 250 into 5,000 Japanese yen. I don't need 6,000. I reduce the price. I reduce the price into what rate you are told? Into, so rate alone I'm not touching. This is 200 into 1,500. Sorry, 250 into So I'm not touching the exchange rate alone. I don't want to touch this 66, whatever the two rates you had. No, I don't want to touch this 66, 115 and 65. Beyond this, any other change can happen. Beyond this, any change can happen. That is called operating exposure. That is called operating exposure. Last one, 250 into 1000. So because of operating exposure, my profit has gone up by 1,26,522. Profit has gone up by 126,522. Except exchange rate, anything can change. Except exchange rate, anything can change. Selling price, units sold, cost price, labor cost, variable overhead, fixed overhead, anything can be changed by you. Anything can be changed by you. That difference is called as profit or loss due to operating exposure. Leave the exchange rates as it is. Leave the exchange rate as it is and change anything else you want. What is transaction exposure? Change only the exchange rate, other things should remain same. Change only the exchange rate, don't touch selling price, don't touch number of units, don't touch cost price, don't touch labor overhead, variable overhead, nothing needs to be touched on. Any doubts on this? Clear? A company can make a profit of 10 lakh if exports and import settlement is done as per spot rate. If export and import settlement is done as per spot rate. However, the same will decline to 4 lakh. Same will decline to 4 lakh if they are realized and paid as per the due date. How much is the transaction exposure? 6 lakh. Fall in profit. Fall in profit 6 lakh. It can be favorable, it can be adverse also. Okay, now I'll discuss first the investment decision part. It's not that I'm going to teach anything new. I'll discuss certain concept on investment decision. One problem was the question said I have some surplus money. I want to invest it. I want to invest it. We had 3-4 options of investment. You can invest in one country, you can invest in second country, you can invest in third country. Ultimately, I'll have to calculate the profit or loss in one currency, which the question will specify. Question has to specify in which currency you have to calculate the profit. So do investment, calculate profit. Do investment in the second currency, conversion, reconversion, all that, lot of headache will be there. Known, unknown component will have to be continuously worked on. And ultimately, I'll have to select the currency that results in maximum gain. And there was one problem where ICI said, I give you 2 options of making investment. Option 1, option 2. I'm not giving you multiple options. So it said sometimes multiple option may give almost the same result. Almost the same result, and hence we can be indifferent between the 2 options. Hence we can be indifferent. We should opt for investment in fixed income security as compared to investment in equity option. One exam question, they gave 2 options. One is investing in JPY fixed investment. Second is USD equity share. Ultimate results is same. Ultimate result is same. But we obviously know that bonds are less risky than equity share. Bonds are less risky than equity share. So if your returns are same, then go by risk angle. Then go by risk angle. See here, CFO of a company has surplus funds. He can invest either in index fund of Japan. What is index fund? Equity. It is equity. Or USA treasury bill. What is treasury bill? Government security. Maturity amount in INR would remain same. Maturity amount in INR would remain same. Where should I invest? Invest in USA. Invest in USA. Why invest in USA? Because I'm investing in treasury bill. I'm investing in treasury bill. Read this and tell me what is the answer to this. Think logically and tell me the answer. Tell me what is the answer to this. This came in exam. Very simple. Student made the mistake with the first part itself. What is the amount to be invested? 2. I have raised 400 billion. In that 60% will be needed after 6 months time. So if I don't need that, let me invest that money alone. Let me invest that money alone. Exam gave same thing. Student did all calculation with 400 billion itself. They did not even find what is the amount investable. What is the amount investable? So I don't need what? 240 billion. Can you please tell me, this is the scenario, interest rates are this, how much cash will I have in hand after 1 month? You have the rates given there, you are making an investment. Invested 1.5 or 1.7? Invest at 1.5, lower rate, because investment will always happen at lower rate. Tell me the answer to this. Thousand. What is financing decision is whether I should borrow in Indian currency or I should borrow in foreign currency. So there was one question which said rate of interest after 3 months to make the company indifferent between a 3-month borrowing and a 6-month borrowing. Say, listen, today I am having a requirement of $100 loan or 100 rupee loan. If I take 3-month loan, I have to pay into 6% into 3 by 12. This is the 3-month interest you have to pay. So technically you'll have to pay 101.5. This is a 3-month loan. If you take a 6-month loan, you have to pay 100 into 8% into 6 by 12. I went to the bank asking 3-month rate and 6-month rate. They gave me a rate. They said 6-month rate is 8%, 3-month rate is 6%, all are per annum rate. Now suddenly the company is saying, let's not take a direct 6-month loan. Let's take a 3-month loan and take another 3-month loan. Take a 3-month loan and another 3-month loan. The another 3-month loan should be at such a rate that 101.5 becomes 104. 101.5 becomes 104. If it's not becoming 104 in the next 3 months, then I'll not be indifferent between choosing a 3-month loan and a 6-month loan. So when will 101.5 become 104? That is for 3 months. That is for 3 months into 12 by 3. 9 point. Technically what she has tried answering is the FRA rate. This is technically called FRA 3 by 6. This is technically called FRA 3 by 6, which is future value factor for 6 month divided by future value factor for 3 month minus 1. In my example, 1 plus 4% divided by 1 plus 1.5%. What is 4%? 8% for a year, 4% for a half year. 1.5% is what? 6% for a year, 1.5% for 3 months. Can you tell me this number? $2.4 per 3 months or convert into year. That's the answer she had earlier indicated. So basic rule is, if you ask me what is the rate that I'm indifferent, the rate of interest after 3 months to make the company indifferent between a 3-month borrowing and a 6-month borrowing is nothing but fair FRA rate 3 by 6. 3 by 6. That is, I have an option of taking a 3-month loan. I have an option of taking a 6-month loan, and I also have an option of taking a 3-month loan and taking another 3-month loan. Taking another 3-month loan. What is the rate of interest for that another 3-month loan is called fair FRA rate. FRA 3 by 6. Summary of hedging strategies. Okay. Forward contract, futures contract, 2 types of questions will be there. One in which exposure and contract currency matches. Second in which it does not match. Option contract, again 2 type of question will be there. One in which exposure and contract currency matches, and in one in which it does not match. Money market hedge can be for a payable, can be for a receivable. Currency invoicing is there and no hedges there. This I've already talked about you. So that is 1.998 plus or minus 0.002 would be. Bid rate is 1.996. Ask rate is 2.000. Exchange exposure risk. What is exchange exposure risk? Is transaction exposure. Transaction exposure. That is, if you realize today, what's the realization? And if you realize in future rate, what is the realization? The gap is called exchange exposure risk. Transaction exposure risk. Risk because of hedging. Risk because of not hedging. Different names. Can you please answer this example? Please answer this example. Do the calculation, please, please, fast. Nothing will come like this. Please start doing it. Start doing it. Division, multiplication, decide, and what rate, please decide. The given rate is euro per pound. No interpretation, nothing is needed. They have used the word euro per pound. That's euro per pound. No interpretation and all I need. If I take forward contract, what rate you want me to use? 1.975 or 1.983? Divided by 1.975, whatever you guys say. Okay. Any doubts on this? Next, H Limited anticipates that spot exchange rate in 3 months time to be equal to 72.95/73.4. After 3 months, it turned out to be 73 and 73.42. What is the foreign exchange exposure and risk of H Limited? Is exposure is 50,000. See, I did sale today. I don't know what is the spot rate and all. That's not given in the question, and I don't need it also. I was imagining that I will realize and anticipates that spot exchange rate in 3 months to be equal to the current 3-month forward rate. I did not take a forward contract. I was thinking I'll realize at this rate 72.95. Ultimately, I realized that what rate? 73, which means you have made profit because of foreign exchange risk. You have made profit because of there are yeah, please tell me.
Then the last question, sir. We in GBP, whether we are selling or we are purchasing, sir, how to identify known, unknown?
Buy euros, which means sell GBP.
We need to pay euros, so we are going to purchase. Okay.
Clear? Any doubts? Okay. As I said, if you want to revise this entire chapter, just the concept book part is sufficient with the MCQs. Major chunk of the Forex will get covered. For practice, obviously, if you do few questions, it will give more clarity. We started with first what is price currency and product currency. Price currency is the first currency in the quote. Product currency is the second currency in the quote. At many places, I kept on asking in futures, what is the product currency? What is the product currency? Because product currency, price currency understanding will become critical as you do futures and options part of the currency futures. Direct quote is equal to home currency per unit of foreign currency. Indirect quote is equal to foreign currency per unit of home currency. Nothing much to do with problem solving. Very rarely we have used this concept. Direct quote is equal to 1 by indirect quote. Indirect quote is equal to 1 by direct quote. Two-way quotes are one where there is a bid rate and a ask rate. Bid rate refers to the rate at which banker buys the product currency. Ask rate refers to the rate at which the banker sells the product currency. Product currency, again, product currency word will keep coming. Spread refers to the difference between bid and ask. Middle rate refers to the average of bid and ask. And ask rate has to be always higher than bid rate. Ask rate has to be always higher than bid rate. Spread percentage is equal to spread divided by bid rate or the ask rate. Pips refers to the number after the decimal. If the numbers before the decimal is same, then when I give a two-way quote, the decimal portion will only be quoted and the number before the decimal will not be quoted. If the numbers are also same after the decimal, then when I'm quoting the pips part, only the last few decimals will be quoted. If question uses the word 20 paise, 21 paise, don't use your understanding of the pips. 20 paise means 0.20. 20 cents means 0.0020. 20 cents, sorry, 0.20 cent. 0.20 cent is 0.0020. 20 cents is $0.20. $0.20. Direct to indirect quote. If you want a bid rate, do 1 by ask. If you want a ask rate, do 1 by bid. Return in foreign currency, you want to calculate 1 plus home currency return is equal to 1 plus foreign currency return into 1 plus or minus appreciation or depreciation percentage of the foreign currency, And if you have a two-way quote, then you cannot do any formula. Please solve using first one currency investment, using the second currency investment, and then calculate the return. These are the commonly used currency. The key conclusion is INR is cheaper than each of the currency except JPY. The GBP is the costliest currency. USD is CHF is not that common. GBP, before that Euro, before that USD. This is very critical. USD, Euro, and GBP is the order. Cross rates refers to the process of doing a cross multiplication. If you want A by B, do A by C into C by B, you will get the rate for A by B. For our basic problem, I'll find one known component, one unknown component. In known component bracket, I'll write what needs to be done. In unknown component, I'll put question mark and write what needs to be done. Then what we end up doing is unknown component is equal to known component into something you will do. It will get cancelled. See what are you doing with the denominator currency, what is the bank doing with the denominator currency, and then decide bid and ask rate, expand the formula, and then complete the question. In this, an add-on can come called as exchange margin. Exchange margin needs to be deducted from the bid rate, added to the ask rate. Deducted from the bid rate, added to the ask rate. What is the purpose of this? Purpose is to expand the profit of the bank. Merchant rate refers to the rate including the exchange margin. Interbank rate refers to the rate excluding the exchange margin. How do you apply exchange margin? You can apply it on the final exchange rate, or you can apply it on one of the quotes which has INR in it. If question says exchange margin on buying rate and selling rate, we saw this in one forward contract problem. Considered as bankers buying rate and bankers selling rate. Should I take it on direct quote or indirect quote? That's your wish. But if you're taking it on one by ask, then in the ask you have to add. If you're doing one by bid, in the bid you have to subtract. You are calculating the ask rate, but it's one by bid. So if you're doing one by bid, in the bid rate if you're using, please do minus. And if you're using after division, then you whatever you normally do. We should always add the exchange margin to the ask rate and subtract the exchange margin from the bid rate. This is for the denominator rule. This is for the denominator rule. Cover rate refers to the rate of the opposite transaction. If the foreign exchange dealer has bought something, he will sell it. That is called cover rate. And if he has sold something, he'll have to buy it back. That's called the cover rate. This can also be called a squaring up of position. Whenever a bank deals with other bank, all transactions will happen at interbank rate, and whoever is initiating is the customer, and the other bank is the bank. Likely rate of one currency against another currency. If you ask likely rate of apple, I'll say rupee per apple. So likely rate of yen means USD per yen or INR per yen. Interpretation of quotes, most critical part. Use the practical understanding to interpret the quote wherever slash word is used. If they use the word per and all, no need to do any interpretation. Directly use the rates. Swap points refers to the difference between spot and forward rate. If they give you any forward points in the question, they are only swap points. They are not pips. We don't take them as pips. And if the swap points are in ascending order, add it. If the swap points are in descending order, deduct it. Swap premium in descending order. Swap premium in descending order would mean that you will have to only add it because the word used is premium. Swap points for broken period, if you want to calculate, use the interpolation technique. You have 1.5 month, 1 month, 3 months. If you want anything in between, please use interpolation technique, except for one problem we did where there was realization of the bill was there, where ICA did not do interpolation. Appreciation or depreciation can be calculated for price currency, for product currency. If you want to calculate for product currency, FR minus SR by SR into 12 by M into 100. If you want to do it for price currency, SR minus FR by FR into 12 by M into 100. Appreciation depreciation percentage can be separately calculated for bid rate, separately for ask rate, separately for price currency, separately for product currency. And if they ask for average rate, average is average of spot and forward. The denominator is the average rate. Appreciation depreciation percentage given in the question, you want to apply in the quote, you will have to ensure that you apply it only to the product currency. If they give it for the price currency, convert, apply, reconvert. Convert, apply and reconvert. If the question says there is a discount or a premium of 3%, this is 3% directly, not 3% per annum. You cannot take this as 3% per annum. You will have to work with 3% as it is, and directly add or subtract directly add 3% because it's the word premium. Appreciation of one currency will always be greater than depreciation of the other currency. Nothing to do with the problem solving. This is just an interpretation. Real appreciation or depreciation, if you want to calculate, then you will have the spot rate, you will have the forward rate. Remove the forward rate to the extent of inflation change, and then use the real rate, real spot rate, and then calculate the percentages. IRPT can be used to forecast in exchange rate. 1 plus RH divided by 1 plus RF is equal to F1 by E0. This can be used to forecast my exchange rate. I need to ensure that home currency means the first currency in the quote. It is not INR. It is not INR. It is not INR. I cannot keep repeating because I keep answering these doubts to the student. I again say home currency refers to the first currency in the quote. Foreign currency refers to the second currency in the quote. USD 0.0122 per INR. USD is my home currency. INR is my foreign currency. And you will have to do the proportionate interest rate. If you are doing 6-month forward rate, take 6-month rate. If you are doing 3-month forward rate, take 3-month rate. Extension is okay. If what is IRPT link with interest rate is, if you have higher interest rates, high interest rates in a country will be offset by depreciation of the currency of that country. So implied differential interest rates can be understood by the appreciation or depreciation percentage. If a currency is depreciating, it means it has a higher rate. It means it has a higher interest rate. Law of one price, 1 plus IH by 1 plus IF is equal to F1 by E0. Space arbitrages, buy in one market, sell in the other market, make riskless profit. You can buy it and go to the bank and buy it at the lowest ask rate, whatever ask rates are there, buy it at the lowest ask rate and sell it at the highest bid rate and see whether you are able to make money. In that case, if the quotes are given 65.4, 67.4, 68.4, 70 is okay. But if the quotes are given direct, indirect, then you'll have to convert the quote and make it in the same order. Make it in the same order and then do the arbitrage. Then covered interest rate arbitrage, what you do is you first calculate your fair forward rate, compare with the actual forward rate. If actual forward rate is more than fair forward rate, market is giving too much value to the product currency. Market is giving too much value to the product currency. Invest in the product currency. Product currency means foreign currency. Invest in the foreign currency and borrow in the home currency, and opposite will happen. If they give two-way quotes, in the question, then you cannot do this answer. You'll have to do trial and error. Invest in one, then invest in second. So our steps is in borrow in INR, convert into USD, create deposit, take a forward contract, redeem the deposit, convert into the other currency, repay the loan, and see whether you're left with arbitrage gain or loss. Triangular arbitrage means you'll have to go through routes USD to INR to GBP to USD, USD to GBP to INR to USD. In this case, when you do exchange margin application, you'll have to apply exchange margin on every quote. Exchange margin on every quote, not only at one time. You'll have to apply it on every quote. Why on every quote? Because at every stage you'll do the conversion. At every stage you will do the conversion. Forex risk management techniques: currency invoicing, netting, leading and lagging, forward contract, money market hedge, currency futures and option, currency swaps. In that currency invoicing, I have two choices. If I want to eliminate exchange risk, please go ahead and select INR. Please go ahead and select. If you want to take a risk, liability, depreciating currency, asset, appreciating currency. If nothing is possible at your end, then you lose business. In case I want a billing for payable, and I want to select a depreciating currency. I don't have depreciating. Three options given, all the three are appreciating. Select the worser of the lot. Select the less worser of the lot. So select one which has the lowest appreciation. And if you want to do billing, select highest appreciation. And if all are depreciating, select the lowest depreciation. Basic rule is simple: high inflow of INR, low outflow of INR. Then next is currency invoicing, where you want to convert the data from one currency to another currency. Consistency will not be there. I cannot tell use bid rate, use ask rate. It depends on negotiation. In exam time permits, try doing both and then leave it, because you do not know where is the conversion, at what rate you need to do the conversion. Leading and lagging, whether to make payment today, whether to make payment later. If you pay today, then you will have to charge interest on that. If you pay later, no interest on this, but the exchange rates can be different. If you receive today, then you may have to give some discount and receive the money today, and then interest on it, interest income on it. If you have cash surplus, interest income is as per investment rate, and if you have a deficit, interest is as per borrowing rate. When you do leading and lagging, please ignore the concept of opportunity cost. Ignore the concept of opportunity cost, because we will go by real income. We'll go by real income. Early receipt is not in my hand. If you don't have it in your hand, then what you need to do? You need to go and give some discount. Sometimes there will be a commission LC which is taken. So if you are giving an LC to your foreign bank, you will pay interest on loan as well as commission and interest on commission Interest income versus opportunity cost. If you are thinking that, do one of the two. Double counting will happen. Go by real interest, don't go by opportunity cost. Ignore the concept of opportunity cost. Netting refers to the process by which I net off receivable and dues payable. Why do I do netting? This leads to reduced risk. Some question will ask, calculate the net exposure after the netting. It can be calculated using multiplying with spot rate, multiplying with forward rate, multiplying with the spread. Spread is the difference between spot and forward. Centralized cash management means everybody gives the money to me today and I do one investment or one borrowing. Decentralizes, I give them freedom. The gap between the two is called as the benefit of netting. Centralizes netting, decentralizes individual investment. Forward contract is basically taking a call whether you want to cover your exposure or not. Ideal rule, please go ahead and cover. You don't want to take any risk. If you want to take risk, then see whether it can lead to higher inflow of INR or lower outflow of INR. Cover rate refers to the rate which you are paying. Cover rate can be calculated through interest rate parity theory. You can calculate through interest rate parity theory, or cover rate for a receivable is equal to, for a payable is equal to the cover rate, hedging rate plus the premium plus the interest on premium, hedging rate minus the premium minus the interest on premium. Profit or loss can be calculated by comparing what has happened with what could have happened. What has happened with what could have happened. And there is also a loss or profit calculated if hedging is done and if hedging is not done. If hedging is done, actual realization using the hedged rate compared with actual realization if it happens today. If it happens today, and not hedging, actual realization using the actual rate and actual realization if it happens today. This is called expected loss. This may or may not happen. Relevant forward contract rate, that example of where we had 60 days payable, 20 days was the transit, 80 day, 2.67 months rounded off to the lower month. When you do interest calculation will be for your transit period and on the amount of loan you took. Loan is on your receivables. Loan is on your receivables. Closure of forward contract can happen in 9 ways: honor, rollover, extend, on due date, before due date, after due date. If you are doing on due date, no problems. How do you do calculation? Date, position, action, reference date and rate. If you are cancelling, only 2. If you are honoring or extending, the third position will come. 1 and 2 will give you cancellation gain or loss. 1 plus 2 plus 3 will give you effective rate. No signs to be attached. Plus minus automatically are there. So don't take 1 minus 2, 2 minus. I don't want any of that. Compare 1 and 4. Compare 1 and 4. That will give you the effective loss or the cancellation. Sorry, effective loss or swap loss of the customer. If you do it before, early honor, if you do it early honor, do first the table of the customer. The original rate realization happens and then effective losses paid or received, and there will be a banker analysis. On the banker side, he will say what is my outflow or inflow. On that you pay interest for the number of days you came early. If you are coming later, then date, position, action, reference date, rate for the customer. Only 2 line items. Don't do the third line item. Third line item can be done, but I don't want it. That will give me cancellation gain and cancellation rate. Cancellation gain or loss and cancellation rate. Then do the banker analysis where there's original position, opposite position and a new position. Original and opposite will give cancellation gain or loss on which interest is charged. 1, 2 and 3 will give the effective loss or swap loss which is recovered. So what the customer needs to pay is cancellation loss of the customer, swap loss of the bank and interest cost on the cancellation loss of the bank. For how many days? 3 days are the date of cancellation whichever is later. 3 days are date of cancellation whichever is later. Once all this is done, then I'll ask you what you want to do. You say honor, then please honor at the spot rate. You say cancel, it ends there. You say extend, please extend for the new rate. Extend at the new rate. Honor before due date, I've explained that. Customer does not appear on due date. All these things you do, you'll be this in 1-2 question example itself will take care. Decision on hedging based on average contribution to sales ratio. If you are doing this, you will have to do all of them together and calculate average contribution to sales. If hedging is done, if hedging is not done, and whichever has better percentage, we go ahead with that. Time value and currency fluctuation component. Time value is basically the amount of discount you get by making early payment. So whatever discount you are getting, 2% discount or 3% discount into the exchange rate on the due date, and the gap is the currency fluctuation component. Money market hedges prepare a balance sheet. In the balance sheet, if you have a receivable, against that create a USD loan, convert the USD loan into an INR amount and create an INR deposit which will mature on the last day and will get your money. If you have a USD payable, against the USD payable, you want to create a USD deposit by taking an INR loan, and then the deposit is created, deposit matures, he pays, INR loan you will have to repay along with interest. The interest rates given here can be understood as annual rate. Interpretation of 180-day deposit or borrowing rate can be annual rate, can be the specific period rate. There is no consistency, so please write your assumption. Please write your assumption. Transaction exposure and operating exposure. Transaction exposure is the profit or loss which happens because of the difference in exchange rate. Operating exposure is the profit or loss which happens because of change in selling price, cost price, number of units, variable cost, fixed cost, lot of changes which can happen. Type of bank account, Nostro account is basically our account with you. Vostro is your account with us. Loro is an intermediate account. Then we have exchange position and cash position. Exchange position is a price stores ledger which records purchase and sale of foreign currency, whether inflow happened or not happened. Whether inflow happened or not happened. Purchase is inflow. Sorry, purchase is basically like the receipt. Purchase, any purchase of foreign currency will be written in purchase, and sale of foreign currency will be written as sale. And the next one is cash position. Next one is cash position, which records only when there is a inflow or outflow actually happening. Understand this to be a product and not the currency. Understand this to be a product, and purchase will lead to inflow of foreign currency. Sale will lead to what? Outflow of foreign currency. Receipt will lead to inflow, and payment will lead to outflow. Whenever you want to balance the account, first balance the cash position and then balance the exchange. In short, we should first do the adjustment of cash position and then the exchange, because when you adjust cash, exchange will change. When you adjust cash, exchange will change. Currency futures, very simple what we do, but the only thing is the contract currency and exposure currency may or may not match. So first you'll have to calculate number of contract, for which write the exposure in one currency as well as the other currency, size of one contract, divide, get the number of contract, and decide your action. What are you doing with the product currency? What are you doing with the product currency? Then date, position, action, reference date and rate. Exposure versus contract. We should ensure that exposure and contract currency is same. In case they are not same, you should do the conversion and then do the calculation. Final cash flow is amount paid or realized at spot rate plus or minus net settlement minus interest on margin money. NDF, non-deliverable forward contract, will be similar to futures. This I had explained in that. So there will be a net settlement. In margin money in futures, if there's a margin money is not my expenditure. Interest on margin money is my expense. Same with your option contract. When you decide your call option versus put option, please decide what are you doing with the product currency. What are you doing with the product currency? Don't say I'm importer, I'm exporter, and then start doing the problem. Please see 0.0122 per INR. INR is the product currency. I am planning to sell receivables. I'm planning to sell receivables and buy INR. If the exchange rate is 0.0122 per INR, I'll take a call option. I'll take a call option and not a put option. There are 2-3 things which will happen. Whenever you do this, one, there will be a premium paid. Second, there's an interest on premium. Third, there is a hedged outcome and an unhedged outcome. A company needs 17.4 contracts to hedge full exposure. We need to round off, it will become 17. So there will be some unhedged. Unhedged can be paid or realized at forward rate or future spot rate. If future spot rate is given, great. If not given, forward rate is the proxy. Forward rate is the proxy. Investment. Okay, I've not given. I've not covered, I think, currency swaps in the citral. I missed it. Okay, currency swaps part got missed out in the concept book, but it's there in the video. It's there in the video, and maybe currency swaps is getting covered in your interest rate swap. So there the explanation is there, but currency swap is not there in the concept book. So maybe you will have to just take care of that element alone. Investment decision is deciding where do I make the investment. So I calculate in one common currency and decide which gives me the maximum gain. Be little careful on selection of investment option. If you are getting same outflow on the same amount on the last day, then you can select one which has lower risk, And financing decision, indifferent borrowing rate is calculating FRA rate, calculating the FRA rate. This is summary and other key points. I think this is kind of covered. Forex is fully over. Whatever I wanted to cover is done. Currency swap, I'll give a 20-30 minutes video. Just that part alone, you see it. Tomorrow we are starting with international capital budgeting, where some understanding of capital budgeting will again be needed. I'll end with this.